administration, the Senate is now expanding it. So basically the change allows more companies to qualify in this program, and it increases the tax breaks to encourage small business investment. Now, one negative for high earners, so that's a limit on certain deductions that will make charitable giving a little less attractive. Now, some estimates say that could reduce giving by the wealthy by over $8 billion a year. Now, for the full breakdown,
who are them some?
Changes that matter most to high earners, you can check out the Inside Wealth newsletter at cnbc.com/insidewealth, cnbc.com/insidewealth. So all in all, for the wealthy, the big
Jimmy's here
from the 2017 tax cuts are mostly on the bottom, right? More generous for the bottom. So it's tips, it's overtime, it's Social Security, it's that $6,000 credit for seniors. At the top, the only real change was this small business piece and the SALT part, which again doesn't apply to many of them because the cutoff is $500,000.
Okay, but you have heard about some accountants talking about recategorizing certain types of income. I don't know if, I think at the high end it would be almost
Well, they need nothing new, you dummy.
Income as a tip or as something else. Overtime. But how do you see this happening?
No, I don't. I think there was a fear of recategorization of income because of the tips and overtime. Again, more at the bottom of the distribution. Right. At the top, I don't think well, what really mattered for the top is permanence. So what are the rules of the road going to be, at least for the foreseeable future, given that, especially for the estate tax, we were looking at this possible cliff. So the wealthy were giving money away in record numbers to their kids because there was the potential of seeing that exemption drop by more than half. So now, okay, it's permanent. It's
you got a problem with that?
We know what the rules are.
So how long will the 30 last?
Until the next big election changes who's ever in the White House and Congress. I mean, they say it's permanent. Nothing is really permanent in D.C. But all in all, for the top, there isn't much change except for the fact that most of what they got in 2017 is extended, and there's that stability now, which is important, and that could increase confidence for wealthy investors and for spenders, for consumers. So that's good for the economy.
Robert, Frank, thank you.
Thank you, guys.
It's nice to see you.
Coming up, mortgage refinance demand surged last week. Details after the break, and later Tesla shares are down 7% from Friday's close. The automaker set to report second quarter deliveries this morning. We'll bring you those numbers as soon as they hit the tape. Squawk Box will be right back. New mortgage data just out showing a 7% jump in refinancing applications last week compared to the prior week. Demand was up 40% from the same week a year ago. That comes as the average rate for a 30-year fixed rate mortgage fell to 6.79% from 6.88%. Applications for home buyers were less driven by the drop in rates. They increased by just 0.1% from the prior week.
Okay. Coming up, House Majority Whip Tom Emmer. He's got a tough job this week trying to round up enough Republican votes to pass President Trump's tax bill before July 4th. That man is going to join us. And stay tuned. We're also going to get ADP jobs data at 8:15 Eastern Time. That's ahead of tomorrow's government report, jobs report, that is. Squawk Box coming right back after this. Welcome back to Squawk Box. The president's reconciliation bill is back in the House now with just 2 days left, really, until the self-imposed July 4th deadline. Our next guest is tasked with getting Republicans to vote for it. Joining us right now is House Majority Whip Congressman Tom Emmer. Good morning to you. We just had a guest on who you know very well, who said he's not voting for it, and he's hoping that maybe this can get pushed out to next week and that there's some kind of compromise to be had. But now that the Senate's out of town, it's sort of do or die if July 4th is really the day.
Yeah, well, it's going to get done. The thing we're working with right now, it's the one big, beautiful bill that is going to actually be generational. I mean, you're going to hear different things from our members. They're very passionate. What I was going to say is the thing we're dealing with this time are the elements of time and emotion. Normally we have a lot more time, but as you know, this just came across. It's basically 85 to 90% of what the House sent over in the first place. So you got to give our members a little bit of time to work through that process. We don't have a lot of time. And the other piece is emotion. Remember, the House was out this week. So people are returning from all over the country, leaving their families to come and get this historic piece of legislation done. to meet Donald Trump's agenda. And the last thing would be, we can't control the weather, right?
Let me ask you this, though. If you look at this bill that's coming out of the Senate, whether you want to use a CBO score, or by the way, some of your own colleagues' score, it adds to the deficit more than before. Is that not a problem for you?
Actually, if you look at this bill, this is all about growth. The money that they say adds to the deficit is making those tax cuts, those business taxes, permanent. This is policy that's been in place for 7 years. That is roughly the difference between the House bill and the Senate bill. And I look at it this way. Literally, we're saying that we're going to keep your taxes at a certain rate, and our government says, oh my goodness, you're not going to put it up at the rate we want because we want to spend this amount. The president and the legislative body are saying no. This idea that it's going to take 9 years to pay for tax cuts, what that says to people like me is, it's going to take my government 9 years to spend what it wants to spend today, and we're telling them no. So, no, I'm not worried about it at all. President Trump is, with his leadership, he's bringing in $15 trillion in investment, making these the Tax Cuts and Jobs Act permanent. The same policy, again, we've had for 7 years, is going to literally explode the growth in this country, the economic growth. It's going to be great for everyone. It's going to be great for America. And you know what? Our guys are going to be very happy that they were part of this historic moment.
Congressman, a very astute viewer has sent in this question. I will ask it to you, which is, why are we currently not getting 2.8% growth today, with the assumption if the CBO is at 1.8 and the administration's at 2.8, and part of what we're talking about here is extending the tax cuts that are already in place. And yes, you're going to capture no tax on tips, and maybe that'll drive some of this, but what is going to get you to the 2.8 number?
It's Donald Trump. Donald Trump and this legislation. Keep in mind, we've had 4 years of disaster under Joe Biden. Donald Trump has only had a little less than 6 months to try and fix this thing, and already you've seen enormous changes. In the CBO, by the way, 1.8% growth is what they projected over the next 10 years. This country has never had less than 2% growth in any 10-year period. So be careful of the numbers that these insiders put out, because bottom line is, we've seen it all throughout history. When you give Americans more of their hard-earned money, when you give them more freedom to make new things happen, they not only improve their own lives, but the rising tide lifts all boats. And that's what this country's all about, and that's what's going to happen with this legislation.
You mentioned Everyday Americans, and you're rolling out a video. You're teaming up with DoorDash. You're featuring the DoorDash grandpa, Kevin, who will save a lot of money because he won't pay taxes on his tips anymore. And I'm wondering, Congressman, if you think this will allow the restaurant industry, to the industries that rely on workers getting tips to subsidize wages, to still pay lower wages. How do you think that through when these workers are able to keep more tip money in their pockets, enabling potentially their employers to not raise wages as much, or even maybe cut wages?
We've got a great restaurateur, entrepreneur in St. Paul, Minnesota, who's expanding, and his name's Brian Ingram. I don't know if you've had him on the show, but Brian would tell you that this is going to be great for his employees, and you're looking at it from the standpoint, Becky, that you assume that the owners of these businesses don't care about their employees. In fact, they do. They're hungry to find employees, and they're going to pay them what they're worth. This is only going to help the employee, and which is amazing, because our colleagues on the other side of the aisle want to say this is all for the wealthy. Well, no, it's not. We're continuing the same tax policy that's been in place for 7 years, and we're actually helping working men and women with no taxes on tips, no taxes on overtime, and we're helping our seniors with great changes when it comes to no taxes on Social Security. So this is a great bill for everyone. Donald Trump said it yesterday. This is no longer the House bill. This is no longer the Senate bill. This is the Americans, the people's bill. So we're looking forward to passing it today.
Congressman, do you think that it does have any impact in terms of shifting people's interest in taking on certain types of jobs versus other kinds of jobs? To the extent that it has the success that you're talking about, and I know this was a campaign pledge by the president, and not to relitigate it, but there are people who say, What about the teacher? What about the nurse? What about the somebody who's not necessarily working at a restaurant necessarily, that works for tips, for example, and how we should think about that philosophically?
Think about everything. People talk about we're in the technology age. We are creating this dynamic economy again. It's not going to be static as it was under this static and frankly deteriorating under the last administration. This is a dynamic economy that allows for people to invest in new technologies. You will create so much growth that this idea that you're going to displace other workers, no, you're going to create more work for everyone in spite of the technology. So I think it's going to be great for our teachers. I think it's going to be great for the working men and women of this country. I think it's going to be great for every American.
No, but the reason I'm asking the question is a teacher who's getting paid $70,000 a year and a waiter that's getting paid $70,000 a year is going to be taxed at a different level, because part of that $70,000 that the waiter is capturing is going to be tax-free, given that it's in the form of tips.
It's an interesting comparison that is really apples and oranges. The teacher is going to be much more compensated than the server in the restaurant. So the idea that you can compare the two is just not accurate. This bill is going to, the legislation, by making these tax policy permanent, by doing all the different reforms that are in this historic piece of legislation, are going to help teachers, they're going to help working men and women, they're going to help all Americans.
Congressman Tom Emmer, we appreciate you joining us. We plan to watch and wait and see what happens, and we hope we'll have you back when and if this gets passed, or if it doesn't, as things progress. Thank you.
Thank you.
You bet.
Coming up, ice cream moguls Ben and Jerry have always been politically outspoken. Now their foundation is the latest target of anti-woke backlash. We'll dig into the new report from Semaphor's Liz Hoffman. That's next. And in the next hour, SEC Chair Paul Atkins will join us in a first on CNBC interview to discuss crypto regulation, new digital assets tracking private markets, and a lot more. Squawk Box will be right back.
Welcome back to Squawk Box. The corporate woke wars have found their latest battleground in a freezer. Semaphore reporting that Unilever cutting off funding to Ben & Jerry's Foundation. This after a clash over transparency and ideological control. Joining us right now to get into it all, Liz Hoffman, Semaphore's business and finance editor. This is a fascinating story. Tell us what's really going on here.
So, Unilever bought Ben & Jerry's 25 years ago, and first they really liked their kind of quirky progressive politics, and then for a number of years they kind of quietly tolerated it, and they've really lost patience with it. This is a company that has a real social mission, is not quiet about it, and is spending Unilever's money to enact it. Unilever gives millions of dollars a year to the Ben & Jerry's Charitable Foundation, which they send to exactly the kind of causes that you'd think, many of which have a very pro-Palestinian bent these days. And it's become a real headache for Unilever. And they are in the middle of spinning off this and their other ice cream businesses, which creates a corporate opportunity to figure out what's going on here. They're trying to audit the foundation. They're not getting a lot of cooperation. And they said, we're done funding this stuff. So that's where we are. There's a lawsuit simmering in the background where the foundation essentially says that they've been muzzled over the last year or two for speaking out on pro-Palestinian issues. And you end up with this really, really niche fight at this giant consumer goods company.
Is there any impact on sales as a result of what's happening here? Either people who are walking away from eating Ben & Jerry's ice cream or people rushing to Ben & Jerry's ice cream, given the stances that this company appears to have taken?
That's what's interesting to me. We haven't really seen it. I mean, there was a real sales impact about 4 or 5 years ago when Ben & Jerry's said, we want you to stop selling our ice cream in the occupied territories in the West Bank. And Unilever said, okay, we're selling the license. Like, we do not want to have this fight. So you saw it then. You actually haven't seen it now. This is a pretty niche fight between some pretty ideologically motivated trustees of the foundation and a bunch of British and Dutch executives who say, we did not sign up for this. We're just trying to sell ice cream. And by the way, we're trying to sell shares of this ice cream company to the public over the next couple of months. So it's become kind of a fight that's happening away from consumers, which is interesting to me.
Go 30,000 feet, though, up just on the whole DEI issue. What really is the status in this moment, you think, of companies rolling back these policies? There were a lot of announcements. Do you think that those were real? Was that just language? What's been the biggest impact, if you will?
I think it's mostly language. Certainly some real impacts on some of the stricter sort of HR policies that were adopted post 2020. You're seeing those quotas, which frankly were always kind of illegal, go away. The softer targets are still there. On the environmental stuff, it's kind of being rolled forward on a 5-year clock. I think companies are very afraid of being sued, frankly, for walking back things they said publicly, for almost as afraid as they are of kind of ending up in the public sphere for some of them. So I think most companies are trying to keep their head down. Unilever unfortunately cannot, because it has this very, very loud subsidiary.
Meantime, I think when you come on, we almost can't get away from at some point mentioning Elon Musk. The Musk-Trump fight is back on. It had been off. We thought there was a ceasefire between them. I don't think you can use the phrase ceasefire. That's wrong. Well, it's just not a truce. But they're back on. What do you think it means to Tesla?
I think it's really bad for Tesla. We published some data yesterday, a consumer survey of 8,000 people, and Musk had lost Democrats, some time ago, certainly on the way in, but there was a sense that he might be able to actually bring over some Republicans, kind of buying Teslas out of solidarity, and importantly for the EV industry, grow that tent, grow the politics of people who might be interested in an electric vehicle. That has not happened. The data that we published from Electric Vehicle Intelligence Report said that Republicans were 11 percentage points less likely to buy a Tesla than they were just a couple of months ago. So that coalition has not expanded. This is bad for Tesla. I mean, the thing about Tesla is, for a while, it sort of had a monopoly on the product. It built these really beautiful, really great category-defining cars. It turns out it's not really rocket science. There are certainly things that Tesla is doing better, and the self-driving stuff is interesting. The robotaxi stuff is interesting. But building a good electric car is something that plenty of car companies have figured out how to do, which means that they're really reliant on the brand. And they kind of always always have been to a degree. Elon Musk kind of single-handedly kept Tesla afloat by bringing in investors, by bringing in talent. It was sort of a force of personality at that company, and now he's become frankly toxic to people on both sides of the aisle. I think they've got real problems. Their sales are you're already seeing it. There have been some executive departures. Elon is kind of trying to run sales to take that over, particularly in Europe where they've really bottomed out. I think they have real problems.
I wonder, Liz, if this sort of marks the pendulum swinging back. You know, for some time we saw companies get out there taking stands, selling products that cater to a specific group of people in the country. They suffered backlashes, that lasted much longer than anticipated. Target is one. Budweiser is another. We're seeing what's gone on with Tesla in terms of the turn in sentiment on Tesla, because the risk of taking a stand in any direction is that you offend the rest of the people who don't like that stand. And maybe this is, I think could be an argument made that from a shareholder perspective solely, that this is a good thing, that companies are just thinking about what is best for shareholder value at this point, instead of trying to take stands which could risk alienating half of their customer base.
I completely agree. And I think this is a little bit of a function of kind of the late 2010s, where, not to say that being a CEO wasn't that hard, but things were going pretty well. This was a pretty benign macro environment, earnings were growing. It wasn't, the day-to-day job of running a company was just frankly easier. And it kind of created this sort of leisure time among the executive class, and it coincided with these big social movements. Me Too, the murder of George Floyd. And there was this sense that people were looking to them. Their employees and their customers and their shareholders were demanding that they take a stand. And they said, okay, I feel like I have the rope to do that. A couple of things changed. Obviously, the politics just changed incredibly quickly. But so did the job of being a CEO. It frankly just got harder. And they're putting out a lot of fires in their business. And they say, God, I never really wanted to do this in the first place. I got kind of pressured into it. And it sort of sleeves off my vest to just keep my head down. The problem is that is hard to do because these companies are, largely big, complicated, global. This stuff really still matters in large parts of the world to investors in particular. And so I think most CEOs are just kind of waking up and opening Twitter and saying kind of there, but for the grace of God, go all of us. I do think they are just badly trying to get out of the business of having opinions on stuff.
Okay. Liz Hoffman, Semaphore, great to see you. Appreciate it. We should also mention for just a moment that we reached out to Ben & Jerry's for comment on that Semaphore story, and they did not get back to us.
Coming up, Fed Chair Jay Powell said yesterday that the central bank would have eased monetary policy by now if not for President Trump's tariff plan. We'll talk to former World Bank President David Malpass. That's next.
Rated PG-13.
Fed Chair Jay Powell said yesterday that President Trump's tariffs had lifted inflation forecasts and we're keeping rates on hold. Joining us now for more on the Fed and the U.S. economy, David Malpass, former World Bank president and now distinguished fellow of international finance and inaugural fellow of global business and infrastructure at Purdue's Business School. David, great to have you with us.
Hi, Melissa. Good to be on.
Where do you think rates would be had it not been for the tariffs? Would we be lower, and do you agree that the Fed should stand pat? And I'm wondering how long you give it to see what the impact of tariffs will be.
I was surprised to see the chairman say that. He was in Europe, and you have to understand the context in Europe. It's all these central bankers sitting around talking and basically anti-Trump. And so that made sense there, but it diverts attention away from the real problem. The Fed has the rates too high, and the question is, when are they going to cut and find an exit strategy from what they're doing? The Fed's have created all these problems, these cycles of inflation and deflation, and I think they have to. There has to be a full remaking of their models. Trump's trying to do that, but it's going to take time. And look at Europe; they're just going to stay stuck in the mud.
Mm-hmm. So, I'm interested in your notion that the context is important in terms of it being a very anti-Trump crowd, because it's almost like the Fed chair was saying, "It's your fault, President Trump. You are the one keeping rates high at this point."
That's the way they want to put it, but the reality is, how do you find models that actually welcome growth? Look, Europe is running a very slow growth, practically a recession all the time. The central bank says that's good because that way you don't overheat. Well, if you run a whole world, the U.S. economy on the grounds that you don't want to overheat, that's really bad for the forgotten man. Trump ran on the idea that there'd be higher medium wages and especially manufacturing jobs. And you can't do that with the rates where they are. They're too high for that because commercial and the actual working capital loans that are needed for small business and for manufacturing aren't there. The banks aren't doing it because all they want to do is lend to the government.
Hey, David, I have a question for you about this bill, and I want to read you. This is an op-ed just this morning from Robert Rubin, Larry Summers. It's titled, "We both served as Treasury Secretary. We know this bill is dangerous." They go on effectively to say, well, government can and should be more efficient. We cannot achieve the sound fiscal trajectory required for longer-term prosperity without significant tax increases. Rather than a legislative package that delivers trillions in tax cuts to the top, we should go back to the drawing board and find ways to raise trillions instead. What do you think of that?
Well, I think that's wrong. It's not a tax increase. You know, it would be a tax increase if they didn't do the bill. And so this gets tangled up in the scoring. We saw it over the last week where they are using the CBO models, the Joint Tax Committee models, and the parliamentarian that were all put in by Biden. And so the reality is you need to change, you need to extend the current tax rates. Otherwise, you'd have a tax increase. And so the growth impact of that would be horrible. So I don't agree with Secretary Rubin or Summers. They served in the 1990s and had deflation. You know, it was a singular period where the Fed models were not working at that time. So we have to break out of it both from the scoring models that are on fiscal side, but it's the same limits to growth models that are on the Fed side. I think there's a chance right now to remake those models and say that we don't want to concentrate wealth in the rich. We want to see jobs in the middle class, in people that are doing manufacturing. Trump signaled that with the no tax on tips. And I think the American public just looks at that and says, good, that's the right way to go.
I think most would agree that the extension of the tax cuts is very important in terms of stability and investment and growth, et cetera, David. But is a price for all of this, I mean, the price is steep. It's an additional $3.3 trillion in debt. And I'm wondering how you think about the importance of the deficit right now, or if that's something that we just, as long as we can keep selling treasuries, this is all fine. As long as we are the default reserve currency, reserve asset, you know, there is no alternative to U.S. treasuries, we are fine increasing the deficit.
The debt is a big problem. The U.S. government is sucking money from all over the world, but that $3 trillion number that you're doing, and the New York Times does it all the time, is not the increase in what the debt would be. It's this static model that if we didn't extend the tax cuts, and if there was no impact on growth, then we'd be better off. Well, that's a hypothetical world. That's not reality. So we've got to stick with the idea that this U.S. economy can grow much faster than it is. The Fed's in the way because they're using models that are inherently limits to growth, and this is the opportunity to break out of it. So I think we have to recognize the bill itself will get this problem moving forward. I think financial markets will react, already have been, reacting positively to the bill because it gives stability in the tax code. It's been odd that the Fed has not, throughout this last 3 years where there were these huge blowouts in government spending, the Fed was silent. And we have to say that all of Washington, D.C. is complicit in this of making the government bigger and bigger. So that should come to a stop right now.
All right, David, great conversation. Thank you. David Malpass.
It is almost 8 a.m. right here on the East Coast, just about. We've got about 40 seconds before we hit it. You're watching Squawk Box right here on CNBC on this Wednesday morning. I'm Andrew Ross Sorkin along with Melissa Lee. Joe and Becky are off today. So much going on, especially in Washington right now. Top story, President Trump's tax and spending bill back in the hands of the House with a lot of pressure to get it to Trump's desk by Friday to meet that timeline. The House can't make any changes, though, to the Senate version at all because, well, most members of the Senate have already left town, and some members of the House are already raising objections. So we're going to see what happens here. On the tariff front, the president suggesting the U.S. could reach a trade deal with India ahead of the July 9th deadline, which he said he's not thinking of extending. The president expressing doubt about reaching a deal with Japan, though, by then, threatening to hit the country with tariffs of up to 35%. So one of our great allies could get hit with a 35% tariff. And we're watching bank stocks today, many hiking dividends and buybacks after passing the Fed stress test. Goldman Sachs raising its dividend from $3 to $4 a share. Morgan Stanley and JP Morgan also raising dividends while authorizing new stock buybacks. Bank of America, Citi, Wells Fargo also boosting shareholder rewards. So, and we had a guest on who's got very bullish outlook on the banks.
Because of AI.
Because
Not
of AI.
because of this.
Right.
President Trump says Israel has agreed to conditions to finalize a 60-day ceasefire deal in the war with Hamas, and the U.S. will use that time to try to help end the conflict. In a post on Truth Social, the president said, "I hope for the good of the Middle East that Hamas takes this deal because it will not get better. It will only get worse." Israeli Prime Minister Benjamin Netanyahu is scheduled to visit the White House next Monday. The U.S. equity futures at this hour turned negative here on the S&P 500, just slightly. Dow still looking to add by about 54 points at the open. NASDAQ looking to be lower by 38 points. Let's get to the New York Stock Exchange. Mike Santoli has a look at the trading day ahead, and this follows a very interesting first trading day of the second half. Yesterday, we saw decisive rotation, Mike, into some of the lower multiple areas of the market.
Very dramatic, Melissa, absolutely. So on the surface level, the S&P 500 did almost nothing, but there was almost the maximum amount of pushing and shoving below the surface to get there. I do want to point out one thing: the repair process from that springtime mini crash has continued to the point where we have a so-called golden cross. That's when the 50-day moving average of the S&P 500 crosses above the 200-day. The forward-looking implications of that in the next month or so are pretty much negligible. It's kind of like could go either way. Sometimes you back up a little bit, but over 6 months it tends to be a more positive indication that the uptrend is back in place. Now, you mentioned those rotations. Take a look at one way of viewing this. This is the S&P Momentum Factor ETF, SPMO, and that's S&P Value. So this is just a 5-day chart, but what you see is, as you mentioned, that 1 day immediate turnabout. Now, on a year-to-date basis, momentum is beating value by 13 percentage points. So this is really just about mean reversion, the idea that the momentum factor perhaps got a little bit too stretched relative to the rest of the market. There's been this mechanical rotation in the other direction. Whether it continues, we've seen this before. It's actually had one in February. Sometimes it can be a source of instability and sort of erratic action because you don't have the protection selection and sponsorship of those mega cap growth stocks for the index. But for now, it seems like it's really just more healthy. Banks were up yesterday, as you guys were mentioning. That's a good piece of this. Healthcare's up 2% week to date, and the S&P's up only 0.5%. Now take a look at this. This is the S&P Industrial ETF, and that's the Dow Jones Industrial Average. You see for the most of this period, mostly in line, but now you see the S&P Industrials just rocket ahead. Couple things here. The non-industrial parts of the Dow have been holding it back. That would include healthcare like United Health and Amgen. That would include Apple, which has started to bounce here and perhaps had a role in that break in the momentum factor. And then XLI also includes things like Uber and a lot of those AI-levered power plays in industrials that seem to be rocketing it higher. So maybe we're in for some convergence here as well, guys.
Yeah. Mike, thank you. Mike Santoli. Tesla expects to report second quarter deliveries in the next 90 minutes or so. Yesterday, the EV market maker's market cap falling below the $1 trillion mark for the first time since June. And it's currently the only Mag 7 name trading below that level. Joining us now with more is Colin Rush, Oppenheimer Senior Research Analyst. Colin, great to have you with us. Sell-side estimates is 385. Where do you fall on this, given we have some indications from Europe and China already?
Yeah, we're a little bit closer to 365 for the actual number. I think buy side is more in line with us in the 360 to 365 for deliveries. The China number that came out this morning, is an improvement from where they're at, but it's certainly not enough to get the company back to the kind of 450,000 units a quarter that they need to be at to really hit the street numbers for the balance of the year.
I'm curious, Colin, as to what investors are saying to you and how you read their sentiment given the tussles between Elon Musk and President Trump. I mean, you could make the argument that on the way up, when things were cozy between Musk and Trump, and the stock gains, from November to the end of the year or so early this year, that the stock should give back that and then some, because the position Tesla in right now is actually not even neutral; it's negative compared to where it started even prior to the election.
Yeah, I mean, I think what folks are looking at is really around execution on the technology side. We saw the launch of the robotaxi service in Texas. I think it's been kind of a net neutral to push slightly, a little bit up for some folks, a little bit negative for some folks. I think it was expected to be modest, and really the ability to improve performance from here is what everyone's watching. So we've seen some improvement around city driving on the technology. And I think what we're going to want to see is, just more and more trust being built with the consumers in the Austin area and increased usage on that technology. And then there's all the optionality around the humanoid robots, which, it's really unclear how quickly that will legitimately come to market and become a revenue driver for the company. And I think there's also some real questions around real application for those robots when you actually get into industrial processes. I think so for us, what we're getting is a lot of questions around uncertainty. There's a certain amount of, I think trust in Elon, and that when he's backed into a corner, he actually tends to do pretty well. And we'll see how he works his way out of this situation, which looks pretty difficult right now.
Yeah, and to your point about execution, Elon Musk is now going to head Europe, right, after that person stepped aside. Tom Zhu, formerly VP in China, is now heading global operations. Does this increase your optimism that they will be able to execute?
One of the concerns that we had, and we started writing about it earlier this year, was around brain drain for the organization. Part of what we've seen historically, having covered the company for almost 15 years now, is that the ideology of a better future and a zero emissions future had really been driving a lot of the employees. As we saw Elon's political activity, get a little misaligned with some of that vision, I think there's some real concern around Elon's politics and what the company's mission really ultimately is. And so as we see some of these management changes, I think the company was probably due for a little bit of a turnover on some of those roles already. But who actually fills the roles and how well they fill them and how efficient they actually execute around some of the adjustments that they need to make as an organization really going to be telling. My feel is that this is going to be a little bit of a tough transition for the balance of the year, and that 2026 may be a little bit better, but I think this year it's going to be choppy in terms of execution and results for at least the next couple of quarters.
I mean, do you want the CEO to be heading Europe? I mean, that just seems too granular for a CEO of an EV company that's, has a
I think
very
it's a
sort of
transition.
uncertain future.
Yeah. You're 100% right. You don't want the CEO running sales for an organization of this size. You want him laying out the vision, but Elon's got a history of stepping in where needed and then bringing someone in to actually fill the role. So I think he's probably trying to get his head wrapped around what exactly the issues are and how they want to approach it. And having that direct experience is helpful. But the fact that he's stepping in suggests that they don't have a great solution for how they're going to address the European demand. And that, I think, is part of our concern here for the next couple of quarters as they work to figure that out and build a strategy around addressing that issue. Having Elon there, I think, is the right move short term, but over the long term, you certainly don't want him running sales in Europe.
All right, Colin, great to speak with you. Thank you.
Thank you.
Colin Rush.
Okay, meantime, Netflix holding talks with Spotify about partnering on a number of projects related to music award shows and live concert series. That's according to a Wall Street Journal report that said that they're also considering doing some big celebrity interviews and short turnaround documentaries. Netflix also rebooting the talent contest Star Search, is working on another music competition show as well. So, it's so interesting, and we'll see if they ever get there. I was going to say, do they ever really go to the news? I remember many years ago talking to Reed Hastings about news. Would you ever have news on Netflix? And he said, nope. And that was, by the way, at a time, you remember they had a comedian on, there's a lot of comedy on Netflix. And I think one of the comedians had said something about MBS. This was after the Khashoggi stuff.
Right.
And they wwere shut down or had to pull the video from the service to stay on in Saudi. And he said, we're not in the news business. We don't want to be in, in these sort of controversial places. It's interesting. Once you start getting into talk shows and other things, by the way, for a long time they said they wouldn't be in sports.
Right, but all these things are unscripted, basically, and news is scripted.
Well, news is not. You think this is scripted?
Well, this
There's
is
nothing
obviously,
scripted about
clearly,
this.
there's nothing
Obviously.
scripted about. I mean, we wouldn't say half the things we. No, just kidding. But it's a much costlier business, the news gathering business of sending crew, and maybe things will change with different technological developments.
Right.
But I think that it's a much more difficult road, as we know.
Yeah.
All right. And Jeff Bezos just unloaded more than 3 million shares of Amazon, valued at nearly $737 million. The move was part of a prearranged plan allowing Bezos to sell up to 25 million Amazon shares through next May. And this, of course, coincides with his nuptials to Lauren Sanchez.
Coming up, ADP private payrolls just moments away ahead of tomorrow's government jobs data. We're going to bring you the numbers and instant market reaction next. Then a first on CNBC interview with SEC Chairman Paul Atkins. Squawk Box coming right back.
just about a minute away from ADP data that is set to be released at 8:15 on the nose. Let's check on the markets ahead of these numbers. We've got the S&P 500 looking to add about 4 points right at the open. We've declined over the course of the morning, but still looking for a gain. The Dow looking to add 75 points, and the NASDAQ paring its losses here, looking to open lower by about 10. Got to check Treasuries ahead of that number. We are seeing some stability in the 10-year yield, 4.296. That's where it's been pretty much the entire morning. And we've got the 2-year yield at 3.795%. Of course, we'll be watching these very closely for the reaction to the ADP report, which of course is the precursor to tomorrow's all-important jobs report, which will be another key data point for the Fed in making its decision. Quick check on oil here. We do have WTI Brent up by more than 1%, 1.2% to be exact, and Brent here at 1.2%. And taking a look at the dollar, we just mentioned the worst half of the year since 1973, and the dollar index is a little bit higher today. We've got ADP crossing the wires. Let's get to him.
Minus 33,000. ADP saying that non-farm payrolls declined by 33,000. That's substantially below, for the second month in a row, the estimate of 100,000. It is the only decline since March of 2023. Goods sector not doing too badly, up 32,000. The losses appear to come from the services sector. We'll show you details in a second, of minus 66,000. And there's the non-farm payroll estimate, which includes government and the private sector, for tomorrow, Thursday, remember folks, and that's 110,000. It's the second weak month in a row for ADP after downwardly revised 29,000 for May, but it's been running, by the way, substantially weaker than the BLS private sector numbers. We'll give you that in just a second, but first let's look at which sectors were affected. Small business down 47,000. There's been a lot of speculation as to whether or not the tariffs would be hurting or hitting small business, down 47,000. Medium-sized business down 15,000, but large businesses doing okay, up positive 30,000. The losses were in this professional and business services sector, minus 56,000, but also one of the stalwarts of the job market, education and health services, down 52,000. Financial activities down 14, but manufacturing up 15, and leisure and hospitality still doing well, up 32,000. As for wages, the 4.4%, this is, by the way, called for millions of paychecks out there, so it's actually better than the government data. It is up 4.4% for people staying in their jobs. That's down a tick, and 6.8% for job changers. That's down 0.2 from the last month. Note that the average absolute difference, without care to sign, between ADP and the BLS private sector is now up to 77,000 per month. So it's not exactly spot on. There's some scope for the ADP to be in line with the lower estimates on the street. Guys, I have seen other data that suggests the payrolls will be soft. Some of the high frequency data we follow from Homebase, Goldman noting the big data. Also, maybe worth mentioning, in the ISM manufacturing report from yesterday, they said that mentions of job firings outnumbered mentions of hirings by 3 to 1. So I think the market has a, what's the right word, ambivalent relationship with ADP,
right,
because it's just not on. But as for perhaps spotting a trend or underlining the concerned softness, I think it probably does a decent job of that. Over the course of a 12-month period, the two are off by about 200,000. So over time, they kind of come together. That's only 14,000 a month. As for the Fed, this will increase pressure on the Federal Reserve to cut rates, but it won't change anything about the concern they have over potential inflation. So it really just kind of deepens the stagflationary concern that we've heard from Fed officials.
Yeah.
Meantime, the one and only Rick Santelli joins us from the CME for his reaction to those numbers. Rick, you've been looking at them, listening to Mr. Leisman. What's on your mind?
Well, I mean, definitely it's the worst job creation from ADP since March of 23. That's a pretty good stretch of time. We all know that the labor market, at least purported by all the experts, economists, and Fed personnel, is just kind of a ticking time bomb of slowness. It's going to definitely slow down. It's just a matter of when and what the rate of change is going to be. I don't know that I agree with that, but I do agree that the glide path is going to be headed down. But I think it's going to be a long glide path, and the relationship between ADP and the Labor Department's statistics that we'll be seeing tomorrow, as Steve adequately pointed out, there's a wide spread there. When I look at what happened with JOLTS yesterday, when I consider most of the press and headlines over tariffs and the current administration's policies, it doesn't shock me that there may be more uses of the word firing than hiring. But maybe it's the contrarian end of this that we should pay more attention to. Maybe we should learn a lesson about what the equity markets did, about the kind of counter-trend rally we had that briefly pushed yields down, although I think that much of that may be in the rear-view mirror. Ultimately, I think it's easy. Yes, I think the best days of the labor market are behind us, but I do think that there could be a resurgence down the road for a variety of reasons after we hit maybe a small speed bump, and I think that's the real issue here. Are we going to get a genuine slowdown or a small hiccup? I'm in the latter camp.
Can we just go for one? Can I just ask one question?
Yeah.
What do you think this is a function of? Meaning why? We're talking about AI. We're talking about tariffs.
So
talking about what?
Eventually, standing in place creates a drain on the job. The reason is because people leave the job market if you don't hire more people. So what we've heard is not so, and what we've seen, by the way, in the data is not so much firing, it's a lack of hiring. Over time, that creates saps the strength of the labor market if you're not replacing those people who leave, so the total employment level would fall. I think the uncertainty may be a major role here. And I also think that we've heard a lot of stories about small businesses, the ones who are importing stuff, the ones who take the imported stuff and make other stuff out of it, small manufacturers, they have been potentially hurt by this. Before any of the potential positives that are hoped for by the administration, the bringing back or the reshoring, before that has any effect. I think the key here, again, is this stability, which would people say, okay, I know what the tariffs are going to be, I know what the taxing is going to be, that would say, okay, I get the situation, now I can right-size my job, my employment, which may be higher, maybe lower, maybe the same. I would just point out, though, that it was the weakness in the job market. People debate the 50 basis point cut before the election. It was the weakness in the job market that was cited repeatedly by the Fed as to why they cut 50. They did so in a very different inflation environment than the one we have right now. And there are the probabilities now. I guess they're a little bit higher for October, a little bit higher for December.
Why was it a really different inflation environment?
Because you had declining inflation back then.
Come on, you had stagnant inflation back then, exactly like we have now. The sticky last mile, really nothing has changed except for the way the Fed talks about it. It really hasn't changed much, Steve. If you look at the core numbers on PC, the core numbers on a lot of the data points, they're kind of stuck between 2.5% and 3.1%. Really nothing has changed on that front. There has been some uncertainty, but whether you look at things in the past like long-term capital, the credit crisis, uncertainty, exogenous issues always creep up, and the Fed seems to be able to determine policy before they happen. I'm not sure why tariffs are so damn different.
Rick, just real quick, you have a across the board at least 10% increase in imports, right? And that will mathematically
10% what? Wait, I didn't pick that up. 10% what?
An at least across the board 10% tariff likely to be put on imports. So that's going to have some mathematical effect.
Right. And you're making that the center of your worry bead universe, although it's what? Imports 11% of the economy. Once again, I will stress, we are overplaying the uncertainty Trump tariff card. And Trump's overplaying that he's not more hyperbole than fact on how rigid this is going to be.
What is it?
And both of these are going to meet. What is what? I think, we just made new all-time highs in stocks. I don't know. I think things are pretty darn good.
Rick, I have to tell you, you're wrong. During the time the Fed was cutting interest rates back in
I'm
September,
not wrong, Steve.
inflation
you
was
might
falling.
disagree with me, but you can't determine whether I'm right or wrong.
It's a factual thing. Inflation
Right,
was falling
factual.
at that period of time.
Inflation hasn't changed. It really hasn't changed. What changes
No, it has. It's
how
down
you
a lot,
and
Rick.
others talk about
That's
it.
actually more for your
It's
argument,
down
by
a
the way.
lot from years ago. It's down
gotta
a
go,
lot
guys.
from years
Sorry.
ago.
Always like a good fight, but gotta go.
We got to go. A reminder, by the way, we should tell you, U.S. Markets, they're closed on Friday, of course, for the 4th of July holiday, the June jobs report. That's going to be released at 8:30 a.m. time tomorrow. So we'll give you the numbers and the market reaction. We'll see whether ADP matches whatever BLS thinks.
We are just about a week away from revealing America's top states for business for 2025 in CNBC's annual study. Once again this year, the cost of insurance factors into our rankings. Scott Cohn joins us from the epicenter of a national crisis in California. Scott.
Good morning, Alyssa. We're in Pacific Palisades. 6,800 structures were destroyed here and 12 people died. Still a great deal of destruction. But as you can see, there is some rebuilding going on, and critically here in Southern California, people are getting insurance. Of course, they are paying more for it. State Farm, the state's largest insurer, just won approval for a 17% emergency rate hike. It is asking for another 13% for a total of 30%. Statewide, the online insurance marketplace Insurify projects an increase of 21% on average in California this year. But independent insurance Scott Wilk, insurance agent Scott Wilkes says all things considered, people will take it.
Early on in my career, pre-insurance crisis, if I had a customer's rate go up by $5 a month, I could be hearing about it and hearing complaints about it. Now people are just excited when their policy renews and it's still enforced.
Of course, insurance companies dropped a whole lot of people from their roles, many of them before the wildfires in January. California's increases are not the highest in the nation. That distinction belongs to Louisiana, as you can see, then California, followed by Iowa. Yes, Iowa, Hawaii, and Minnesota, as insurance companies recalibrate their risk.
It's not just a phenomenon in a few states. We're seeing rising insurance costs all over, and partly that's a reflection of rising risk. We've seen a sharp increase in the frequency of disasters that create over $1 billion of damage.
It still, though, varies quite a bit from state to state and has become a really important factor, particularly here in California, but in many other states, in the cost of living. So we are factoring insurance into the cost of living category of America's top states for business this year. You can read all about that, read about our study, and see where your state ranks just about a week from now at topstates.cnbc.com. A week from tomorrow, Melissa, we will reveal America's top state for business.
We love all those clues, especially the diabolical ones. You seem to always stump us.
They're coming.
In the report, we mentioned that premiums across the board, across the United States are rising, and I'm wondering, this is the first time that insurance cost is actually factoring into this ranking. It's that much of a decisive factor.
We started factoring it in last year. In the cost of living category, we look at homeowners insurance, and we have a lot more data on it this year. We also are factoring in commercial insurance in the cost of doing business category. It really has become an important factor in the cost of living, in the cost of doing business. And the experts are saying this isn't going away. This is something that, as we continue to have higher costs of replacing housing or structures, and of course more climate risk, that it becomes a bigger deal. And the insurance companies are really trying to manage this, and yet they're very heavily regulated from state to state. So it really does vary, and it's very interesting how it does vary from state to state.
All right, Scott, thank you. Great to see you. Scott Cohn.
Okay, we got some breaking news right now from Rivian. Phil LeBeau joins us now with more. Phil, what's happening?
Andrew, Rivian's Q2 deliveries totaling 10,661 vehicles, roughly in line with expectations. Production for the quarter was 5,979 vehicles. Now, you might be sitting there saying, wait a second, that's far lower production than deliveries. Remember, they are in the midst of a transition from model year 25 up to model year 26. So that was expected that you would see slower production. It's not unusual. Many automakers go through a similar type of thing. Their delivery guidance remains the same for all of 2025. They expect to deliver between 40 and 46,000 vehicles, so no change in their guidance, and they will be reporting their Q2 financial results on August 5th. Again, Rivian deliveries for the quarter, 10,661 vehicles. Guys, I'll send it back to you.
Okay, we're going to keep our eyes on that one. But coming up next, a wide-ranging interview with SEC Chairman Paul Atkins, from priorities in office to crypto regulation and the rise of tokenization of private companies. We're going to cover it all next. Squawk Box returns after this.
We've got this.
We are joined right now at the table by SEC Chairman Paul Atkins. We're thrilled to have you. A lot going on in Washington, as you know, drinking from a fire hose at this point. And we've got about 1 million questions about the market, about what you're doing, about what the regulatory landscape looks like. And so there's so many different places we can go. I wanted to start with actually something that happened on this set yesterday, if you'd indulge me. Sure. Only because it was such an interesting conversation, and it's now even, again, in the press today, there's Vanguard's doing something similar, which is, we've long talked about public markets and the benefits of public markets. But we've also talked about how in the private markets, there's so many companies that are still private and what it takes to get them to be public. But one of the things that's happening now is this idea of trying to let the public have access to the private markets. And there was a company that came on yesterday. They're quote unquote tokenizing, if you will, shares in a private company, in this case SpaceX. You have Robinhood now doing something similar, but they're doing it outside of the United States in Europe. I'm so curious just how you, given where you sit, think about what's happening right now.
Well, Andrew, it's great to be here. Thank you very much for you all having me. The markets have changed a lot, obviously, over the span of the last few decades. And so whereas the IPO market used to be like when I was a young lawyer starting in the mid-'80s out, that was a way for companies to raise money to build property, plant, equipment, develop their R&D and things like that. Apple, Microsoft, all of those companies started that way. Now, fast forward to now, you have really robust private markets, and so there hasn't been that drive to go public. And part of that also is not just the capital that's there in the private market, but also the impediments to be a public company. That's litigation threats, just the cost of doing of being public, and the other.
And so what is the answer then? Is the answer to make it more attractive to be a public company, or is the answer to make private markets more accessible to the public?
And more transparent.
Right.
I mean, that's a key aspect to this.
Right.
I mean, companies stay private for a reason. One of the reasons is they don't have to file as many things with the SEC. They're not the same disclosure requirements, but to protect investors, particularly average investors, you would think you want that transparency.
Right. Well, so that's exactly true. The law is clear as to public companies and what needs to be disclosed. And so what my goal is to make IPOs great again, basically, is to, there's been a lot of red tape and a lot of impediments, as I mentioned. I think if we address those sorts of aspects, I think we can make the
So what are the 1, 2, 3 top things that you think you need to do to make being a public company, as you say, great again?
Well, first of all, the disclosure is important, but if you look at, I dare you all to look at an average 10K or proxy statement and tell me, what actually is going on with the company. Over the years, there has been so much disclosure. A lot of it is CYA, basically, for potential lawsuits. So if we can address those sorts of aspects, I think we can make it better and more attractive to be a public company.
In the meantime, though, there are these efforts taking place to effectively change what it means to be a quote-unquote accredited investor in private markets. Historically, you've had to have $1 million as a sort of threshold, with the idea being that if you're wealthy enough and have over $1 million, you can afford to lose money or do something that's quote-unquote more risky because you don't have all the same disclosure requirements in a private company. But you, I think, have a different view of this.
Yeah, well, so I think we will definitely take a look at those rules to see, what should be tweaked, because there is a lot of demand on the investor side to be able to invest into private products. And so, but that has to be done, I believe, very with our eyes open, because we don't want to have people go in where they don't understand what they're doing and they're not well equipped.
And so what would that mean? We were talking about tests or other kinds of things to suggest there's an education process, and it's the education that would make you accredited, not how much money you actually have.
Well, so there are lots of different ways. I mean, part of the accredited investor standard came about because the idea is, well, if you don't know about it yourself, you can hire somebody, or you have the means to kind of ferret out the information and make decisions, or hire somebody to make decisions for you. So we need to take a look at that, but we also need to look at, for example, for long-term investing, for people investing for retirement in funds that are very long-lived.
Right.
You know, the aspects about private markets is its lack of liquidity is not what it is in public
Right.
markets. Valuations are a little bit more tricky, let's just say. And so those sorts of things, you cannot go in to a private fund or a private
Right.
investment and expect to turn that around.
What do you make of these sort of tokenization efforts? I mean, it seems to me that we have rules. We could debate whether the rules are the right rules and maybe they should be changed. But given the rules that are in place and the intention of the rule today, it seems to me that the effort to sort of quote unquote tokenize something, an underlying asset, and to sort of use this structure is really effectively just a workaround to what the actual intent of the rule is.
Well, I guess I disagree with that a bit, because tokenization is an innovation. And we at the SEC should be focused on how do we advance innovation in the marketplace. And so I would argue here over the last several years, the SEC has been standing athwart efforts to innovate in the marketplace because things have been unclear. The rules have not been clear. We've had regulation through enforcement. That day is over. We are now, my whole goal is to make things transparent, from the regulatory aspect, and give people a firm foundation upon which to innovate and come out with new products, and so that they know what they're doing.
I think there are two things to think about, Andrew, and that's tokenization of U.S. stocks, which is one thing which could drive a lot of cost savings for all parties
I'm not against
involved,
tokenization. I'm saying
settlement
if you
times
wanted,
would be reduced
I'm talking about if you wanted to tokenize
tokenizing
SpaceX, which is a private company.
And then there's also an access to private credit, I think you were mentioning, which is a complete individual investor access to private credit, which is also another sort of tricky area, in that this is also, as you mentioned, it's not as much liquidity. Valuations are very difficult, particularly I would imagine for an individual investor. I mean, there are a lot of things that here that are new frontiers for investors. Where do you stand on that?
Well, two questions. So as far as tokenization and other innovations in the marketplace to make trading and holding securities easier and with quick settlement, my predecessor pushed for what we call T+1, meaning a settlement and clearance the day after the trade, the trading day. And so tokenization and other aspects of doing that tokenization in the marketplace is yet the next step to have much more efficiency in the marketplace and certainty of having a trade settle. But way back in the 1960s, before our time, basically the New York Stock Exchange had to close for 2 days a week just to catch up on the paperwork from the stacks of paper certificates that were going from one brokerage to another. So then came DTCC and digitization of securities book entry. That was a huge advance, and so now we are in a new world for.
Where do you land on SPACs? We had sort of a big number of blank check companies go public a couple years ago. Most of them did not work out. It was a bad vintage, if you will. I've argued that SPACs could be very interesting if, and I don't know if you'll agree or disagree with me, if whoever the sponsor or promoter is locked in place for whatever duration of the forward-looking statements they make about a deal is. Meaning, if you want to come on TV or put in your documents or do whatever you want and say, here are the future prospects for this company, and we'll give you the numbers, what we think is 3 years out, 4 years out, and 5 years out, great. You should be locked for the 3, 4, and 5 years out. Part of the problem was that these promoters and sponsors of these things could technically, depending on where the stocks traded and other things, they had ways to get out, oftentimes 6 months into the process.
Yeah, well, so I don't have anything against SPACs. Basically, I do think that, again, we were talking about IPOs and how the incidences of IPOs have really decreased over time. And so SPACs are yet another symptom of that because it's a much faster way of going public. You have a ready-made company. Disclosures, very important. Obviously, the structure of it is very important. But I think if we pay attention to going public and what are the impediments for people to access the public markets through IPOs and other means like that, I think the other situation will be able to solve itself.
So let me just ask a philosophical question, because what I hear you saying is two things at the same time. One is I want to fix the system so that the IPO market is a more attractive place to be. And if I do that, I won't necessarily have to deal with tokenizing private companies, and I won't have to really think too much about SPACs because those will be less attractive options compared to going public. My question is, since we all have to walk and chew gum at the same time, what do you do while you're working on fixing the IPO system to make it more attractive? You have all of these other things going on not in the background, in the foreground.
Right.
What do you do about that?
Well, so that's, I mean, I've been on the job for 2 months, which is great. And again, like you said, drinking from a fire hose. So we will, we are going about it. We have a really good program, I think, now addressing the crypto markets. So we have that underway, working with folks in administration and on the Hill. So there's, moving afoot with bills, the two bills, particularly on the Hill. So with respect to the IPO market, you will start seeing our proposals coming out. We obviously are cognizant of what's going on. There have been new rules adopted by the commission in the last couple of years regarding SPACs. Those were very rather controversial, let's say. So we'll be looking at all of those things. So you can't build Rome in overnight, but we'll be addressing that.
Is there a time or place for the SEC to say we should halt the tokenization of private companies for now until we can examine this and the impact to the markets and to investors?
Well, again, I think we have our rules. Well, we have our rules, and again, I'm looking at that as an innovative way to address the workings of the marketplace. I don't view that as a wholesale new type of product, and so I view that as beneficial to the markets, and obviously, we will be adjusting our rules.
Okay, well, Rome wasn't built in a day, and this interview isn't built in a day, or even a segment either, because we're going to take a quick pause, and we're going to come back with Paul Atkins right after this. Slip in a quick break. Don't go anywhere. Welcome back to Squawk Box this morning, right here on CNBC. We were speaking with the SEC Chairman Paul Atkins, and we're thrilled to have him at the table. I have a question because about insider trading, an issue that the SEC has always sort of oversaw, but there hasn't been a huge number of insider trading cases in recent years. I mean, not big famous ones, but there's this whole crypto industry that is not really regulated, and I'm curious what you think of that. Which is to say that there's lots of people doing things, and the reason I mention this is 3 or 4 months ago, if you remember, somebody developed a Sorkin coin, briefly, for a hot minute, worth I think a couple $100 million at some point.
Wow.
It was a
Nice.
wild thing. And what I saw happening was people were creating these Telegram and Signal accounts, and they were all talking to each other about how they were going to buy and sell. I mean, it was literally like the pools of the 1920s. It was a very interesting thing to watch. And the question, just to see how it was happening, and I was curious where you think the SEC should play in that universe.
Well, I think there has been a fair amount of regulation in that area, or regulatory activity, over the last few years, which has been also part of the problem of innovation. But getting back to it, fraud is fraud,
Right.
and the mission of the SEC is to look after investors, protect investors, but also look after capital formation and orderly and efficient markets. So those are all important aspects of our mission. So the SEC has been very active on that.
Do you have different ideas about how companies communicate with the public, though? Because for so long it was you had to put your statement on both Edgar, but really on Business Wire or something like that. And now obviously you can go on Twitter, you can do this, but people are going on podcasts. Obviously they come on places like Squawk. But how do you think about sort of broadly pushing out all of this information at the same time?
Well, so the markets live on information, obviously, and that's why inside trading comes up, very often. As far as people who have more information than others and abuse their aspect there. But as far as the access to information, that's what's so wonderful about modern markets, is that information is all over the place, but it's up to the company, up to the issuer.
What do you think about Congress? So this is going to be a bite the hand that feeds you situation. But no, I remember talking to Jay Clayton about this. I've always thought it should be the SEC who could somehow step in and start to really look at insider trading in Congress, because we've had a lot of questions about whether it's Nancy Pelosi and that family, and there's so many examples where you go to yourself, well, how is it possible that these people are trading? Do you think there should be a rule in place that makes it much more complicated or difficult, or a disclosure that doesn't exist today?
Well, a few years ago, Congress did enact a rule that's called the Stock Act.
Yep,
and so
I'm aware of it, but it doesn't seem to have shifted the balance. When you see some of the disclosures and also how well they've done, you say to yourself, how is that happening?
Well, I've seen there are all sorts of different studies as to that, whether or not there's any evidence of it. The SEC gets literally thousands and thousands of tips from all over the place, coming in, from the net and from people on outside, whistleblowers and whatnot. So obviously we take all tips seriously and look into them. So obviously I can't comment on anything, but just let's say that the SEC is very active.
I want to get back to our conversation about private companies, private credit. These are things that individual investors want to have access to. How do you view the role of the SEC in terms of products that investors want to have access to, products that investors should have access to, and what your role is? Or is it your role to put up guardrails here? Is it your role to just say all these products, as long as you disclose properly, they are available to individual investors, or there's some products that are not a good idea for individual investors, and the SEC will take a more activist standpoint?
Well, right now we are at a cusp of where we need to look at the rules and how they apply. But obviously there are standards for public disclosure, and in the private markets, because of these particular products are not publicly registered, those rules of disclosure don't necessarily apply. But the private markets have developed a lot over the last 40 years, and institutional investors and others make demands on issuers for information. So there's being kind of a leveling of the amount of information that's in both of them.
But a separate issue, private credit, which is the new, it's been done on Wall Street for, I don't know, 10 years, maybe more. But in terms of access by individual investors, that's only opening up right now. Is that an area that investors should have access to now that, some might argue here that we're in sort of the waning days of private credit, and that investors will be marketed the worst of the credits out there that aren't rated properly, that are, the dregs of what's left over that the institutions don't want.
Well, I'm afraid of that too, obviously, and so we will, as we look at the accredited investor standard and other things, we'll be cognizant of that. And as I said earlier, it's very important to have good standards as to what retail investors would be getting into.
Chairman Atkins, we are out of time. I wish we could continue this. I want to talk about semi-liquid investments, B-REIT, and some of those kind of things that people want to know. There's so much to do. Come on back, sir. Thank you.
I'd be happy to do it.
Very
Thank
much.
you very much.
Thank you.
Thank you.
Melissa, thank you. We're going to be handing it off to our friends on Squawk on the Street. They're coming up next.
Happy with it.
Good Wednesday morning. Welcome to Squawk on the Street. I'm David Faber alongside Jim Cramer. We're live from Post 9 at the New York Stock Exchange. Carl enjoying a well-deserved day off. Oh, yeah. Yes, as we all deserve them as well. Take a look at futures. I don't know. What's that say to you? Anything? Anything at all? We have a whole show to do. Yeah, we got a whole show. Exactly. That's what it says to me as well. Thanks, Jim. Our roadmap does begin with a pause for the big tech run-up. This after a surge of more than 20% over the last 3 months. The NASDAQ did notch its first decline in 6 sessions. And as you just saw, futures, well, doesn't say much anything right now, but maybe a bit of softness. We're going to talk about the big banks because they're boosting dividends, and that follows this week's stress tests. We're talking about Citi, Wells Fargo, Bank of America, among others that are also trading at record highs. And OpenAI's Sam Altman with some strong words for Meta and the company's recent talent poaching spree. That is Meta coming after a lot of OpenAI employees. And there you see it. Missionaries will beat mercenaries. Let's start, though, with the recent run-up in technology stocks. Last night on Mad Money, Jim unveiled a new acronym for 3 of the mega caps. Take a listen.
Not FANG, not Magnificent 7, just M&M's. The sole survivors of the brutal quarter from what used to be the most captivating group in the market. Yep, only 3 of the mega caps finished the first half at all-time highs. And it's worth trying to figure out how that happened. How did Microsoft, Nvidia, and Meta manage to triumph? Especially when all of their stocks had hit some pretty hideous darn levels early in the quarter.
No, all right. What's it all mean?
It was marked up. I mean, yes, it went to 158. Remember, this is just who finished at the high. I'm trying to distinguish between the companies that came in hot and then faltered, and the companies that really delivered. And look, and I think the ones that delivered, David, very interesting. Meta turned out to be cheap, as you knew. And Microsoft, where they're thinking about laying off as many as 9,000 employees in the latest round. Microsoft may be the company that uses AI the most. Or they might just say, you know what, we finished this Xbox acquisition. Why do we need it? We are seeing, David, AI...
Well, you mean the Activision, not Xbox. Yeah, you said Xbox.
Well, Activision. Well, look, I think that's not Xbox, but I do feel that there's been two waves of layoffs, May and June. They're firing employees. Now, they're firing employees and they're making the numbers. Remember, the AWS, the reason why they made the numbers was that they were able to do 33%. Previous quarter, they did 31. People were looking for 31.9.
All right, well, you're referring to a Seattle Times story in which they say the company could lay off as many as 9,000 employees. Of a 228,000 employee worldwide base, that would be roughly 3%. Right. Maybe even as much as almost 4%, they say, of the employee base. I want to get to the ADP number, though, because we usually don't talk about it this early in the show, but it was a negative 33,000 or so.
It was really wrong last time, so
it was really wrong last time. But I mentioned it in light of the market yesterday, Jim, where value showed some resurgence. Now, it may have simply been a function of the first day of a new quarter, of a new half.
Down. That's
momentum going the other way, but do you think that there is perhaps a bid for value in the market because of an expectation of, and I know I shouldn't even say this because we're not supposed to talk about it anymore, but a Fed rate cut as soon as July?
I just watched Jay Powell, Chairman Powell, say no.
Yesterday.
We have to see. Yeah.
From Central.
I mean, look, when I spoke to Andy Jassy, who, by the way, thinks the consumer is robust, not weak, Andy Jassy said, look, a lot of pull forward. We got a lot of low prices. We can't make a judgment yet. Prices are not up, despite there was a story saying that he was being hurt by inflation. The story was completely inaccurate. Now, that's not unusual. You and I know that happens. But no, it's too soon to tell. And that's why Jay is like being smart.
Okay. All right, so what do you attribute the move yesterday, which we just showed? Momentum had a bad day, value had a good day. Does that continue, or is that over and done with?
No,
and you're all about M&Ms now.
It's individual stocks. It's individual stock stories. When we see stuff like that, we can look at the individual stocks that ran up, and then we can look at the earnings that are about to start in a couple of weeks, and we'll say, well, that was dumb, that was stupid, why did I buy that stuff? So, I mean, people, it was like the Russell. Remember when the Russell was up, and people said, well,
yes,
the Russell
we're finally getting to a broader market. Yes, I do remember that, of course.
The only safety in this market is growth. So when you see a J&J up $3 and they don't have a lot of growth, I am not going to jump into that. When you see Hershey up $5 and they don't have growth, I'm not there. When you see Constellation Brands, which just got hammered in the earnings, but stock up yesterday, I'm not buying it. So let's just forget, let's just hedge fund talk. I want to talk about what people should do, not what
All right, so it's just the same story, same playbook, essentially, with an even smaller number, but nonetheless, same playbook we've been seeing for years.
Tomo Bravo's back buying stuff.
That's a small team.
Well, I'm just saying they're back buying that stuff that they like to buy.
Yeah. All right, speaking of which, Tesla's not a part, of course, of the new acronym from Jim, but they do have their delivery figures out for the second quarter, and Phil LeBeau has them for us. Phil, how they looking?
They're roughly in line with expectations, David. 384,122 vehicles delivered in the second quarter by Tesla. The consensus estimate on FactSet going into this morning was 387,000. I wouldn't call this a miss. I'd say roughly in the neighborhood of what people were expecting. We should point out the production coming in at 410, 244 vehicles. If you're looking at shares and saying, well, that's a decent little pop on shares of Tesla on these delivery numbers, keep in mind that there were a number of analysts, and I read probably 10 notes in the last couple of days. A number of those analysts were expecting the delivery number to come in closer to 355,000, maybe 360,000. So a little bit better than some of the analysts were expecting. To Tesla delivering 384,122 vehicles, just shy of the consensus estimate of 387,000. Guys, we'll send it back to you.
Yeah, and we can see the stock is reacting positively to that. Phil, yesterday it was a lot of back and forth as well between sort of us as I tried to understand. You know, we were trying to make we were trying to explain the difference between regulatory credits that Tesla has lived off of to help boost earnings in terms of greenhouse gas emissions versus the big beautiful bill, which is doing away with the tax credits that buyers get when they buy it. But on that other side, which has been so important to Tesla, I know you've done reporting on this and I've been asking you about it. Nothing has changed as of now. Is that correct?
Correct. Nothing has changed, and that is tied into the greenhouse gas emissions. If the EPA and the White House at some point make a move to make a change there, that may have huge implications for Tesla. But those zero emission vehicle credits, of which you pointed out yesterday, I think last year it was $2.4 billion, that they received money from other automakers and other companies outside of the auto industry, where those companies need those credits in order to meet greenhouse gas emission standards. They buy those credits from Tesla, from other companies. Rivian sells greenhouse gas emission credits. So that's how that stands right there, David. That's very real money to the bottom line of Tesla. But that has not changed at all. The big beautiful bill completely focused on the $7,500 credit that you or I or anybody would get for buying an electric vehicle. That's the change that's happening there. And I think that the plan, according to the Senate, the bill that was passed by the Senate, that $7,500 discount, it goes away after September 30th. Let's see if the changes now that it's back in the House, but that's where things stand right now.
All right, so Phil, do you think one of the things people are excited about is the China numbers? Shipments rise in June, first time in 2025?
I wouldn't get excited, but I would say if you're a Tesla investor, this is welcome news. I think it was 6 straight months where you had declining sales. And now that you have the Juniper models that are over there, filtering into the deliveries, it's clear that they perhaps have built a floor in there, Jim. But that market is so brutally competitive. 1 month is not enough to say, okay, well, the worst is over in China. Who knows what this is going to look like over the next couple of months? Because we really don't know if the price war is over in China when it comes to electric vehicles. And that really has been killing Tesla, killing all automakers, because what's happening there is too much capacity, building too many vehicles. So what do these automakers do in China? They slash their prices. And that's what's really killing profitability over in that market right now.
Phil, thank you. Phil LeBeau, of course, with those latest U.S. numbers from Tesla. You can see, of course, that is helping the stock.
The communists are great capitalists.
BYD's got a lot of really good automobiles. I hear it from people who obviously have exposure to those automobiles, not just in China, but in other markets around the world. Jim, I want to get back to the Microsoft story that we mentioned at the top, reported by the Seattle Times. I know our Steve Kovac, who follows the company closely, has more as well on these layoffs, which I guess follow some layoffs that occurred only a few months ago as well, Steve.
Yeah, that's right, David. So Microsoft telling me they're laying off less than 4% of their total workforce. This is a global situation, all tenures, all levels across the board. And they tell me that would be approximately 9,000 employees based on their most recent employee headcount. This, like you said, David, this is on top of the 6,000 employees that they laid off in May, so bringing the total to approximately 15,000 for this year so far. That's more than they laid off back in the beginning of 2023, when they laid off about 13,000 9,000 employees after all that overhiring during the pandemic. Let me read you a statement. They're telling me, quote, we continue to implement organizational changes necessary to best position the company and teams for success in a dynamic marketplace. Now, of course, there's another question about what role or factor does AI play in these layoffs. It doesn't seem like that's been called out specifically, but a Microsoft spokesperson did tell me that employees are going to be using these cuts to spend more time focusing on what they say is meaningful work, and this kind of stuck out to me, by leveraging new technologies and capabilities. You could read that as AI, you could read that as Copilot, you could read that as something else, but that is an interesting thing that stuck out to me here. So again, Microsoft here laying off 4% or less of employees, which would be about 9,000 employees in total, David. 15,000 for the year, David.
Right, for the 15,000 for the year. Is that normal course, though? You said, obviously, it may exceed what they did in 23, but I would assume they're always looking to, potentially cut, obviously hire in other areas as well.
Yeah, that's right. Obviously, AI is one area they're going to keep adding on to. It looks like the gaming division, the Xbox gaming division, I'm seeing some headlines across from Bloomberg and others that there's some really deep cuts going on there, including over at King, which is, of course, part of Activision that they purchased a couple years ago. And they also, just some of the language around this announcement too, David, it sounds like a lot of it is targeting middle management and people like that in order to kind of increase efficiencies. We've seen that at Meta and so many other companies. So that seems to be the real key thing here. Again, not really blaming AI or anything like we've heard Andy Jassy do.
Got it. All right, Steve, thank you, Steve Kovac.
Listen to me.
I'm listening. I always listen to you.
Remember when we all read Orwell?
It's a long. Actually, I did reread 1984. I reread that.
We get here. I mean, the whole shooting match down and out in Paris and London. One of the themes of all of this work is just that most people lie, and you lie. You pass pamphlets out in Paris. It's supposed to be like meaningful work. Okay, here's something that I'm tired of. I'm tired of hearing that people are moving to more meaningful work. Were they doing meaningless work? In Orwellian terms, what we're saying is, this may be nonsense. This whole AI, we bring in AI, they were doing what? And now they're doing what? They were doing meaningless work and now they're doing meaningful work? No, either they were doing Soviet work, we pretend to work and you pretend to pay, or I would contend that it's all nonsense. And it's just a way to fire people. And if you're Andy Jassy, you're not bringing in more people, you're bringing in more robots. If you're these companies, they have too many people.
Right. I mean, in the case of Amazon, we're talking largely about distribution centers and physical work, whereas with Microsoft, we're talking about middle managers and...
Right. I mean, the typical interview that we have, that everybody has is, well, how much of these layoffs are AI? Well, 1,420. Well, why is that? We see what we're doing is we're shifting people from meaningless work to meaningful. We have to break through Orwell, okay? And we have to just say, these companies have too many people and trying to make the quarter. It's no different from what we used to see from other companies.
Right.
I'm not talking U.S. Steel. I'm saying they have too many people.
As we'd expect, right.
They didn't do AI. What AI?
On a much smaller level, we got
because of AI. Come on.
Carl's not here because he's on vacation. Right. Don't get anybody concerned.
No, I'm saying that we have to break out of the Orwellian fixation that the reason why they're laying people off is because of AI. They're laying people off because they got too many people and they want to make the damn number.
Yeah, exactly. Same reason.
They want to make the number.
Same reason on a small level, Warner Music.
They got to make the number.
Is going to cut jobs
to
slash costs by $300 million.
Those people are less equal than others.
Understood. Speaking of AI. The back and forth between your friend Mr. Zuckerberg and Sam Altman has gotten fairly interesting. It is a talent war. It is a talent war. And if you missed it, Altman in a Slack conversation, I guess, with some of the employees says, they've gotten a few great people for sure, but on the whole, it's hard to overstate how much they didn't get their top people and had to go quite far down their list. They've been trying to recruit people for a super long time. There's that. All these people, they add super to everything. And I've lost track of how many people from here they've tried to be, that they've tried to get to be their chief scientists. I'm proud of how mission-oriented our industry is as a whole. Of course, there will always be some mercenaries.
Mercenaries.
Yes.
I mean, it's free agency. It's like the NBA. I mean, what is he talking about all? Does he understand sports at all?
I have no idea for him whether he has a affection for sports the way that you and I do.
It's like Steinbrenner in the old days.
Well, right? Altman wants to win too, and he's incredibly competitive as well.
Open the wallet, you win.
Harder, perhaps, for OpenAI. I mean, OpenAI has significant resources as well that it can draw on. But one thing it doesn't have right now is a publicly traded stock. Certainly, it won't have for quite some time. In fact, it's in the midst of a very complicated change in its entire capital structure as well.
There are stars, okay? Stars can command a multiple.
I'll tell you, the one I come back to is this Alexander Wang, who's running the entire effort there. Scale AI. They valued it at $14 billion. They bought 49% of it. Meta. That whole thing is, wow. I mean, he took $3 billion out, but he left Scale AI to sort of fend for itself. Then it lost Alphabet and it lost a number of its customers. Now Meta's apparently potentially going to make that up for Scale AI. Right. Meanwhile, let's find out how much they're giving him in stock. A Meta stock as well, not just paying for his company.
Is he a mercenary?
Was he worth? How many billions was one man worth there?
The Legion versus the
He was worth more than Vikram Pandit. Remember that one? Where they bought his hedge fund?
City's increase in dividend.
So we're going to come back to the banks. Actually, let's do that. Let's take a break. We want to take a break?
AI says we should take a break.
Yeah, let's take a break. Take a look at
AI
futures.
says the Phillies should
We'll come back on the other side if we have time.
AI's a spreadsheet.
We got a mad dash. I'll just keep talking. He'll keep talking, but we won't be talking to each other. More Squawk on the Street straight ahead.
To the
All right, welcome back. Nation's biggest banks hiking dividends, announcing some buybacks as well. This after they all passed the Federal Reserve's most recent stress test. Goldman Sachs raises its dividend by 33%. Morgan Stanley and JP Morgan also raised dividends. They also authorized new stock buybacks. Bank of America, Citi, Wells Fargo, they also boost their shareholder returns, largely through dividend increases, Jim. I had a quick cheat sheet, but of course I'm a washing paper. I can't find it right in front of me here. Here it is. Not unexpected though. We talked about the stress test the other day. You like this sector though?
Oh, I love this sector. This sector has what I call mojo. All right, that's a technical term. Bank of America with 7.7. Well, let's look at the dividends. It's 2.33. Citi $2.40. Well, I don't know. I mean, 2.78. Goldman with that big 33%, they're still 2.26. JP Morgan, we know that they did the buyback too. They're 2.07. And how about this, David? Morgan Stanley, 2.84.
2.84
for you.
Percent yield. $1 a share is the dividend.
Yeah, I like
There's
that.
Goldman stock price.
And then Wells does 12.5. Wells had all these problems, and they got the uncapped sharp speeding very
Wells
aggressive.
is on a roll now,
Yeah,
right? In
and
many ways, in terms of at least. I mean, the
I
stress
think
test now
Wells
behind
is-
it, the cap behind it.
He
It's
can do it everywhere. The world's his oyster. Sharp.
Charlie Scharf, yeah.
World's his oyster.
Is that still your favorite of this group, or not really? Or you don't have a
I
favorite?
have to go with the Golden Slacks. I got to go here with Solomon. I mean, Solomon is a very aggressive guy, and he's putting a lot of money in. And I'm waiting. Look, David, there's an IPO every Figma. There's an IPO almost every day now, and we got some M&A coming. I mean, I got to tell you, I think Goldman's in good shape. Morgan Stanley's got the most, let's say, the even revenue stream, so it's going to give you the highest multiple. Maybe that goes to 18.
Yeah, advisory wealth
Maybe that
management,
goes to
obviously,
18
very
times
important
earnings.
part of their franchise.
Wealth management is
Still,
king.
IPO is still
Schwab
important to
is
them.
6 times.
Say again?
Schwab, because its wealth management is incredibly highly valued.
Highly valued.
Oh yeah, Schwab.
Yeah, that's that. Yeah.
Who makes more money, Larry Fink or Steve Schwarzman?
Wait, that's BlackRock and Blackstone. Why do you? What does that have to do with Schwab? Nothing.
I don't know, I just kind of like it.
It just popped into your head.
Yeah, it actually,
Steven
for a moment,
Schwarzman
it
is a
did.
lot richer than Larry Fink.
Yeah,
a lot richer.
And how
so
about
much richer. And by the way, huge foundation. I don't think people realize the Schwarzman Foundation. I've been talking how much what they've got and what they've got here in the U.S. and how large it is.
High. I won at Abington High and everything I played. Now it's Schwarzman Stadium. There the galloping ghost when I crushed
Got a lot of money to give
now
away.
Schwarzman Stadium. Who names a public high school? It's pretty not bad. David, we have so much to talk about.
So much. And you know what? We're going to take a break and let you think about your mad dash.
Oh, yeah.
Then we're going to come back and
I'm
talk.
paying an homage to Catalonia in my mad dash.
We're going to talk about all of it. You're going to pay an homage to Catalonia.
Yeah,
okay. Great. I look forward to that. Would you like another look at futures? You would. Okay. Take a look. There it is. We're going to be down a little bit when Squawk on the Street returns. welcome back. Let's get to a mad dash, and we'll also get an opening bell a few minutes from now.
Let's talk capitalism. Last week I had Air Environment on the show on Maryland. I came out the next day and said, look, I think this is a pretty good situation. It was on the mad dash.
I remember it.
Stock jumped to $100. Well, this morning, there's 3.53 million shares secondary, priced at 248. Remember, what they have is an anti-drone. As you saw, Ukraine, it's not clear about what weapons are going to them. But I would point out that an anti-drone is probably the most inexpensive way to win a war, and I do hope that we do that. Wahid Nawabi is the man who has got the suite of products that includes the anti-drone, and the anti-drone is just dollars.
If there's anything we've learned from the recent conflicts, of course the one that's been going on in Ukraine for years and the recent one between Iran and Israel, it's the importance of drones and how much they are beginning to dominate combat to a certain extent.
And you can't have $60,000 drones. That had been the way of the United States. Palantir's fighting that, obviously. Palantir stock is turning here. But Air Environment has weapons that actually, for dollars, shoot these things down. So you have a $500 drone, well, boom, I'll hit you with a $1 laser pulse.
And Ukraine they're both, in terms of combating drones and building their own, they're kind of, they're creating an industry, by the way. Even when they ever actually are at peace, they may have an opportunity to build something there.
You should be on Ukraine's side, if only just to see how the new battles work.
Well, the president has stopped the latest shipment of Patriot missiles for Ukraine to defend itself.
I know that RTX has done a remarkable job with the Patriot missile to be able to defend Ukraine, and I think that they should. But my politics don't matter, but I would say that if you want to know how to fight in the new world, just back Ukraine. Because back in Russia doesn't make sense. This is not 1941.
I think many people would agree with you.
Right.
Many people would agree with you.
It's not
no.
See that.
All right, we got like a minute until we get an opening bell. You know what I'm going to do? I'm going to surprise you. Go back in the Wayback Machine and ask you what the key to this market is, which I always love.
The key to this market.
It's, just another way to. Yeah,
I think.
You got one?
Yes. Centene.
Oh, that's not good.
When Michael Neidorff the late Michael Neidorff ran Centene, he did it in a way where he had, I would say, the lowest cost, but best care, because that's what he was about, for Medicaid. Now, there are some stories today. Centene made a point that there's worse morbidity in the exchange market. But what is this really about? I think this is about the new Medicaid. What about guidance? Because Medicaid, I think that I don't want to be too, political, but Medicaid is the loser in this bill. And that's what Centene's about.
Jim, we're going to talk more about Centene because it is going to be the biggest loser out there today. Let's get to the opening bell right now. Here's the big board. Keep going, everybody. All right, the Pan Math Challenge. A bike-a-thon in Massachusetts.
Okay.
Investment management celebrating.
Well, right to support. Whatever it was. 616.37.
100% of it, donations go directly to cancer research. It is a 190-mile race over 2 days from Boston to the tip of Cape.
Goodbye. /ES has had a good pullback. So we could have a breakout today. Today's Wednesday, I think. I've had a runny nose all morning. I usually don't complain about it, but God. So short week coming up. little snake breakout. Still hasn't broke past the 63. If it does, we go higher. On /ES on the 2-minute. 25, 62, 54.05. I'm watching them right now. Okie dokie. Get ready. It is now getting ready. Right about now. SPX. July 2nd. The 6210. See if I get $3. Looks like a good setup to me. About now. It's there. It's there. Strike is 6210. $3.30. $390. Back to the top. Well, we pulled back here. Let's see if we hold. I got these SPX calls right now. There she goes, baby. Yeah. 440. I'll take it. Jimmy said we were going to break out. We did it. I got one holder. Man, I'm really... Beautiful. question is, can we break it? Holding support. Kind of squeezing right now.
When you buy certified pre-owned with Ford Blue Advantage, you get
Yip-a-dibba-doo. The 60-20, the 6210s. We're back to my 450 area. Then we got the 200 SMA coming up. I'll be right back. Get my chai. Oak. Here we go, 480. 510. Do 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 do. Going higher. We are now at 490.
Go and just get extended, maybe. That's certainly a possibility. So that's obviously next week, the big thing on the market. And tomorrow we get this jobs number. And, you know, if ADP is any kind of precursor to what we're going to see tomorrow, that certainly is going to be more fuel to fire for the Fed to consider lowering rates. But historically, ADP and non-farm payrolls have not been so aligned.
Oh.
Understood. I mean, just a final thought too. As the Fed now, is there more likelihood of
You really understand?
I know we have to wait on the non-farm payrolls too, but with this ADP miss, the first decline since 2023, March of 2023, they're saying maybe July has more of a chance of a cut.
Still in these here.
I think the safe bet in what the market is really pricing in is September. There is a slight uptick for a possibility in July, but even if we get a weak NFP number tomorrow, we would have to see continued
I had a real bad runny nose
over the next several weeks for the Fed to do anything in July. But right now, September is 90+% probability of a cut.
Okay. Scott Bauer, CEO of Prosper Trading Academy. Thank you, Scott. Good to see you. Thanks.
Thank you, Nicole.
Coming up, how are you feeling? Because we're going to talk markets and investor sentiment. The major indices are near all-time highs, but at least one survey is not so high. In fact, sort of cautious. We'll explain. Morning Shade Live. We'll be right back.
Oh yeah. Oh yeah. Oh yeah. It's time. Now it's been 46 minutes since the market opened. Been kind of slow. I have one contract of the SPX, and that's all I have. Right now they're at 480, 490. The resistance will be this double top up here, 10-4. And I'm gonna go spot on with the number. $62.08.32. Give me grand. Give me grand. There's 510. Give me a grand. 620832. Give me.
Is now
That's been the way it's all night. I've been sneezing like it all night.
Ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time learning. Trade brilliantly with Schwab.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Hey, Dad. I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The two grandchildren, planning for their college educations. Someday it'll be their turn.
I doubt it.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization.
Holy Tesla.
And track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to Morning Trade Live. We want to focus on markets and investor sentiment. Joining me right now, David Goodsell,
Very
Executive
serious spot.
Natixis Center for Investing Insights. And the question is, how enthusiastic or not so much are investors and the cautiousness they may be feeling? And, you know, we talk about the markets and then we talk about regular folks. What are some of the findings that you're seeing now?
Well, I think it's interesting we're seeing diminished expectations among investors right now. If we look at things this year, folks are telling us they expect 12.6% returns above inflation for their long-term returns. While that sounds really high, it's actually about 20% lower than what we saw our last survey in 2023, which was about 15.6%. Now, every time we do a survey, we ask investors and advisors, kind of what they expect and what's realistic. In 2023, that gap between expectations and realistic was 123%. Now it's down to 76%. So a substantial change in how people are feeling.
So what they are expecting is some returns, but just less so. At this point now, why are they feeling that way? Why are they feeling more cautious, do they say?
Well, I think the number one concern they have is inflation. In fact, when we ask them what their top investment concerns are and their top financial fears, it comes out as inflation.
Shit.
And
people don't make sense anymore.
About 2 cuts, I think people are really anxious about that happening and feeling like inflation's behind us.
They really don't.
About 26% of people think inflation is behind us, and the majority of people thinking it's still a very much day-to-day experience for them. One of the things we do see because of inflation, about 60% of people told us
it is a day-to-day experience. A lot of us didn't get, wasn't on the list of the billionaires during the Biden regime, but we took it out of their hands. Okay, here we go now. I held on to them. They're at 520 to it. Jimmy says we might see 6208.32. Any questions? And where's Funk? We're now at $5.10. Can we break out to $6.20, $7, maybe $8? He's still in the SPX. He's watching it close. Watching it real close. Boom, baby. $5.30. Woo, there it is. $5.50. Now he's clean. I have hard speaking English. They hung up on me. Why did she hang up on me? Ooh, $6.90. Jimmy said. Jimmy said it. I said it, and I sold my last one. Yes, I did. Yes, I did. Yes, I did. Ooh. Yes, I did, yeah. $7. $7.70. Carl's Way is next to the best way. Funky, where are you today? What'd you think about that, Richard? There now it's $7.30. $8.30. Mm-hmm. Yeah. Yeah, I heard Hood was getting upgraded. Jimmy said we're going higher. Nobody believed me. We almost hit 100. Hood almost hit 100. Let's see. Whoa. Okay. Always clean. This is James. May I help you?
Hello.
Yeah.
Hi, good morning. This is Olivia from State Benefit Group. The state is updating Medicare plans for special enrollment 2025. I am here to check if there's anything missing in your plan. Before we go any further, I just need to verify that you currently have both Part A and Part B of Medicare, right?
Not yet, baby. Well, they're getting smarter. I wonder what the odds of me getting a date with one of these AI callers. Hello, did you hang up on me? That was kind of rude. It was very rude. I don't know if that was uncalled for or what. Do you have any clue who I am? I need to get paper towels, remind me. Okay, we're at $8.40. I like your little dress you have on today, girl. Little farmer's daughter outfit, huh? Yes, it's me in my farmer's daughter outfit. Yeah, this one would have been a kind of a tough one to call, maybe. Okay, here we go. New high. SPX. Yay! $9.30. $9.50. Whoa. Hello? I'm just curious if there's anybody still anyone's holding one of them at least. Rob? Funky, where are you? $9.30. Some people out there think that Jim can get $1,000 out of this. So does that previous 6208.32 now become support? Yes. We might move it to the 21 EMA. Here we go. We're going to find out. What you gonna do? What you gonna do when they come for you? Holding up the 9. Oop, there's my 990. $9.90. Boom, baby. I think I rest my case. What do you think about that? The crowd's going wild here at the sports arena. If you're following Washboardjim here with the SPX, you just took it from $3.30 to one $10 bill. Now, I'd love to have had Funky notice that, but I can't get a hold of him. I have to tell you who I have a crush on, though. Her name's Little Red Heidi Wood. That girl right there. Can we go fishing together? Is he? We got the $10, man. Richard. I love you. Miss Reddy. Heidi Wood. So is Diddy going to be found guilty? Oh, look at here. Jim just sold it too. Come on, baby. The 62 tens. He's got them back on watch here. And we could drop these down to 62 20s. Kind of missed that turn. There it is. 650. The 62 tens. 62 tens. There it is. And we're getting there. $5.70. We got one. The 62 tens at $5.70. Well, McDonald had a farm, me-I-me-I-O. And on this farm he had some rubber bands. Me-I-me-I-O. The crowd's going wild here at the sports arena right now. So does anybody believe that Diddy will go to prison? Well, I never hung around with Diddy. Not once did he invite me to any of his fling parties. I don't know if I appreciate him or not anyway. Him and I would probably wouldn't have gotten along very well. I have a feeling I'd have to stand with the mob instead of that Diddy the slob. He was found guilty on 2 charges. 5 years. Something sounds awful funny. Okay. We are wanting to see this thing bounce. My name's Washboardjim. Oh boy, these things are now at $8.40. What do you think about that, my Bardo? $8.40. Uh-oh. Uh-oh. $9.20. Uh-oh. Uh-oh. How's he do that? They're now at $8.80. It's a $300 trade. They're trying to make a business decision here if he wants to sell his trade now. We are now at $9.20. I think I could do that. But you know, if I got $9.70, that would be $400 trade. There it is, $9.70. Ladies and gentlemen, citizens arrest. He just now made it to $9.90. What the heck just happened here? Can anybody say $10? What just happened? Or Barto, what just happened? Be sure to tell a family member that you love me today. Be sure to tell your wife that you love me today. Or have your wife tell me that she loves me. Bobby Shore says, nice trade. I'll be right back. We just made a new high. I've got the sniffles. I'm not feeling good today. I haven't felt good in a while. But I thought I had something real serious wrong with me, but it wasn't. I'll know when I get my blood test back now. La-da-dum. See how much of a gift that was? That little pullback. That's what you got to do too, is a strategy. Just sit here and watch your stocks and wait and wait and wait and wait and wait and wait for that big knife. This one was perfect. Right to the 63 on the 1 minute. I should have got two of them. That's what I should have done. You understand? Someone say yes. Look at the video. Damn. Toughie. It's now 10:57. Could be lunch. Yeah. I'm seeing things now. This AI is going to be the camel knife. Oh my God, a skunk. I'd have to say that was a pretty good one. Very good one. Okay, we're patiently waiting again for another setup. You sit and watch the same stock every single day. Let's say today I wanted to trade NVIDIA. To 21, 21, 21. New high, new high, new high, new high.
Vietnam, details to follow. Again, that is a quote from True Social. So during the last hour, you did see the S&P 500 rise. So investors continue to pay attention to what we get on the trade front. In terms of sectors in the S&P 500, you have information technology leading again. We've seen some losing ground yesterday in tech and consumer discretionary. Today you have some regaining of some ground there. Materials are higher right now. Over the NASDAQ 100, you are seeing a gain there, up more than 0.5%. Meantime, the Dow is flat at the moment. Keep in mind the Dow was the winner yesterday to kick off a new month, a new quarter, a new second half of the year. Small caps right now gaining more ground. Small caps, the star of the show at the moment. You're looking at the Russell 2000 up by just shy of 0.75% there. Let's take a look at some of the other asset class action. You're looking at the yield on the 10-year Treasury up by 4 basis points. Dollar firming up a little bit, but still it's around these 3-year lows that we've been watching. Dollar hasn't been participating in a lot of the strength that we've seen. Dollar up just 0.25% right now. Gold a little bit higher, up a little bit more than 0.1%. West Texas Intermediate crude oil higher by just shy of 0.5%, but still holding around that $65 a barrel level. That's the level that we've seen before the volatility around geopolitical tensions. It's gone back to that level now and seems pretty sticky around there. Bitcoin moving higher right now, up just shy of 3%. Above 108,000. Will it get back to 110? We'll certainly be on the lookout for that. For a look at some of the top moving stock action or top moving stocks in today's market, I'm joined by Alex Coffey, senior equities contributor and co-host of Next Gen here on Schwab Network. All right, let's talk about a member of the Mag 7 here. We've got Microsoft in focus. There are some reports of job cuts, and jobs are obviously in focus today because that initially threw cold water on the markets with the ADP numbers today. But what's the latest with Microsoft, Alex?
Yeah, good morning, Diane. Microsoft, through a CNBC report and then a subsequent Bloomberg report, we got some details, is expected to lay off 9,000 employees, according to CNBC. This will affect less than 4% of the total global workforce across different teams, geographies, and levels of experience. They say that they continue to implement organizational changes necessary to best position the company and teams for success in a dynamic marketplace. This is a Microsoft spokesperson who said this in an email to CNBC. They had also, of course, announced in May that they were looking to lay off around 6,000 people. Now, later on, we got from Bloomberg an expectation that there will be deep cuts across its Xbox unit. This is also its King division as well, which makes Candy Crush, expecting to lay off 10% of that staff, for about 200 jobs. So when you see it, we're getting more and more of these details. Initially, Microsoft was under a little bit of pressure, Diane, but as the market recovered post ADP, post Tesla deliveries, and post the opening bell, Microsoft has also gotten back above the unchanged line. It is very, very quiet in its trade thus far, though.
Yeah, look, I mean, it's quieter here, more quiet here on Wall Street today. Look, we're in that holiday season period. It feels like, you know, the market's just also looking for clarity on the trade front. When it comes to Microsoft, you also had Dan Ives talking about Microsoft earlier this week, and NVIDIA saying those are on track to join this $4 trillion club. So it feels like with this move, this feels like kind of like normal cyclical hiring and not a problem for Microsoft. Is there anything else you're noticing around Microsoft?
Yeah, I think there's a little bit of that for sure. Obviously, one of the things that AI is likely to do as well is going to really provide efficiencies for many of these businesses, and staff cuts are probably to be expected, at least at some points. Different types of jobs may be created, but some jobs may be found to be redundant. I don't know that this is related to that necessarily. One of the things I saw was also talking about kind of trying to eliminate like the vertical structure of the organization, trying to bring contributors closer to the leaders of the company. So flattening the organization, eliminating middle management, which can make sense, especially if you're trying to, you know, lower labor costs, but also increase productivity. So something to watch for sure. It definitely, alongside the ADP report going into jobs tomorrow, is just another example of, hey, we're seeing companies cut jobs, not necessarily hire. Yeah, it's not major job cuts, but, you know, somewhere around 4% of the workforce, still significant.
Yes, indeed. So notable, but potentially just kind of a cycle. And we see that with some of these companies, just as you mentioned, just a flattening out of the structure. Thank you, Alex. That's Alex Coffey, Senior Equities Contributor. All right, let's get some insights on the news that's shaping markets. For that, we want to welcome in Aaron Brockman, a wealth manager and executive managing director, Washington Wealth Group at Stewart Partners. Aaron, thank you so much for joining us today. So you may have caught this. President Trump had posted on Truth Social about a trade deal with Vietnam, saying details to follow. Now, I can't pinpoint the exact time where we saw the S&P 500 start to gain a little bit of bid, because at the same time you have the cross current of worries about the job market at play. When you think about the focus of the market and the catalyst here, do you think it's kind of a dual-pronged trade policy and what's happening in the economic picture?
I think so. I mean, it could also be something completely different, right? And I say that sort of tongue-in-cheek, but there's a lot of noise that's coming out of the White House, right? And there's a lot of noise that's coming out from a lot of the data points recently. And, you know, one of the things that we see is there's a lot of difficulty interpreting that data. And, you know, we're trying to figure out what it might mean in the short term, and sometimes it's taken our eye off of what it actually means in the long term, right? Which is that no one can seem to understand which way the data is pointing, and that probably means that the economy is in a good spot overall.
So given that the economy is potentially in a good spot overall, what's your reaction to the ADP number showing a loss of more than 30,000 jobs? Now, obviously, now it's not, they don't typically run in lockstep now, the ADP and the NFP print, compared to years past. So what's your reaction to the numbers that we got today?
Yeah, look, I mean, it looks ugly, right? But it's one small data point. And so what I ask is, like, what does one ugly number mean in the greater context of things? And so what I think about is more is what is the Fed, or what is Jay Powell really looking at ultimately?
Oh, you idiots have been watching this guy for 3 years.
How is that?
He doesn't know.
Fed policy. And I'm not sure that the one number might, in a sense, impact Fed policy, but you know, certainly doesn't look very good.
So speaking of Fed policy, many market participants are anticipating a couple rate cuts this year. Does that line up with what your expectations?
Nope.
Yeah, it's certainly possible. I would say that Jay Powell has done a tremendous job overall, and I know that the White House might not necessarily think so, but when no one is really happy with the Fed, or no one knows exactly what they're going to do, it probably means that they're doing exactly the right thing. You know,
I disagree.
It's entirely possible that we will see it, but I would rate cuts. But I would say that I applaud the Fed for sort of waiting, because
I disagree.
We had the largest tariff announcement in decades, and now, just as any prudent decision maker would say, is like, hey, let's wait and see what the effects are of that before we make any sort of rash decision. So I'll be curious to see what happens with the White House and with some of these trade deals, as well as the legislation currently, the big beautiful bill, see if it passes.
And Aaron, then let me ask you this, because you're not the first person I've heard who says the Fed has actually, or is doing the right thing, but the voices are loud on the side saying that the Fed is too late, or is potentially going to be too late. So is your view, and there are calls for a cut to occur in July, is your view that a cut will happen later rather than sooner?
I think so, later, right? I mean, think about where we are from an inflation perspective, right? Inflation is, you know, mostly under control at this point. And, you know, look, the employment sector, you know, the unemployment rate is still pretty low. And so the questions I have to the people that are saying that the Fed should cut rates sooner, it's like, do we really want to use up, I mean, that's one of the most effective tools for fighting a recession. Do we want to really use those tools now when the economy is sort of firing on all cylinders? It seems kind of silly to do that right now without getting a little bit more data that shows a discernible trend.
Aaron, Aaron, how should investors think about risk now in the second half of the year?
Yeah, I think that's a great question. I mean, right now, if you're investing in public equities or publicly traded like fixed income, you are inherently taking more risk than you were several years ago. And, we're always looking for opportunities. And, like when you look at valuations in the market, I mean, we're 15% away from, using the cyclically adjusted PE ratio, we're 15% away from peak valuations of the tech bubble, right? Which is, we had not seen before in recorded history. So one of the things that we look at and recommend to all investors is like, where are you taking risk? And it's actually really cheap and inexpensive to hedge your portfolio now. You don't want to be hedging your portfolio after, some of the craziness of Liberation Day. You want to be hedging your portfolio now when the market is near an all-time high. That doesn't mean stick your head in the sand. There's a number of tools that you can utilize to hedge both equities and fixed income without exiting the marketplace.
Aaron, I just want to ask a quick follow-up question then. What's one contrarian idea or one thing that you feel like investors are missing or is not being talked about enough?
I think that interest rates could go to 6% for here, right? And if you are buying fixed income investments, I mean, you are inherently taking a lot of credit risk. Credit spreads have almost never been tighter, and you're taking a decent amount of interest rate risk. There's a lot of market neutral type strategies, global macro strategies, where you can in fact get fixed income like returns, but not take credit or interest rate risk. And we've been using those strategies for a decade. Interest rates should not, interest rates should be about where they are, right? Like they should never have been at 2+%, for the last, from 2009 to 22.
Well, I'm sure some people like those low levels for certain purposes. All right, Aaron, we'll leave our conversation there. That's Aaron Brockman, Wealth Manager and Executive Managing Director, Washington Wealth Group and Steward Partners. Our thanks to Aaron. Got a lot more to come next on Trading 360. It's the big three coming up. 3 stocks, 3 charts, 3 trades. Rick Ducat goes through the technicals, and Don Kaufman, a field trade, joins us on his list. Oklo, Meta, and the Japan ETF EWJ. That's next on Trading 360 here on Schwab Network.
Okay, we're pulled back to support. We have a triple top. Just a few seconds off.
He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing,
1 p.m. Eastern, only on the Schwab Network.
Welcome back to Trading 360. I'm Diane King Hall. Time now for the big three. 3 stocks, 3 charts, 3 trades. Rick Duquette will take us through the charts, and here to take us through the trades is Don Kaufman, co-founder of Theo Trade. It's great to see you, both of you. Don, let's start out with your first trade on your list. You've got Oklo on your list. That thing has gone nuclear this year, up more than 100% year-to-date. Year-over-year basis up, what is it, more than 500%? So tell us your views on this one.
Yeah.
Yeah, there's a whole lot of hope, a whole lot of dreams here, predicated on what is right now, a $7+ billion market cap, and yet to produce a product. Look, there's only so far that you can take an underlying, predicated on who's investing in it. And in this case, it happens to be Sam Altman. So, look, I'm just going with the trend right now, and I waited very patiently in this underlying for it to sell from 70 down to 50. I think that the 50 level is an absolutely critical level. If it crosses through it, it's got a long road to the downside. As such, well, I'm going to give myself a little time on this one. I'm going to go out to the September 19th expiration. I'm going to be buying 45 put and selling a 35 put, like a $10 wide spread. A $50 product is huge. This one's done for a $3.55 debit, but again, all kinds of time to see some sell side activity and an underlying that is an overcooked, fission reactor.
Okay, all right, Rick, you're up next. Take us through what you're noticing about the chart here for Oklo.
Yeah, a bit of trouble hanging out above this key level, 55.50 here, this red line. That was roughly where we had our best close. It was once again resistance. Then we had our huge breakout to the upside, culminating with those highs, 73.55. Now we have retreated once again. That boundary was supportive many times before it was eventually breached, in tandem with our yellow 21-day exponential moving average near 54.30. So two important levels were broken through. Now traders may have their sights set on this point here. That was the low point after we had a gap up. That comes in right around 43.63, 44.59 as well as our orange 63-day EMA. So we have another similar confluence of potential support a bit to the downside here. Really lines up fairly well with the strike prices that Don was mentioning here, these areas. So about 45 to 35 would be roughly kind of this box, looking for price to stabilize around that 35 level where we saw some consolidation after earnings. For now, though, trending downward, trend line off those highs is still in play here. We did see some very heavy volume a couple times during this run up, but now we're seeing another volume spike as price declines. Notice as well we saw bearish divergence on the RSI, price made new closing highs. RSI trended lower and has now sank below that overbought area, now even breaching that 50 midline that separates bullish from bearish momentum. So just also to consider volume profile, we can see that where we are now, we're in jeopardy of losing this heavy trading area. That would be roughly, once again, that 50 area that Don mentioned as a key threshold here. So as I said, support around 44.45, resistance around 55.50.
Okay, support around 44.45 and resistance around, what was that again, 50?
55.50.
55.50. Okay, Don, I'll give the floor to you for a final thought on this one. I know, look, you make a good point about this is a very kind of futuristic view when it comes to Oklo. You know, they need some dollars, some meat on the bone, but they do have that Air Force contract. Any final thoughts you want to leave us with on that before we move on to your next trade?
No, you're exactly right. So they have a contract over here, but they're not going to have a product probably for 18 months to 2 years that's actually ready to go. And I think it's at some point, this is not investors. This is traders really driving this. And I think traders are actually running out of some steam. We see some sell side activity here in the near term. It doesn't mean that, you know, the goose is cooked for this underlying, you know, long term. Just in the near term, I think we've seen it again overheated and ripe for a pullback.
Okay, all right, Don. So let's talk about the next trade on your list. Member of the Mag 7, not as parabolic as Oklo, but it's been the outperformer in the group. So where do you go next with this?
Yeah, so Meta. Wow, you know, I have just been needing to talk about a bearish trade in this underlying, and I've had to wait a very, very long time to do so. So Meta finally kind of spun around in the last 2 trading sessions. And I do believe we're going to see some more sell side activity in here. So a degree of divergence.
NVIDIA's at to 63.
We could actually see specifically yesterday some sell side activity and a handful of some of the Mag 7 rotating into some of the Dow stocks. Look for some follow through. Again, what I term a divergence in the force. So with Meta, I'm going to go a little shorter duration here. Look, I'm not massively bearish to the point where there's going to be
bearish on
sell
this
side activity. All I'm going to do is a July 18th spread. I'm just going to buy the 707.50 puts and sell the 705 puts. It's just a $2.50, put spread in this behemoth $700 product. This one's done for 85 cents. All I'm really looking for here is, again, this divergence to kind of grip hold, nice little pullback.
I gotta figure out what he's doing.
And look, I just want out profitably and move on.
Okay, and then Rick, then what are you noticing about the chart patterns for Meta?
A technical read on this chart would suggest some potential bearish signals to take note of. Certainly not a recommendation or a guarantee, but I can't help but notice that we had our high point back here at this pink line, 740.91. Even though we did make intraday highs beyond that level, we did not make a higher close. Notice as well that we had a set of highs here, and then here, RSI showed bearish divergence once again here. Despite rising into that overbought area a second time, it did not make a matching high on the RSI. Now we are falling out of that overbought area once again here, so another kind of more bearish signal here. 705 was a level I took note of as well. That's our red line here. That's our high points after we had a bit of a drop downward and then a subsequent ceiling. Then it was a supportive area as well. In the short term, that stands out to me because it's also in confluence with our white trend line here going up across the lows after we had our earnings gap up. So that was beginning with our low point that we had after our earnings gap to the upside here. So a bit of a uncertain picture right now here as we digest this name that's still near the highs, to be sure. Momentum still favoring the bulls here, but declining. The pace of the gains is slowing here. So if we were to assess our other studies that we look at, volume profile, standard deviation channel, for one thing, the +1 standard deviation channel is roughly where we got stuck yesterday, right around those old highs. So 740 or so is a resistance area to take note of. We can also see that the general area we were talking about earlier, 700 to 705, heavy volume node, and our 21-day EMA could make that a convenient supportive area to keep an eye on there. But eventually, though, 681, these low points that we saw during our area where we hit some lows here, that would be one more line in the sand for it to really watch out for, around 680, 681.
Okay, so what stands out to me that Rick just said, Don, is the momentum still favoring the bulls. Do you have any final things that you want to say in terms of, especially when you think about risk? And you said you had to wait a while to find a point to put on this trade.
Yeah, you know what? So I actually respect and actually agree wholeheartedly with Rick. But as a trader, I like to be kind of the first one over that wall on some of these bearish trades. And we're at this point in time right now where you're looking at a number of different charts, a number of different products over here, and bullish or not, you have to be thinking to yourself like, wow, there has to be a pullback at some point here in the near future. We just have not seen that kind of price action. I'm going to hop on board with this latest divergence. Look for that pullback here in the near term.
Okay, and let's talk about the last one on your list. The ticker is EWJ. When I first saw this coming in, I was like, what is this, Newark Airport? Because at first I saw the E and the W. But this is the iShares Japan ETF. Tell me a little bit about your viewpoint on this. Educate us on this one.
First of all, I agree wholeheartedly on the Newark Airport. You got to be bearish on that all day long. But I am equally as bearish right now on the EWJ, which is, again, it is the Japanese ETF. Right now, look, we have a July 9th deadline coming up. And, obviously a lot of traders are still talking about taco, which is Trump always chickens out. In this particular case,
good again.
Going to. And I think there's going to be some negative implications in just the next couple of weeks, specifically to Japan. The negotiations right now have kind of stalled out. I know that we're actually hearing some other deals are actually coming through, specifically Vietnam this morning. But Japan looks like it's going to be a little bit of a holdout, and I'm willing to actually sustain a little risk in this one. So whether this is going to play out, in the next week or the next few weeks, well, I picked the August 15th expiration. I wanted to give myself enough time for this trade to play out. So August 15 expiration. I'm going to buy the 75 put. I'm going to sell the 70 puts, $5 wide put spread. This one's done for a $1.15 debit. I'm bearish pretty much across the board today, but in this one, this is tariffs, and this is where I think that the marketplace as a whole right now, the S&Ps, may be kind of underpricing some of the risk inherent in this marketplace.
Okay, all right. Rick, let's take a look at this chart and tell us what you're noticing about the patterns in this chart.
Yeah, here's another one that had a bit of a pop recently, and it may have looked pretty promising at first, because if you were to look over the history of this chart, I mean, it's a very obvious ceiling that we saw at our green line here near the 72 level. So you can see that we did have a bit of consolidation. In terms of closing prices recently, for the most part, price held on. We did have a little bit of a dip below that solidified at our orange 63-day EMA before rallying and taking out those old highs, making a new high close as well. But now things have faltered a little bit. We have moved back down below those previous highs near 75. And for perspective, too, 75 to 70 is right about this area which Don was talking about, looking for a retreat back to our purple 252-day EMA just below that 70 mark here. Along the way, though, that 72 level, that green line that I highlighted earlier as a repeated resistance ceiling, that lines up with our orange 63-day EMA and our downward sloping trend line that has been breached. It could be a supportive area. Once again, we have a few things lining up around that general area right at this moment. Going forward, they'll kind of probably diverge apart more, though. So something to keep in mind, oftentimes these are moving targets, kind of a snapshot of the technical picture in time. For now, though, RSI also rallying, but seeming to peter out a little bit. We did break through the 50 midline and our downward sloping red trend line here, but not really establishing much of a foothold above that key 75 level here. So to take another view of our chart using our volume profile study, well, not super surprising that the point of control is here around 71.12, where we had those repeated ceilings here. It also lines up fairly closely with our linear regression line, our line of best fit there. So around 71 could be another supportive point. If we were to keep moving higher, +2 standard deviation channel, right around 76. So another potential ceiling, only a bit above the area we discussed earlier, 75.
Okay, all right, Don, the floor is yours for a final thought, but I'm going to give one also thought on the bearishness on Newark Airport. I think that can come back a little bit because I've been there somewhat recently and it wasn't as bad as expected given all the reports. I think it might be out of the woods, but final thought on EWJ, in your point of view, not out of the woods here.
Well, it's better than LaGuardia is. Yeah, just a generalization about the marketplace. As I was saying a moment ago, some of the tariff risks coming literally next week, a week from today, the July 9th deadline. It's real, it's coming, and I think the marketplace right now is not appropriately looking at the risk. One of the other ideas in here could actually be some long volatility trades on the chance that vol does pick up in the next few weeks.
All right, we will leave our conversation there for today. That's Don Kaufman of Field Trade and our own Rick Duquette. Thank you both, guys. Coming up next, we're going to spotlight Tesla. Its latest delivery numbers out. Shares are actually higher today after losing some ground today. We'll dive into analysis on those delivery numbers. Trading 360, we'll be right back. Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of think or swim. the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization. And track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Trading 360. I'm Diane King Hall, live from the floor of the New York Stock Exchange. Time now to spotlight Tesla and his latest delivery numbers. Joining us for Perspective is Ed Batowski.
Question is, how were they?
Wood Investments.
Were they good?
All right, Ed, thank you so much for joining us today. So the delivery numbers came in a little bit above 384,000. That is down more than 10% year over year. It doesn't beat the consensus view, but there was a whisper number going around Wall Street. Were you surprised or not surprised, first up, by these numbers?
I was surprised it was as high as it was. I thought it was going to be a disaster.
Ooh.
And it turns out that it was not a disaster, which is a real positive for Tesla in light of all the negative PR that they've been getting recently.
So, Ed, it's so funny that you say that because I was actually surprised, but I thought it would be better than this. And I'll tell you why. Because I went into a Tesla showroom. I talked on the phone to a different Tesla showroom. They said they were, sold out of all their vehicles. Now, that was just for this most recent month, for June. And so 1 month is obviously not a full quarter. So I was under the impression that there was strong demand. Do you think that political hang-up is still like a headwind for the company, and Elon Musk kind of...
Not really.
Well, when you used to think about Tesla, you thought about a great electric vehicle. Now you think about Elon Musk, and you think about Donald Trump, and you think about their skirmish that they had. So I definitely believe that there's negative PR out there, and there's a lot of other choices. That's the other thing to remember, is that Tesla has a price earnings multiple of 160, which means to support that, it has to grow its earnings at 160%, and it's not doing that. So this is a grossly overpriced stock that where its financial health is deteriorating, revenue, net income, and cash flows are down significantly. So this is a company that is in real big trouble right now.
Oh, really?
Okay, I'm interested to know your views because you
What's
mentioned
your opinion?
It's not just about political headwinds. There are other choices, and one of the challenges that Tesla has faced is losing market share in China.
Been hearing that for years.
Now you've got BYD, you've got Li Auto, etc. Do you expect that to continue to still be a challenging area for Tesla, China market share?
Well, it depends on how the trade negotiations go. But I definitely believe that the Chinese government is keeping the lid on how much Tesla can do over there. But BYD is a fantastic company. NIO is a great company. And there's a couple of other Chinese manufacturers where they can buy domestic and not worry about bringing in the tariffs from the United States.
To be fair, Tesla did see somewhat of a recovery in China recently. So you saw some improving demand for the Model Y there. They've been really obviously pushing the Model Y there, especially given some redevelopments there and stronger output there. And Dan Ives dealt with some comments on Tesla, and he's been bullish on Tesla. And look, you have kind of just different views about how Tesla should be valued, right? Is it an EV company or is it an AI AI company? Is it about autonomous?
It's a technology company.
And so what do you think about that view? How do you look at Tesla?
I look at it as a pure car company.
Oh, you're full of crap.
AI is something that supplements what they're doing, but it is not an AI company. It's not a robotic company. It is purely a car company, and that's where they make most of their profits.
You're fat slob.
Is something that has become a disaster. Every time when my wife sees it, she just kind of she wants to throw up because she thinks it's so ugly. But the Cybertruck thing,
I'm annoyed with this guy already.
and I wouldn't be surprised if they just kind of ditched that whole Cybertruck.
They can't take much of him anymore.
So Ed, it's so funny. I'm not similar to your wife. I'm not a big fan of the Cybertruck. It's just not my aesthetic. I don't have any problem with it. Now the Model Y, it's a great drive. Do you expect the Model Y to regain any market share in this coming quarter?
I do, just from the pure marketing standpoint, that Elon Musk is taking over the marketing and he's going to put his face back on Tesla, and people have Elon Musk or Tesla deranged syndrome, where they continue anything that Elon Musk does, they get behind and they think he's an absolute genius, which he is. But what are the chances of him replicating his success every single thing that he does? So the Model Y,
who's this guy?
Well, the price has come down quite a bit, which makes it even more affordable. But they're going to have to come up with some new.
Who are you?
Okay. No, I think you make a great point about, I do think that Elon Musk is a genius, because that's just one of the things I was fascinated by how I've driven one before, but by how the vehicle operates is just very intuitive. And then the other thing was I saw one of those, I call it an Autobot, but robots in there. So it's, but it's more of like a curious fascination there. When you think about Tesla, look, it's been an underperformer year to date in the Mag 7. On a year-over-year basis, it's obviously performed better. What's your expectation for the second half of this year for shares of Tesla?
I see the shares dropping precipitously as earnings come out in the second quarter. When those are announced, I think the stock's going to take a big hit. I'm just not a huge fan of overpriced companies, and that's what this is all about. That when you look at the robotics and the AI, do those things add to the earnings of Tesla? And they don't. You have to look at how much they're spending.
You're a very bad man.
They're bringing in, and that's going to be the difference between success and not success. And the new initiatives where they have to raise more money, I think they're going to have a hard time. I think there's going to be a lot of rough roads ahead, if I can use that pun, for Tesla.
I love a good pun there. It handles, I have to admit, it handles rough roads well. All right, and we will leave our conversation there for
this
today.
guy is an idiot.
Managing Partner, Chapwood Investments. Thank you, Ed. Coming up next, it's
Tell that to Eddie.
Joins us to take a look at another member of the Mag 7. That's Apple, is adding on to this week's gains after an upgrade from Jefferies to give us the details and an example trade. That is next on Trade 360.
Okay. What he said. Woo!
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Trading 360. I'm Diane King Hall. Time now for the disruptors. Taking a look at Apple. Joining us now for perspective, we've got George Sillis, senior markets correspondent. Apple shares moving higher today off the back of a, I don't want to call it fully constructive, but a little bit more upbeat view from Jefferies. What's your take here, George?
Well, I think, Dan, if you look at Apple, I mean, first thing you'll notice is the stock has been a serial underperformer, at least in the mega cap space. I'm going to throw Google in that mix as well. NVIDIA, Broadcom, Microsoft have all really hit some new highs and have really taken the limelight away from Apple. And I think, considering Apple's estimates for the upcoming quarter, as well as the fiscal year, they're actually quite low. They're only expecting around 4% sales growth and about 6% earnings growth. One of the things that Jeffrey denotes with their call.
This is what I stated too, though. I said their last earnings, they're lowering guidance, if not giving any guidance at all. And they've been wrong. So, I'm just telling you. Oh, they're going to be shocked. Earnings were that good? No, but they didn't issue any guidance last quarter because of tariffs, which is total hogwash.
Amelioration, what we're seeing in the tariff talks, as well as, from a macroeconomic standpoint, interest rates, at least in the United States, have fallen on the 10-year basis. That actually helps the financial conditions in China. So I think what we're actually seeing is the manifestation of improving trends in China. That includes potential for Apple, lessening of the tariff talks, and of course the impact that tariffs would have on Apple. But at the same time, you'll notice a lot of names that are very concentrated in areas like Southeast Asia and China. Wynn Resorts in the casino space, Nike. These are a couple of names that have been moving higher. And I think Apple is starting to make some nice momentum move to the upside. So they're actually looking at this call based upon the estimates for, like I said, sales and earnings being quite low. So if they do see some improving trends in demand, particularly in China, and also, like I said, some less challenges based on tariffs, there may be some trend continuation here for Apple going forward, considering that there's been a significant underperformance in this name compared to some of the other mega cap names, especially NVIDIA and Microsoft in the $3 trillion valuation space.
You make a great point. Look, it's been one of the underperformers in the Mag 7, as you mentioned, George. I do wonder if Apple will end up having a year in some ways similar to last year, in that, there was suddenly by the summer, trends started to change, and I wonder if we'll see that with Apple now. So we're seeing, potential peek at it this week. But George, when you think about this note from Jefferies in the view, it's hold, right? So it's neutral. Where do you go in terms of an example trade?
Yeah.
Well, I think when you look at Apple, you have to consider, value first and then momentum. And so right now, at least on the daily chart, you're starting to see improving momentum. And I think the catalyst there is interest rates lower in the United States. It's impacting positive monetary and capital conditions in China, and Apple being concentrated and exposed to China fair as well. And so I think if you look also at the technical patterns going back to the end of last year, where the stock was trading close to $260 and it fell all the way down to about $170 at the April lows, there's a potential for a 2/3 retracement, which corresponds to the 50-week moving average, and that brings us close to the 220, 225 area. So I'm going to play a bullish continuation trade for Apple. So I'm going to structure an August 44-day expiration bull call spread. I'm going to buy the 210 call and then sell the 220 call
against it, and that's right around, like I said, that 50-week moving average that I think the stock could potentially go to. This would cost you about $4.75 a share, or $475 a contract. So it's bullish. You have to hit at least 214.75 if you hold it till expiration, and then that max loss is what you pay. That's the potential, outlay versus 525 max profit. So it's close to 1-to-1 return on risk, and max profit is achieved at 220 or higher by expiration in 44 days.
And is there anything that you have to watch out for in terms of any event risk?
Well, I mean, any event from an exogenous standpoint can happen. There could be a change in tone from Washington. There could be some other, military event or geopolitical event that could certainly interrupt this trade. But at the very least, we have to understand the risk and reward. And so we know what the outlay is. It's $4.75. That's your max loss. And then, of course, your max gain is contained at $5.25. So, but there's always going to be risk, and it could be exogenous, and that could certainly interrupt the price pattern and the momentum that Apple has right now. But all else equal, I'm just going to go with the momentum that's based on what we see right now in the charts.
Got it. That's our George Solis, senior markets correspondent. Thank you for the example trade on Apple. Shares higher right now by 1 and almost 3/4%. Coming up next, time for our 360 round. We're taking a look at earnings from Constellation Brands. It's all hit to profit and sales. Shares, though, higher off the back of its latest quarter. We'll have insight on the other side of this break.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Believe me, when it comes to investing, you'll love Carl's Way.
Carl's Way.
Take a left here, please.
But there's a...
Carl's Way is the best way.
It is.
Is it? At Schwab, how I choose to invest is up to
Who are
me.
you?
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab.
Ooh, how cold is that chick? Let's get with it. It's now 10:49 here in Missouri, 11:49 Eastern.
where you had an earnings miss, you had a revenue miss, you had guidance reiterated. How reliable and believable is this reiteration of guidance? Because essentially what it's calling for is a reversal in trend and volume growth over the next 3 quarters, so 2Q, 3Q, and 4Q, while keeping in mind that June was a challenged month for them. And so, tariffs had a modest impact. They are USMCA certified. They're only paying tariffs on aluminum cans. With the 50% tariff, it's going to be an incremental $20 million to their beer operating profits. So not a huge deal. This story is largely focused on a top line recovery. And if they are going to have the recovery, it's likely going to need to show up in Circana and Nielsen data as soon as the first week of July.
So, Gerald, those are great points. No, I appreciate that because, like, to your point, if it's reliable and believable, and obviously when any company gives guidance, the goal is obviously to give what are believable numbers, but obviously it's banking on some recovery. So, Nick, do you think this is believable when you think about some of the softness that they have had in demand, especially when Gerald brings up the point about June?
Well, the softness was more in wine and spirits, not in beer. The Mexican beer Corona Modelo doing very strong double-digit growth. And yes, it's believable because 3 months ago they guided and lowered, and now they're not. So some of the profit margin should be less severe. And this is something that's impacting not just Constellation Brands, but companies across the board. If the worst of what we expect about tariffs are behind us, some of the worst of the expectations that are built into the price of the stock may be behind us as well. So yeah, I do believe it's believable from the company, and if not, their credibility would take a hit. And but this is a company that did guide lower 3 months ago by a greater amount, so I trust this guidance from the company.
Okay, and then Gerald, I want to get your thoughts on this. You've got a buy rating, you've got a $195 price target on Constellation Brands. What gets it there?
So the catalyst to us coming out of earnings is very clear. If we see improved volume trends,
I'll be right back.
Channel data, so Nielsen and Circana, we believe the stock will, the multiple will expand, and the stock will kind of narrow the gap to relative to where it typically trades historically. Right now, it's at between a 20 to 30% discount to its historical averages. Our conversations with investors lead us to believe that this is a name they want to own, but they just want to make sure that they're getting in at the right time. And so we think intra-quarter will be the bigger catalyst to potential multiple expansion relative to any given earnings.
And then, Nick, I want to get your thoughts on where do you think it has the potential for the greatest recovery? Is it the direct-to-consumer, or is it the wholesale channel?
Well, getting the wine and spirits business back, I mean, that was a huge drag. But focusing on the double-digit growth in the Mexican beer is certainly a way to go. And it is true. This is a stock that's trading at its lowest forward PE multiple in nearly a decade. And that's because the estimates were going down and increasing rates over the last year. So the stock has lagged, justifiably so. So what we need to see is the worst is behind us, and relative, we can see earnings expectations continue to improve. That doesn't mean the estimates are going up, just cut at lesser rates. An improvement should be the likely bottom for this, a month or two ago.
Well, that certainly seems to be the reaction today. Shares up about 4.5%. It seems to be the view that the worst is behind it. Nick Rach of the Earnings Scout, thank you so much, and Gerald Pasquarelli and Needham, thank you both. Have a great holiday, a weekend. Have a beer. Why not? Thank you for joining us on Trading 360. I'm Diane King Hall. Download the free Schwab Network app. It's available in the Apple App Store and tune in 24/7 on schwabnetwork.com. Stay with us. You've got Fast Market up next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The two grandchildren planning for their college educations. Someday it'll be their turn.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 800 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades and full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
I'm Nicole Petalides, host of Trading 360 and The Watch List, live on the floor of the New York Stock Exchange, where we bring you breaking news, experts, CEOs, influencers, and analysts. It's all available on Schwab Network.
July. Oh, I haven't done July's invoices. We're going to do them tonight.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because
still going sideways,
is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Good afternoon, traders, and welcome to Fast Market here on the Schwab Network. I'm Tom White. Got a great lineup for you today. We'll talk markets, which are rallying once again, and option strategies. We're going to cover Apple, which is up over 5% so far just this week and was upgraded today. And then Adobe, which is down about 15% in 2025 and was downgraded this morning. And Likefolio has consumer sentiment data in Meta Platforms, which is up over 20% so far this year and just off of Monday's all-time highs. Now let's take a look at the major indices, which are sitting near session highs for us. The benchmark S&P 500 up 0.3%. The Dow Jones Industrial Average basically flat. And then the NASDAQ 100 up 0.6%, bouncing back from yesterday's losses. And the Russell 2000 small caps continue to outperform this week, up another 0.75%. Help me break down all this market action. Let's bring in my co-host for the day. That's Joe Mazzola, head trading and derivatives strategist at Charles Schwab. Joe, give me your take here. It just seems like this market's Teflon right now and dare to short a dull market at this point, right?
Yeah, you nailed it. You know what? From your intro, I think the index that I'm kind of keen on the most right now is the Russell. It's been a laggard for many years, right? It looked like the rotation was occurring in November and December when the Trump trade gave it some life, but then kind of fell apart again. And here we are, as you mentioned, up about 0.75% today, but we're above the 200-day moving average.
Okay, we lost support here.
Since March, and as we're looking at the S&P 500, the NASDAQ setting new highs, I think this is the one that might show that there's some broadening occurring. And maybe some of the momentum trade that had
get ready, folks.
Last couple months or so. Yesterday was interesting in terms of kind of how that dissipated and how that kind of waned a bit. And you saw some of that rotation occurring, moving into some of the sectors that maybe hadn't been as well loved. But like I said, that price action in the Russell is very interesting to me today.
Yeah, we talked about it yesterday as the rotation was taking place, right? Selling out of big tech and moving into staples and, financials again. And, Joe, when you look at that, one of the things that it triggered for me a little bit is maybe the resilience of this rally is the fact that, hey, you're not, investors aren't moving out of the market, right? They're just moving assets into different areas that had been beaten down. I mean, we had Target up 6% yesterday. We had all these other names up 2%, 3%, 4% that had been beaten down. Healthcare was another one in there. So does that kind of reflect the resiliency of investors that, hey, this bull market's not done by any stretch of the imagination. We're just going to go into areas that have been underperforming.
Yeah, and it makes sense, right? I don't think there's anything wrong with trimming strength and looking for the chance to rotate into maybe underperforming. Remember, this is the beginning of the third quarter here, right? So the second half of the year, people look at their statements and they say, okay, maybe we got a little bit overweighted in tech, maybe we got a little bit overweighted in communication services because of that first half strength. It's interesting to me, Tom, that we finished the first half of the year up 5%. I think if maybe you blinked and you missed all the volatility that we saw in April and May, you'd say, 5%. That's a decent start to the first half. But just think about the path that we took to get there. That was pretty incredible to see where we're at right now. And like I said, I think it probably makes sense for a lot of rotation to occur at this point as investors are looking to see where that strength will be in the second half of the year. And I think another thing to key on is this. Mag 7 earnings for the second half of the year are going to be really, really critical because the expectations for this year, for 2025, would be you'd see, positive earnings in the Mag 7, but that dispersion, right, between the Mag 7 and the other 493 stocks, that was going to narrow. The expectation was that you're going to see the other sectors, the other names are going to catch up with the Mag 7. So once we kick off earnings in the next couple of weeks, that's going to be really interesting to see. I think investors may be anticipating that already and are starting to make that move.
Yeah, I'm going to mark this down. That second or third week of earnings season towards the end of July into early August is going to be, I think, the catalyst, especially if we continue to rally here, Joe. I mean, you look at the S&P 500, Golden Cross is in place now, 50-day moving average is moving ahead above the 200-day moving average. 80% of the stocks in the S&P 500 are above their 50-day moving average. So the froth is getting there a little bit. There's the Golden Cross. It typically doesn't happen. And typically when it does, stocks usually go higher. I think the last time they didn't was about 1990. But Joe, I think that's maybe, what's got me scratching my head with all the headwinds we always talk about on a daily basis, whether it's geopolitical risk, tariff risks, this tax bill trying to get through the House now that's been passed by the Senate. So there's headwinds out there, but in bull markets like this, I think this is one of the things we kind of have to communicate to our viewers is the fact that, hey, they get that a lot of that stuff just gets ignored, and it's going to be better moving down the line because markets are forward looking.
We talk about this all the time, Tom. There's inertia behind this move, and that inertia can quickly change if there's a catalyst. Now, there's plenty of opportunities for those catalysts to arise in the next couple of weeks. We got a deal done with Vietnam today. I don't think that's market moving, but we did see the tax bill pass through the Senate yesterday. The hope is that the House of Representatives gets something done by the end of the week. That might be a bit aggressive, but who knows? That could be done. And here's a perfect example. If you look at yesterday, some of the bigger movers towards the end of the day would be some of the solar stocks and some of the clean energy stocks. When the Senate got their tax bill passed, that basically kind of cut back on some of the cuts that the House had put into their bill, or at least maybe alleviate some of the pain from some of those cuts. So you saw things like the solar stocks rally. You saw the different solar ETFs move up in accordance with that. They're continuing that move today. So it's still headline driven. It's still a market that's headline driven. But there are still potential landmines for this market. But as of right now, it's kind of seeing past that. I think, in my mind, a couple of things to be paying attention to right now is when you look at some of the hedging activity that you're seeing on the institutional side. A week ago, 2 weeks ago, you saw hedges in place kind of heading into the FOMC meeting where
even yesterday,
85th percentile in terms of puts and puts relative to calls, meaning how many people were buying downside relative to buying upside. That's moved from like the 85th percentile down to like the 40th percentile. So people have kind of given up on the whole hedging idea. I don't know. In my mind, I think that's a little early to be doing so. But here's the problem. If you just keep buying puts and keep buying hedges, you're missing a lot of this upside rally, and you're increasing that hurdle rate. I always kind of liken it to insurance. You're paying the premium for this, but you're going to have to recoup that premium at some point by the moves in the underlying market. And I think to a certain extent, institutions who have probably maybe sat out the beginning part of that rally are playing catch up right now and are getting a little bit sick of having to pay for that insurance.
Yeah. That's the thing, about the hedging part of this, right? Hedging your portfolio right now is pretty cheap. Well, it's cheap for a reason.
It's cheap for a reason. You got it. No,
yes, exactly. I think that's a great point. But Joe, you look at that. We always talk about the Fed and their dual mandate. Inflation's been coming down, jobs market's been robust, but we're starting to show cracks. In today's ADP report, kind of reflected that. The first time we saw a negative number since mid 2023, and this kind of while they're not totally correlated one-to-one between non-farm payrolls and the ADP report, they move in sync, Joe, and we're starting to see some cracks. And to me, that says, maybe there should be a little bit more caution. But at the same time, if there are cracks, and say the non-farm payrolls comes in light tomorrow, hey, the Fed's got that put where they can cut rates starting in July. Is that maybe what investors are banking on at this point with all this optimism?
Yeah, yes and no. And the reason I say potentially no is just because we haven't seen the probabilities increase dramatically for a Fed rate cut in July. I think it's up around 21-22% now. So yeah, it's been a slight tick up, but I don't think anything to where it's a screaming move for the Fed. A lot of times what will happen is the Fed will wait to kind of see what those probabilities look like in terms of expectations, and they don't necessarily want to shock the market by doing something that the market's not expecting. I will say this, tomorrow, well, number one, let's just start with the ADP. The problem with the ADP just hasn't been a great predictor of non-farm payrolls as of late. So seeing it come in, with subtracting 33,000 jobs today, that's something you want to kind of keep in mind. But tomorrow, not only get the non-farm payrolls, but we get the jobless claims, we get continuing claims because it is a truncated week. So I think, in my mind, I'm going to keep an eye on the claims data, just because the non-farm payrolls data is a bit of a lagging indicator. But the claims data, the jobless claims, continuing claims, those continue to show some, so if you look at it like a 3-month moving average, those continue to show that they're ramping up. there's one other thing that we probably don't talk about enough, and maybe we should, is not just the unemployment rate, but it's the underemployment rate. Like, right, are people working at jobs that they're qualified for? That thing's starting to tick back up around 7.5% right now. So that's a big difference from 4.2% unemployment rate. And maybe, that's something that we might want to start paying a little bit more attention to as we continue to make our way through the second half of the year.
Yeah, one of our guests that we have on quite a bit, Daniel DiMartino Booth, she's always been saying that we're not at full employment, the labor market's not solid. I don't know if that comes to fruition, but you mentioned that job participation came in a little bit last month also, and people are taking part-time jobs and maybe not full-time jobs because it feels like the labor market's just kind of stagnant. Nobody's getting laid off as much, but then again, nobody's hiring as much. Microsoft announcing that they're going to cut 4% of their global workforce. That's start coming into the data. But Joe, when you look at some of the names that are driving the markets today, Apple's, we're going to talk about that a lot. That's up over 5% this week. But Tesla, for a 14% decline year over year as far as auto sales goes, but this number wasn't as bad as a whisper. Expectations were about 390,000 cars delivered. But at the same time, they came in at 384, a little bit worse than expectations. But the whisper number, I was hearing like 350, 360. So that may be why you're seeing the bump here in Tesla.
Yeah, and it's interesting when we look at the majority of the volume in terms of kind of the retail trade here at Schwab. Our traders love to trade Tesla. It's been range bound for a while. It's got some volatility to it. Holding it for the long term means that you really believe in what autonomous vehicles could mean. Could mean for that company. That's probably still a ways down the way.
We love trading Tesla.
But it's one of those stocks where it trades within a range right now. I mean, it's pulled back from its December high, but it's also showing that Elon Musk has come back now. He said he's going to spend more time at Tesla. It's going to
I want to know about
be
this
the primary focus of his attention.
If I win OBBB passes,
to me, I think you hit the nail on the head when you said it came in.
Will it trigger a rally or a sell-off?
Because of the belief that maybe sales had declined even more so, or came in lower than than what the target was. So. Anything above that is pushing this up, but we'll see if that's we'll see if that has some legs.
I placed my vote.
If it holds, because initially the stock was up over 5% in the pre-market, then fell down all the way down to 303. So it's $10 off of those lows on this one. And I mentioned Apple. Joe, another one. After the stress tests were released last Friday,
the hell happened to Funk?
The financials, the buybacks announced by J.P. Morgan and Morgan Stanley, $50 billion and $20 billion. Joe, that kind of lent. I tweeted out about it last night when I saw some of those numbers come through. A bunch of dividend hikes for these companies also, but it's kind of reflective of the strength that maybe these banks see in the economy, or at least it getting better and improving when they're out there buying their stock at these levels with markets at all-time highs. Is hey, maybe we are, going to improve in the economy. Maybe that GDP that's expected to be 1.4% from the Fed is going to be 2.5% by the end of the year if we get through a lot of these headwinds as far as tariffs and geopolitical risks, right?
So banks had two really good pieces of really good news in the last couple of weeks or so. Number one is the fact that, yes, that stress test showed that they don't have to hold nearly as many assets on their balance sheet, allowing them to buy back their shares or, as you mentioned, increase their dividend. You got Bank of America, you got Citigroup hitting 52-week highs today. But the other thing is, remember, we're also getting a steepening of the yield curve, right? And that's been really good for banks as well, too, because the spread between where they borrow and where they lend continues to favor them. And as that yield curve continues to steepen, that will help them in their net interest income and their profitability going forward.
Yeah, that the 2 year, I believe the 10 years of a 4.7, or the 30 years at 4.7, the 2 year down to 3.68% at this point. So widening net interest margin income on there. All right, Joe, let's take a quick break here. When we come back, we're going to discuss Apple. It's been lifting markets this week. The iPhone maker stock is up over 5% so far this week. Was upgraded overnight at Jefferies. Stick around. We're talking Apple when we come back.
not going to be there. So far, it's held up.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right.
Did y'all take a lunch break at
Are
once?
you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start.
The little reverse of that Apple.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free.
Apple Pop.
Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Yeah.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Fast Market here on the Schwab Network. We're talking Apple. The stock got upgraded overnight by Jefferies. They were underperform on this name, and they put it up to a hold. 188.32 price target, up from 170.62. So, Joe, when you look at a stock like this, you see it upgraded like that, it's almost like, yeah, maybe the worst is over, but it's still not a great stock. We're putting our price target up a little bit. But this had been a laggard, especially in the Mag 7 and the overall market, from those all-time highs that we saw in December because of growth rates have slowed. They're putting money into AI that's not working out at this point. What's your take here on Apple?
I mean, you said it, Tom. It's down 16% year to date, and the market's up 5%. That's a pretty wide distance between what the overall market's done and then what Apple's done. And then you compare that to the Mag 7. There's basically three stocks in the Mag 7 that haven't, or that are down on the year, and Apple's one of them. So Google and Tesla being the other. But what's interesting about Apple is that while they continue to see growth and generate profits out of their services, they just haven't really done well with the hardware sales as of recently. And it's even though they got the upgrade from Jefferies, it wasn't like it was a resounding buy. It was basically, it was a move to neutral, right? So that's not what you would consider, a big upgrade. Now, I will say this, there's been other talk as well. It's not just Jefferies, but Dan Ives came out today and he said, look, he thinks that that Apple should be looking to make a big acquisition, particularly in the AI space, because they have lagged, behind, in AI creation. That the iPhone 16 was supposed to be the big upgrade. That hasn't performed as well as they had hoped. But Dan Ives is calling for them to acquire Perplexity AI, and we'll see if they do that. But basically, he's saying that in his words that their treadmill approach needs to end. So he's looking for a big partnership, and that could be Perplexity or Anthropic. But in his words, he calls that Perplexity purchase a no-brainer. So we'll see.
Yeah, and that's the thing. It's almost like, hey, partner with somebody that's really good at AI, because obviously you've missed the boat and you're behind the curve in AI. The Siri rollout's probably not going to be till 2026, and who knows if it'll be good. But Joe, if you look at this, the partnerships might work out, and I think that's kind of lent a little bit of optimism to this name. But at the same time, they've already got a partnership with Google Alphabet. Gemini's not a bad large language model either. Maybe they could partner in that front also without having to develop their own AI infrastructure. Is that maybe the key here for what what everybody's getting excited about? Because this stock was on a downtrend since hitting those highs in December.
Remember, Apple isn't always a first mover, but Apple tends to be a best mover, right? Like, they'll kind of wait it out, and then they'll hit the markets with a better product. You can go all the way back to, when the iPhone first hit versus the BlackBerry, right? So they don't need to be first to the market, but they're usually coming with the best product. The problem is the product hasn't been the best for a while. And so, fortunately, they're part of that ecosystem where people say, okay, well, I've got the headphones, I've got the watch, I've got the phone. I want to keep it all together, so I'll just continue to upgrade along the way. And financially, they're able to do that just because of some of the different partner programs that they have and the cost structure. It's getting more expensive, right, for people to buy, and we'll see what happens with the supply chain as we keep hearing more and more about President Trump wants Apple iPhones built here in the U.S. I don't know if that's going to happen, but that is one of the reasons that you've seen Apple stock be depressed this year. But one thing I will say is this, though, Tom. It looks like it's starting to break out. From a chart perspective, it looks like it's starting to break out. It had a nice move earlier today. It has pulled back a little bit from that move. But sometimes we talk about that inertia, right? And when you get kind of that upward movement, if there's some type of positive news behind it, we have earnings coming up, I believe July 31st.
They keep wanting to pump it.
Fundamental data right at that point. But technically, it looks like it's trying to make its way back up to that 225 level. I think it needs to get above 215. And the reason I bring that 215 number up is because that's the area that it stalled last time before pulling back. If it can get above that 215, we might have a chance for this thing to go all the way back to where it was back in February and March when it was pushing that 225. Or late March, basically, when it was pushing that 225 before we had the whole market pull back in April. It just hasn't recovered like the rest of the market.
Yep. That's just one of those things. It's like if I hear that term super cycle one more time, it's been 3 years running now, and it hasn't taken place because iPhone sales have moderated. But Joe, it seems like the momentum's back in there. That 50-day simple moving average was resistance for about a month, broke through there a few days ago. Now it's hitting its 100-day moving average. How do you want to look at this one from an example trade?
I'll take a look at a diagonal. We'll look at one of Kevin's favorites here. The diagonal is basically a time spread and a vertical spread combined. And in this example, we are looking at the August 18th versus July 25th. So it's you're long the August 1st. You're long the August 1st, and you're short the July 18th. So you're actually long the earnings week. So you're long that earnings premium, which tends to catch a little bit of a bid as you get into earnings, as you get into that week and get closer to it. So the hope is that if you own this diagonal and you own that back month, you're holding that implied volatility, you're holding that vega, which tends to expand as you get closer to that. In this example, you're long the 210s in the August and you short the 225s. And what I was talking about is this: if we can get above that 215, it's the potential for us getting to that 225 increases, because I think that 215 has been a bit of a hurdle. If it gets above that and there's some momentum behind it, that 225 would be that last level that we saw prior to the April pullback. And if that's the case, the momentum could pull it up towards that strike. Earnings are expected, like I said, on at the end of July at the 31st. So in this example, you are owning that earnings week premium. Current implied volatility percentile rank is only at 23rd%, so it's relatively low compared to where it's been. And when you're looking at that, that's when it makes a little bit more sense to own that volatility, to own that Vega, which you get by owning the time premium in this diagonal. This thing expands as it rallies towards that short strike. And what could help traders with this is that if it's a slow grind up, you have the ability to get a couple rolls in there prior to that date and prior to the earnings.
Yeah, let's break this one down. And I was surprised when you sent over this example that the price of it, because it's a bullish $15 wide call diagonal, that you're paying nearly half the price of the width of this call diagonal. But let's get into the details on this. August 1st weekly options, you're going to capture that earnings event, so volatility a little bit elevated, but not much right now. The 210 strike call, you're buying that one basically at the money, slightly in the money. In the July 18th options that expire in 16 days, you sell the 225 strike call, bullish $15 wide call diagonal. And I mentioned this, Joe, because you've got 16 days till that July 18th expiration, and I think you're collecting more option premium to offset the risk on this trade, which is the debit you paid. Joe's got $825 debit up here. That's where it was trading earlier. That would be your risk. Yeah, $825. It's down to about $7.60 now, so you can get it a little bit less expensive, even though the long strike is still $1 in the money, with the stock trading right around 211 here. Now, where do you get the break evens on this one? Well, it's going to be a little bit above that 210 level. You need it to probably go above 212. 213, something around there to be profitable on this. Joe, when you look at trade management, you want those rolls as you get closer to expiration in 16 days on that short option on the 225 strike. The idea is it grinds up there, you get more value for those rolls, and time decay is still in your favor, right?
Absolutely. And if you kind of price in those rolls, hopefully by the time you get closer to that expiration, this thing is maybe cut in half in terms of the debit that you paid because of the fact that you can roll it. It does look for, as you mentioned, Tom,
I don't think I've ever had a nose like this.
The hard part with this is if you get a big move either way, right? Big move up or a big move down very quickly. If that happens, especially on the downside, well then this spread is going to it's going to lose value very quickly. On the upside, the hard part is, okay, do you want to roll that 225, close it out? Do you want to move it up? That, I think, really depends upon how bullish you are. But in this example right now, this type of trade would really benefit from a slow move up towards that price. If that does occur, and you're collecting time decay, remember, you get an extra day of time decay this week, just because you can't trade on Friday. So, it's interesting to me to see that this is still, priced as the way that it is. I thought it would be a little bit more expensive, as you did when I first looked at this, and especially given where we're at right now. You can do this for almost 50% of the value of that width of those the 210s versus the 225s. That kind of shows you when implied volatility is lower like this, these time spreads become a little bit cheaper.
Yeah, and the fact that earnings happen during the option series that you're buying, that 210 strike call in, that's kind of reflective, because you'd expect going into earnings that volatility is going to remain firm, and you bought that option, so you're long Vega in this type of trade, and you don't expect that Vega to come out until you get to and past that earnings event. So a pretty interesting call diagonal there. You do have some assignment risk on that short option over the next 16 days into expiration also, but good look at the bullish call diagonal. Thanks to Joe Mazzola, head trading and derivative strategist. Thanks, Joe, at Charles Schwab, joining us. But coming up after the break, Andy Swan's going to join us from Likefolio to look at sentiment data in Meta Platforms. The stock is just below Monday's all-time highs, and just raised a price target out of Baird today, up to $740, which is just below those all-time highs. Stick around.
do.
Trading at Schwab is now powered by Ameritrade.
Oh, I was going to turn
unlocking
on
the power of Thinkorswim.
cook my chicken.
Award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization. And track market trends with up-to-the-minute.
We're just now pulled back to support on Zim. I don't watch it much.
Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks
Not unless they're Jim's.
techniques like trend analysis, price patterns, moving averages,
And being in the now.
and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today. Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Boom!
Welcome back to Fast Market here on the Schwab Network. It's time for our cash tag segment. For that, let's bring in our next guest. That's going to be Andy Swan, co-founder of Likefolio. Welcome back to the show, Andy.
Thank you.
All right, so we're talking Meta Platforms, just off all-time highs. It's had a nice run, but Andy, these guys are spending so much money on AI. You hear all these stories giving $100 million bonuses to try to get people from OpenAI, but that's maybe okay if you've got 3.4 billion monthly active users on your platform and a majority of advertising dollars are going your way, right?
Yeah, that's the thing. You know, how much money is too much money to throw at one of the biggest problems and biggest opportunities in the world if you've got the biggest audience in the world. And I think that's exactly where Meta is. You know, they're eliminating traditional ad agencies. Their Advantage Plus ad platform is exceptional. And, you know, by 2026, we could have, entire ad campaigns completely automated in terms of generation by Facebook for small businesses and large businesses alike. And that's an extremely powerful place to be, because what it does is it takes a lot of the cost burden off of their customers and allows their customers, instead of spending money on design and figuring out the best calls to action, etc., it allows them to spend that money on ad placements inside of the Meta ecosystem. And you nailed it. When you talk about Meta as kind of the the gravity well of online digital advertising. It's very clear when we look at, the mind share that they have in this space of digital advertising. There's Meta, which is larger than Google, and then there's just kind of everybody else, which are very small dots. And so, Meta's definitely in the driver's seat here. The one thing that, if you just look at the data alone could concern you is the growth rate of those smaller players is starting to really ramp up. Reddit, very high, Pinterest seeing gains, Meta falling off. But, actually when we looked into this, the data was showing Meta falling off in terms of web visits to their ad manager platforms. A lot of that fall off is actually a good thing because it's their customers having to log in less in order to spend more. And again, this goes back to that entire promise of why they're investing so much in AI, because what it's doing is it's empowering their customers to do a lot less and spend a lot more on the platform for a much higher ROI, which ultimately is the winning hand in the digital advertising space. It's really tough to see how Meta doesn't continue to win from here.
Yeah, the growth rate is, it's almost like that law of large numbers at this point, because Meta platforms across all their platforms is so big compared to those other competitors. It's almost like that AWS versus the other cloud providers. It's just a law of large numbers at this point. But Andy, when you look at it, you mentioned, if a customer doesn't have to go on that digital ad platform as much just because it's already automated and they're putting more AI into it for that return on investment. When you look at this, it's almost like it's okay for them to give these star players in the AI space, these developers, that money, right? Or are they going to spend too much? Because the return on investment so far in AI for a lot of these big tech companies has been minuscule at this point. It'll continue to grow as it gets better. But is that payoff going to be there according to your data where, hey, nobody's leaving these platforms, we know that, right? So they're always going to have the eyeballs, and that takes care of it, right, Andy?
Yeah, I think it does. I think, and you also have to remember, Mark Zuckerberg has had an entire career of investing too much money or of, trying to parlay what he has too aggressively over and over again. I can remember when Instagram for $1 billion was extremely controversial, as perhaps he paid too much for that, and now it's an enormous majority percentage of their eyeballs and a lot of their revenue. So this is a founder that a founder-led company that simply sees opportunities as a chance to lever up the advantages that they have. And Facebook has extraordinary advantages. Meta has extraordinary advantages. And, where's the money going to go? It's going to go where the highest ROI is. Where are you going to be able to deliver the highest ROI? It's the platform with billions of users that has the best AI tools for advertisers to target those users and deliver relevant messages and offers. So I think they're betting right. I don't think that they can spend too much on this opportunity. It just seems like they're in the driver's seat and they're just hitting the gas a little more, and shareholders have to be at the point where they just, in Zuck we trust. It's just the way it's going to be until someone else takes the helm.
Yeah, think about it, the hits versus the misses from this company. The misses, the big one, Metaverse, they dumped a lot of money into that Reality Labs. It's not paying off. But then, buying Instagram for $1 billion, that's, what a win. And then WhatsApp, and then, just the eyeballs that they have. If you guys had an earnings score on this one, Andy, because it is just below all-time highs, it continues to move to the upside. But, if advertising keeps up, it doesn't feel like this stock should go lower because it's not like overvalued on a valuation basis.
Yeah, I mean, it's always possible you're going to get pullbacks, but I think you just have to put Meta on your list of, anytime it pulls back 7 or 8% from all-time highs, you're going to pick up some shares. Stocks at all-time highs that are really great companies, and especially I think founder-led companies tend to continue to make new all-time highs, and that I don't think this one's any different. So buy the dips until further notice.
Buy the dips till further notice. I love it. All right, great stuff as always, Andy. Appreciate it.
Thank you.
All right, that's Andy Swan, co-founder of Likefolio, breaking down Meta platforms. And, you know, historically, whenever we talk Meta with those guys at Likefolio, they have pretty positive data, no different today. So I looked at a strategy, kind of sets up with what Andy said on any pullbacks. Well, this is a strategy that, hey, it's just below all-time highs. It's not immune to market moves. So if the market does sell off, maybe Meta does also. So this strategy takes advantage of a little bit neutral to bullish type of stance here. I went out to the July 18th monthly options that expire in 16 days. It avoids that earnings event at the end of the month. And I sold a put vertical that's out of the money to the downside. Sold the 700 strike put and then bought the 680 strike put. So a short $20 wide put vertical. You're collecting roughly about $420 credit on it. That's what you can make, $420 on that spread. But what does that mean for your risk? Well, your risk is going to be about $1,570, $1,580 in risk, but that's all the way below the 680 level on the downside on this. Now, when we look at this, we always talk about trade-offs. Like, I can only make $420 on this, and I've got over $1,600 or about nearly $1,600 in risk on this trade. But we always talk about trade-offs and probabilities. So that short 700 strike in the July 18th weekly cycle got a probability of about 16 or 67.5% that it's going to be out of the money at expiration. The break even on this trade, 695.80 to the downside. That's nearly a 70% probability that the stock will remain above those levels. So those are those trade-offs. Yeah, I've got more risk, but I've got a better probability of success on this one. And as I mentioned, the credit that you take in on a trade like this is what you can profit on it. Now, what does it do? It takes advantage of positive time decay. As you get closer to expiration, the price of this short vertical spread on the put side continues to contract on a daily basis, and you profit if the stock goes up, you profit if the stock stays where it is and consolidates, and it can even go a little bit lower, but remain above that break even, just above $695. So neutral to bullish, short put vertical there as an example, kind of setting up with the Likefolio data. All right, we're going to take another quick break. We're going to come back. We're going to take a look at Adobe, the cloud and AI stock, down about 15% so far this year, was downgraded today. This has been a laggard in that AI space. Stick around.
Looks like we got a new high. I'm not in them now. Golly, 1160. That ain't right. Ooh. Wow. That'd been a pretty trade. Jim didn't seem too bearish this morning. Not too bearish at all. We're 1150 now. We had one good pullback, knifed on that one. And we flagged out. We've been getting higher lows and higher highs. And the volume's kind of petered out. I don't want to jump and chase. But I think I could have got that at 8. Sold it at 11 for sure. 11.20. Or higher. Probably at 12. Okay, that was it for the cottage cheese. See if it holds this new flag. I can't believe how many times I've sneezed today. It's a world record. This is the world record in sneezing that I've ever done in my life. I swear to God. I don't think I've ever had water just drip out of my nose. I really don't think I've ever had water drip out of my nose. Drip, 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 drip. Damn, I have to wear a bib everywhere I go, even when I take a shit. Drip, drip. Jim, we just want to make sure you're okay. We know you're going through some kind of weird time right now. I'll be right back. We're definitely at resistance. Kind of a diamond-shaped pattern. I think we'll know here. It'd be really strong if they did here. He's watching it close. If we can keep just one notch out of the money, maybe. The 60-20s right now, 62-20s. $480. Could have got him there, but I didn't. I wanted to wait a little longer. 1 o'clock Eastern. Eating a chicken salad. Jim thinks we'll get a better price here. It's got the new high. I forgot what I saw it at. I can't remember what number. 460. There's 480 right there. There's 460. He's watching it. It seems like we're double top. We're definitely at a breaking point. Oh, did we get it? 420. You can go lower. That's definitely support. You still play it. Just one notch out of the money. If you think it's going to pop here. $440. Just a little dipper, little fake knife. There it's 420. Randy, funky. SPX. There it is. 4.20. I don't know if this is a good smart idea or not, but I did There's $4. Ooh. That's nasty. Whatever I got. Alex, 420 please. Always clean this, Jim.
Hello?
Yeah.
This is Donna. I'm calling to let you know that the government is giving a subsidy to pay your...
Go on. The costs of getting old. Jim's green again. Should he sell it? Or are we going to break out? Jenny says, Jim, this is what I always liked about you. You rolled the dice. No matter odd or even, the odds were always in our favor. We're at 470 now. Boom. Did I say $50 a contract? Whoa, baby. I'd like to know what happened to that funk. Man, that's good. This might not be too good here. We gotta hold this support. Well, just go for it. You're going to do it. Don't go too hot, Jimmy. See, I think it can come down, but... Back to my even. Jimmy's watching it close. It's the SPX Lotto calls, July 2nd. Strike 62.20s. Yep. $4.20. And he doesn't think it's really, really strong. That's what Jimmy thinks. going to find out real shortly. I got the runniest nose this side of the city. I got the runniest nose on this side of the city. She can follow me a mile. I can't get a load of my lady. Well, I got a booger that's hanging out of my nose. Oh Lord, yeah. I got a booger that's hanging out of my nose. It's hanging out of my nose all the way down to my toes. One of the best songs I've ever heard you sing, Jim. Is that the one you sung back in 1994 at the State Fair Community College, the Sun Bowl? It was a wonderful song. Let's go, baby. Hey, did you hear Washboardjim was just on YouTube and was singing that classic 1994 I Got a Booger to My Nose song. Okay, this could get pretty nasty if we don't hold this up here. I'm going to tell you that right now. So I'm debating. They got one contract, just hold them and buy 2 more down here and hope for the best. Oh, yeah. Oh, this is radio station KRSP. Was that Washboardjim you had on your show right there, singing that #1 hit in 1994? I got a booger in my nose, would you pick it? We've had so many requests on that song. It's unbelievable. We still are holding support right here. So I would say just hold your buttons. We'll have one more bite of salad and that'll be it from dinner today. So I just wanted to tell you how good you were, and I noticed that the chicken breasts are getting smaller and smaller every year. They don't make them like they used to. Yeah, you southern chickens, you have a lot bigger breasts than the ones on the northern part. Did you ever notice that? Chickens from the south have bigger breasts. Didn't notice that, did you? You'll learn a lot around here. Rivian.
So if we were to break to the downside, $13, our green line here, our line, a frequent stopping point for price. Many times
Jimmy says
here,
wait.
It was a floor,
so he's waiting.
A ceiling, then a floor once again, then a ceiling, etc. You can see the point I'm trying to make here.
They ain't gonna wait much longer.
A key place that the bulls would want to hold on to is this $13 mark. Also lining up with the lower end of our pattern.
3 of them.
To the upside, we've got our moving averages clustered together. They're all right on top of each other. Yellow 21-day, orange 63-day, purple 252-day, all between 1340 to 1385 or so. So really not seeing a very strong trend.
Oh God.
Yeah, and still lower on the year despite the fact that it has had some at least
I'm waiting for.
as far as it's.
I gotta be polite because I don't know. Always clean. May I help you? This is Jim. Yeah, what's up? What the hell's going on here? Okay, she decided to go ahead and go on down. So get ready. The master of the masters are here. He's looking at the 6220s. He has one contract at $4.20. I was rudely interrupted. I know it. I could have added there. Just gonna see if we can get it a little cheaper. There's 370. Oh. It's got some walls to break. Okay, I gotta make sure I get that one other bill I gotta check on. What's it do? What's the name of that bill? Oh. Back to 410. Ha ha ha. February, yes, March. Okay. Woo! 490. I think we know what to do. This man. I think we know what to do. Unbelievable. He's got to be the luckiest man. 3 white soldiers. He sure did it. Okay, that's March. Then you're for March. I can't go up too much farther. March, April. $4.80. Jim just nonchalant, making money. Not even trying. How did you do it? We were all sitting back, Jim, the other day, watching you trade the other day, and you started talking smack with these dotted lines. And this big guy bully guy on Schwab come on there and said, Carl's way is the only way. Okay. Well, now I'm getting frustrated because I can't remember. Oh, God. March, April. Can you imagine itemizing for over since 1990, 1992, 90. 1990, 1989, we've been automizing quite a bit. Okay, here we go again, one more month. Let's see if I can find it in here. Rent. Acuity. Is that it? You want to inform you. I think that's it. The crowd's watching again for another opportunity. So when Jimmy's up 60, 70, 80 bucks a contract, you're probably going to make a business decision. Cutie. Yeah, I think it's this. I think it is. I think I found it. back at my price here at 360. Oh man, this is it's for Not in yet. Coming on down. Jimmy's still waiting. That's odd about it right here at 340, 330. The 6220s. Two of them. Mm-hmm. Nope, 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 nope. Oh yeah. I'm dying. I think that's it. Oh my gosh. I better not have COVID. Stick away for a second before I die. Always remember me as Washboardjim. Tried to put a smile on people's faces, and if you ever were starving, he'd buy you Big Mac. If your old lady was fighting, hanging on you and beating on you, he'd always find a way to separate you two. I remember when I was 15 and at Washboardjim, seeing Richard and his girlfriend at the time fighting over a cigarette butt. So he got on his bicycle and ran up at the store up there and bought a pack of cigarettes, and they're still sitting there arguing about the cigarette butt when he come driving through the driveway. And he said, "Got all these boogers hanging out of my nose. Runniest nose you ever did see." And he said, "Here's your pack of cigarettes. Y'all can stop fighting now." Okay, George,
their core business, but part of the R&D, and that's like companies like IBM and Google. For what it's worth, there are small players like Rigotti, which is essentially a builder of supercomputers and quantum processors, and it's proprietary in nature. These are companies that are generating a lot of money right now in terms of capital investments from institutional shareholders, private placement, and equity holders, because they're getting a lot of federal grants for development and research purposes. And so I think this is, again, an interesting area that is a complement to what's going on in the artificial intelligence space, autonomous driving, robotics, crypto, for instance. So quantum computing is just a natural.
I want to know where funk is.
Additional technology to speed up the processing power than classical computing has given us so far. But Cantor's constructively bullish on this one. They've got a $15 price target on this name. They did, of course, move it to an overweight rating as well. And I think it comes down to the manifestation of revenues. And revenues are important for any company. And, we talked about some of these companies in the quantum space that don't have any revenues and don't have the revenue estimates going forward. And that's not the case for Rigotti. So I do see why there's analyst coverage on this name, because based on the trailing revenue,
I've never had a nose that dripped like that.
Worth last year, they are expecting around the same this year, around 8.9 to 9 million. But going into next year in 2026, that number is more than double, around $22 million. So for what it's worth, this is a company that's expected to double its sales between this year and next. And that may be coming from additional partnerships, royalties, or, if you will, patent licensing agreements with the major companies. But I do think this is still an interesting space, and it's one that's really, caught a lot off guard, considering, looking at Rigotti itself as a company. The stock was trading at sub $1 level last year. So this stock is over 10x in the last year. And even though it's pulled back from its all-time highs, or at least last year, which was around $22, it's still up about 1,200% last year.
Okay, when comparing to then the rest of this space, George, because it's not necessarily at this point, I mean, like all of these things created equal, even though they tend to trade somewhat in tandem. Like we got news from INQ, they're really seeing developments right now in Texas as far as legislation being passed for continuous build of quantum. So, I mean, what else do you watch outside of Rigetti today? Because this note obviously is the broader space. What's working, what's not within quantum?
Well, I think, across the board, there are so many companies right now, it's hard to keep track of them. But there are many names, and some of the names we've talked about, and I brought this up, is they don't have any revenue. So for what that's worth, I think you're going to find those companies are going to, manifest into additional equity offerings, dilution, but they can also provide great...
Just keep an eye on volume.
If you will, from the standpoint of moving higher quickly versus... on the opposite side, moving down quickly. I think Rigotti itself is very volatile, so you have to be mindful of that. The company's, like I said, generating around 9 million in sales last year, but they lost in terms of net losses around 140 million. They have cash around 209 million, so for what that's worth, that's about a year and a half's worth, roughly speaking, of cash to burn. You have to consider dilution risks, but I do suggest that legislation is very important, because if these companies are getting federal allocations, grant money, that can certainly offset any need for revenues, at least maybe in the next year or two. So I do think that's important that if you look at these companies projections wise, go about 1 to 1.5 years out. So if you see sales growth improving about 1.5 years out, which I mentioned here for Rigotti, it's improving by double in 2026. These are based on the estimates. That gives you something to go off of. But other than that, you have to consider there's still a lot of risks. There's still a lot of opportunities, because this whole ecosystem of stocks and technologies are still evolving. And we've seen the evolution of companies that really haven't generated much revenue, if any, continue to move higher. We talked about Archer and Joby, those electric vehicle takeoff and landing companies. They've done very well, and they're starting to generate sales this year.
Yeah, and this will be an exciting space to watch, as I do think it ties very much into some of the AI and just enthusiasm regarding advanced technology and where we'll see things shift just in the next several years. So appreciate that great breakdown on overall the quantum stocks, George Tillis. That'll also do it for Alex and myself for Next Gen Investing. We're closing off of all-time highs in the S&P 500. Good place to leave it. The watch list is coming up next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 800 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network. Good afternoon. Welcome to the Watch List. I'm Nicole Pedalides. It's 2 p.m. Eastern Time. We're coming to you live from the New York Stock Exchange, a record-setting day on Wall Street. Once again, the S&P did hit new highs. Trump announced a new trade deal with Vietnam. Maybe that gave a little boost after the weak jobs report put pressure on this market. We have a big show for you today. Tom White will join us with Options Corner, and he'll break down recent news for Uber, Reddit, Qualcomm, as well as 3 real trades that he found for those names. Then we'll take a look at several tech stocks beyond the Mag 7, as well as Futurum's recent AI 15, showcasing the next names to disrupt the AI space. And our panel will preview the June jobs report, which is released tomorrow. And today's ADP employment miss, does it give us indications about tomorrow's report? We'll ask our guests. In In the meantime, here's a quick look at the markets. As I noted, the S&P 500 new records. Right now, the S&P is still holding on to gains of about 20 points at 6,217. That's up 1/3 of 1%. The tech-heavy NASDAQ 100 gaining more than 0.5%. And also the Dow Jones Industrial Average, well, that's down 56 points. Started in the green. Did have a green point at one point today, but now is red. And Russell 2000 is up 1% almost. Oil and gold are mixed. Oh no, gold higher. 67.47 the barrel on oil. That kind of popped there. That's up $2. And gold right now is gaining about $10. The 10-year bond yield 4.29. Bitcoin 109,875. Also got a pop in the last couple of hours because that's up about 4% now. And the US dollar 96.47. Well, that hasn't been doing much at all. Just sort of sits there. All right, but before we bring in our first guest, we want to take a look at a few of the top stories in today's market. Constellation Brands posted its first quarter results after the close.
Here we go.
Street estimates on both the top and bottom line. The alcoholic beverage maker saw revenue fall 6% year-over-year, citing non-structural
290
factors.
off to 63.
Beer business growth flat to up 3% for the year, while projecting wine and spirit sales to fall between 17 and 20%. Shares of Constellation Brands are down 30%.
290. The same ones.
Upgraded to hold from underperform today, citing Apple's strong iPhone sales volume, seeing its strongest growth since the third quarter of 2021. The analyst believes tariff-driven pull-in demand and share recovery in China could drive June quarter revenue and EPS growth of about 8% and 10% respectively. Jefferies says that good third quarter results could keep stock stable in the near term. Now we take a look at the bigger picture. Joe Hedgener is with us, CIO at Astrozoa Capital. Good to see you. Thank you for being here. So some of your thoughts here on the market action.
She'll trick you. Watch her.
Thanks for having me. Yeah, I think the biggest thing we've been looking at in the last few days, I guess in the last few weeks, is we're laser focused on interest rates, not just in the United States, but globally. And some of the most recent news coming out of this U.S. Trump administration has been putting a decent amount of pressure on the long end of the yield curve, whereby the 10-year rate and the 30-year rate has been rising. This could be for a number of different factors. At the same time, this same administration is talking about potentially some kind of a shadow chair. We're talking about installing a Fed chair next year who may be cutting interest rates aggressively. And one of the things we're trying to think about is, sure, Jay Powell can stick to his guns over the next 6 to 12 months, but who's coming next and what's going to happen then? And what's the world going to look like in 12 months from now? And the shape of the yield curve, I think, is tremendously important as it relates to risk assets, stock markets, real estate. It really is the basis of a lot of different sub-asset classes.
And as you see the S&P and NASDAQ 100 hitting highs this week, do you feel that there is opportunity to move higher? I know, nobody really knows what it looks like in the next 12 months, but do you feel that there is some bullishness in the market that could make us have new highs in the back half of the year?
Yeah, I do. I think that the momentum is really there, and if this administration follows through on a tremendous amount of fiscal spending and the market starts to price in interest rate cuts, that's tremendously stimulative for the economy. And I would kind of akin it to almost like a game of musical chairs. At some point the music's going to stop, and we want to be really well prepared when that happens. But
this has been weird.
We're just
I can't believe it.
Starting to cut interest rates.
I've sneezed over 1,000 times today.
Spending bill through Congress and Senate, and so the second half of this year could potentially be something along the lines of a 1998, 1999.
I don't think I've ever sneezed that much, ever.
In the meantime, we're still concerned about the dollar lately. Obviously, it's been the world's reserve currency. It's been higher, it's been lower. There's nothing really to worry about at the current level, but we worry about the competition from crypto and other nations. At the same time, within your global hot takes, you have the euro this is what, not a prediction, maybe it could be a surprise. Euro does not exist in 10 years?
Yeah, I mean, that's a hot take. But
it is not a hot cake.
The probability
Don't be laughing at her.
Not necessarily disintegrating, but
that wasn't funny.
Nothing like its current form. I think the probability of that is actually very high over the next 10 years. And what I mean by that is about 10 years ago, the European debt crisis, the aftermath of that crisis was started to percolate a lot of these populist governments in Germany, in Italy, in Greece, in France. I mean, you just look at where we're at today from a political landscape standpoint. Whether you're in Northern Europe or Southern Europe, there's a very big kind of populist sentiment that's skeptical of the Eurozone and Brussels, in particular. And there's good reason for that, right? I mean, Germany isn't going to be bailing out peripheral Europe, again. That was a tremendously unpopular practice in the aftermath of the European debt crisis. If you fast forward to today, where we are, a lot of these metrics that got us to the first European debt crisis 10, 11 years ago are worse now than they were in 2011 and 12. With debt to GDP ratios, productivity, demographic trends, all of that is actually worse. It just hasn't been a problem because interest rates have been zero for so long, and a lot of countries were just able to inexpensively gorge on more and more cheap debt. However, in the last 12 months or so, the long end of the yield curve, whether it be the United States, Japan, or the Eurozone, has gone up substantially, and the cost of this level of indebtedness, I believe, is not sustainable. So I think at some point we're going to have somewhat of an existential moment where there's going to be something along the lines of the second European debt crisis, and I think that is the catalyst to where potentially a lot of political factions who are anti-EU or skeptical of the existing infrastructure and establishment could potentially have a lot of sway. I mean, you look at AfD in Germany, Marine Le Pen in France, right? Meloni in Italy. And I guess the last thing I would say there is, the demographic trends are also, quite poor, for a lot of those nations as it relates to their productivity and growth. So in 10 years from now, I think it is actually quite likely that it doesn't exist in its current form.
Yeah, wow. Thank you for that. I'm going to ask you a couple more questions, but maybe you can give me some short, quick answers because we only have, a minute or two left, and I do have a lot of questions. You talked also in your hot takes, and then I want to get to some of the other things like gold and Bitcoin. Legacy auto manufacturers are going to go the way of the BlackBerry. What does that mean?
Oh, goodness. So the first and foremost, I think I would point to the technology, technological change. Internal combustion is going to be around for a long time. But a lot of these incumbent manufacturers have taken out a substantial amount of debt, billions of dollars of debt, in order to finance the production of lithium-ion EVs. And it's already on the wall that's kind of first-gen technology. There's a lot of development as it relates to kind of solid-state batteries and what that 2.0 version of an EV looks like as it relates to being able to charge quicker, have a longer range, etc. And these companies, their level of indebtedness, whether it be Ford or GM, etc., the level of indebtedness they've gotten to in order just to create lithium-ion EVs is levered enough to where they're not going to be able to raise tens of billions of additional dollars to retool their existing supply chain for the next gen technology.
Okay. Yeah. Let's talk about the inflation-linked bonds, gold, Bitcoin, banks, mortgage credit. I know equities you said you like. Tell me about some of these other opportunities for investors.
So I'm a little skeptical of cryptocurrency versus the rise of quantum computing and just what does quantum computing as it relates to encryption power and disentangling encryption, what does that mean for existing kind of blockchain technologies. But the idea of a hard asset, a hard scarce asset, I think is very relevant in the current framework of dollar debasement, right? If you had $100,000 sitting in your checking account 5 years ago, it's worth about 25% less now if you just sat there in cash and you didn't invest in either hard assets or equities or something that would go up with inflation. I think dollar debasement very much continues over the next year to 3 years.
Okay. Joe, thank you. Joe Hedgener, CIO, Astrozoa Capital. Thanks. Good to see you, Joe. Thanks. Coming up, Options Corner, and Tom White is standing by. He'll highlight unusual options activity from the day and how investors are looking to trade on the recent news of Uber, Reddit, and Qualcomm. This as the S&P 500 hits record highs here on Wall Street on July 2nd, ahead of more news that's coming out tomorrow.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the watch list. Time for Options Corner, where we analyze unusual options trades that we're seeing throughout the day. Real trades, and Tom White has found them, host of Fast Market here on Schwab Network. He has 3 bullish trades for us that you combed through and found for us. But just a quick thought here is we got a weak jobs print for the private payrolls ADP, tomorrow's non-farm payrolls, and we still have the big beautiful bill bouncing around. And some good news from Vietnam pertaining to trade. I mean, what do you think is your point in the market that you're watching here?
Seems like the good news is outweighing the bad news, right? Those headlines about Vietnam, and that's not confirmed by Vietnam yet at this point, but that's a good start, right? Because we've only got 2 trade deals done, though, if that comes to fruition. But they're going to be working more on the trade deals into next week's July 9th deadline. That's going to be key. But then, the market kind of pushed aside the fact that the ADP jobs report was minus for the first time since May of 2023. And this might be those items that we talk about, parlaying into what the Fed talks about, where we have a robust jobs market, right? If people are employed, they're going to spend money. That's going to support the economy. But now we're starting to see those cracks widen a little bit. But at the same time, I think there's optimism on the flip side that, hey, if the jobs market continues to start to show cracks, maybe that non-farm payrolls tomorrow a little worse than expected. We got jobless claims tomorrow too. That, hey, the Fed's going to be there to cut in July. Now, the odds for a rate cut in July aren't really that elevated right now. They're still below 25% at this point, according to CME FedWatch tool. But I think there's almost a Fed put built into this market a little bit. I don't know if that helps, but we're a little bit frothy on valuations, a little bit frothy on the technical basis, but it seems like you can't stop this momentum trade, especially in a boring summer market here, Nicole.
So at this point, we have a lot of action. We can never be boring around here with record highs and lots of news, and you have 3 bullish trades that you're going to share with us. So tell us about Uber a little bit.
Yeah, stock's just off all-time highs. It's had a pretty spectacular run here so far in 2025. First, it was the hedge funds that were starting to scoop up shares towards the end of 2024 and into the start of the year. Now the stock's up over 50% so far this year. Pulled back just a little bit from those all-time highs we've seen over the last week. And I think some of the commentary that might come into play as the stock has rallied, the impact of autonomous vehicles moving forward. Tesla's robotaxi event went pretty well. We've got partnerships between Google's Waymo and Uber at this point. But if fully autonomous vehicles come into play here, what does that mean for maybe the ride-hailing stocks, whether it's Uber or Lyft? And Wedbush put out a note a couple days ago on Monday saying that, hey, 40% of Uber's mobility gross bookings are most exposed to AV risk. So while Uber might have autonomous vehicles, maybe they have to license that. Maybe if they have to purchase the cars, even though they're not paying drivers. So I think there's going to be probably some chop here in this stock in the near term anyway, until we get that kind of figured out. But did see some bullish activity in here, and this was out in the July 18th. Monthly options expire in 16 days. Trader bought 5,000 of the 95 strike calls, paid an average debit of just over $2, so the break even just above $97 over the next 2.5 weeks. That's about 5% above the current share price. So this trader's betting that, over the next couple of weeks here into July expiration, that we're going to see more all-time highs.
All right, we'll watch for that. Up over 50% this year, as you noted. Next up, Reddit, and you found a bullish trade here.
Yeah, shares are up about 4% today, but flat on the year, up over 115% over the last 12 months. So it's had a good run. And this is one of the growth names in digital advertising spend, right? While you have those behemoths, whether it's Meta Platforms or Google Alphabet, Reddit, because it's a smaller player, is actually seeing bigger growth. I think growth over the last 12 months has been about 130%. It's newly publicly traded company, but if you look at their daily active uniques, I think they call them, those have started to moderate a little bit, so that's a concern here moving forward, but it's had a good run. The RSI, or on the technical basis, the relative strength index, is above the 75 level, so it's considered overbought at this point, so maybe a little bit stretched, but I did see some unusual option activity in there. Also really short-term positioning by this trader. They bought 3,000 of the July 11th weekly options that expire in 9 days, the 170 strike calls. They paid an average debit of about $4.50, so they start to profit on this position above 174.50 over the next week and a half. That's about 10% above the current share price in there. Call volume is double normal daily average volume. The stock was up over 7% earlier in the session, but yeah, this trader's betting that we're going to see more gains over the next week and a half.
All right, and it's interesting as I think about Reddit, right? I also saw that similar web data showed all these downloads, the rising absolute numbers in recent months. So that's good. At the same time, they They went into an amended and restated credit and guarantee agreement, as you noted. That also gave it the boost. So, I mean, there are some bright spots here for Reddit overall. Let's take a look, even though year-to-date still lower.
I'm surprised that Jim Howard never got married.
How about we look at Qualcomm? What do you think here?
Yeah, the stock's having a nice day today as tech's rebounded a little bit, up about 5% so far this year, but it's pulled still down about 30% from all-time highs that we saw just over a year ago. So it's pulled back pretty sharply. It's bounced like every other tech name since those April lows you can see here from the chart, but it's underperformed a little bit. And if you look at the AI build-out, right? If you look at Qualcomm, what are their businesses? What are their silos of revenue? Well, it's smartphones, number one, but then they've got some issues with Apple that might stop using their chip shortly. That's been talked about for years. And then they're in Internet of Things, they're in automotive, they're in industrial. So they're in everything out there. But they've got exposure to China, so that's also a concern. So does the stock play catch up? That's going to be one of the things, because if you look at the growth the first 2 quarters of 2025, that increased 17% compared with the same period
that could be a problem.
in 2024. So they're doing okay, but stocks underperform, and I think traders trying to take advantage of that. Really short-term positioning on this one too, as far as unusual option activity. This is out in that July 9th or July 11th weekly cycle that expires in 9 days. Trader bought 7,000 of the 162.5 strike calls in there. They paid an average debit of just over $2. So that break even of 164.55 over the next week and a half is only about 1.5% above the current share price on this one. So yeah, somebody thinks that we're going to see some more gains in here. And remember, Nicole, next week, no real economic data of note. Earnings are basically nothing. We've got Delta reporting. So it's one of those conundrums, I think, that a lot of investors are thinking that, hey, there's not a lot of headline risk here at this point as far as earnings and data goes. It's a boring summer market. Momentum's been to the upside. And that's why I brought you 3 bullish trades today, because it feels like the optimism's getting a little bit stretched, but that doesn't matter to markets as they're at or near all-time highs.
So ready of any headline.
Yeah.
I know maybe on the print it doesn't look like it's going to be riveting, but it very well could be.
Yep.
So we have to stand ready. Thank you. Tom White, always a great look here on Options Corner, taking a look at 3 key names today. Thank you, Tom White. Coming up, we'll take a look at several technology names just beyond the Mag 7. We have to break down Futurum's AI 15. You heard of that? Spotlights the next names that could disrupt AI. The watch list. We'll be right back.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, You can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to the Watch List. I'm Nicole Petalides. We're live on the floor of the New York Stock Exchange, a record-setting day. Here on Wall Street, we have a few movers for you. If you looked at Centene, this name is down to 8-year lows, withdrawing its guidance for the full year. The withdrawal comes after the company received its first view of 2025 industry marketplace data, and the data highlighted 22 states in the coverage. As a result of that data, expects lower growth and a reduction to its full-year risk adjustment revenue transfer. And Centene received downgrades, JP Morgan, UBS, following this guidance withdrawal, and the stock's been down 40% all day long. Adobe downgraded to sell rating from neutral today at Redburn with a price target of 280, down from 420. The analyst believes Adobe's moat is being eroded by generative AI and says that low-end disruption is likely to intensify. Redburn believes that without a strategic shift, Adobe's free cash flow growth will slow to single digits by 2030. All right, we want to talk about AI, not just the Mag 7, but more than the Mag 7. How about the 15? We got to talk about this. We have a whole thing set up for you. Shai Valor is with us, Chief Market Strategist at Futurum Equities. Thank you so much for being with us. There's been a lot of excitement around the Mag 7 names. We're back to new highs on Wall Street. Some of your big picture thoughts.
Yeah, I think that the market is front-running the inevitability of what the Fed is going to do in Q4, which is cutting rates. This morning, you're seeing the small caps outperforming the big cap names because I believe there's a 90+% chance now in September that the rate cuts are going to actually happen. So whether or not Powell wants to admit it publicly, rate cuts are coming. Liquidation is coming to the market. So a lot of traders and individuals are just front-running the inevitability of that happening, and that's where you're seeing constant all-time highs.
So you think that you're bullish for the second half. You see the more news coming here, and is it going to be AI-driven or more than AI?
Listen, AI is the main event. That is what's going to be driving the risk on trade that we at Futurum are bullish on in the second half of this year, where you have someone like Zuckerberg who will be throwing $20 billion just to attract the talents to be in-house right now, to have this like acceleration in our AI race. So I do think that you're seeing these hyperscalers throw billions of dollars at just FTEs, that in the next couple of years, we believe that there's going to be a couple $1 trillion of spend that's happening in AI infrastructure. So knowing that we just got the gut check recently that even when there's a paralysis in business spending, there's geopolitical tensions, AI was a safety blanket. So I think that was a pulse check on the durability of this bull market rally, and that's where you're seeing a V-shaped recovery and an all-time high within like 2 months of, I think we're in a bear market just like in beginning of April.
I like how you wrote geopolitical risk was tested and passed. And it was tech that helped to keep us alive and made the comeback and all that. You also have the Futurum 15 here that I was looking at. Yeah. This is something. I mean, what are you telling me? That these names are, some of these names are going to highs?
Yeah, I believe all the attention right now is being at the Mag 7 names. It's totally standard where the first wave of any revolution is towards the infrastructure. So right now it's a hardware, compute. Back then, .com era, it was all about the structural arteries of the internet. So the IBMs, the Verizons, AT&T, they caught the initial bids. But what was the hidden gems of that era? It was the online marketplaces that were built on top of these structural arteries. So the Googles and Amazons, that was the golden gooses of that era. AI is following the same similar lineage. So I think right now all the attention is on the hardware players, Mag 7. But this next stage of AI isn't going to be about who builds the biggest models. It's who can orchestrate the greatest outcomes at scale. And that's where you're seeing the Palantirs out there. You're seeing the CrowdStrikes, the Cloudflares. Like, these names are expensive, but they're consistently hitting new highs because the AI tsunami that's coming, they're safe from it. So the market's willing to pay a premium knowing that these are the stage 2 AI winners.
Do you buy all the names? I mean, first of all, you have to make an index of just these names. You know, Do you buy all the names? It's like a horse race when you hope like, you know, one just goes crazy and you make some big win that covers all your costs. Do you buy all these names?
I own a majority of those names from a couple years ago because knowing that the way revolutions happen, it's in stages. So knowing that stage 2 is really where the real alpha is going to be made. I saw Palantir under 10, Cloudflare under 60, CrowdStrike, even post outage. It was like, they're safe, guys. Even though they shut down the world for a couple of hours, they're going to be essential in this agentic AI world. So I think right now valuations are quite extended. I think that there is going to be somewhat of a breadth or pullback in the near term. But don't confuse that breadth for a potential correction, because I do think once we get, I don't know, maybe a couple percentage pullback, I am going to be a net buyer entering the second half of this year because we got a perfect storm set up where Powell is, whether he admits it or not, will be cutting rates. AI spending is picking back up and it's going to compound. And a geopolitical risk that you said that got tested and passed that I mentioned, if you told me a couple months, just when we started this year, that we were able to attack Iran without the market crashing, oil spiking, and we're hitting all-time highs, I'm like,
excuse me.
That just proves the durability of this bull market, that we're in the early innings of it and it's nowhere close to being finished.
And then names like Tesla, which sold off recently today, got a pop, but is that a name you like?
I'm trying not to die.
Not necessarily.
I do like Tesla. I think that the timing of when they're going to switch the narrative of being this EV company into the, what I believe at future is they're building the operating system for physical AI. So when you think Tesla, don't think EV deliverables. Like even though this morning it was slightly worse than Wall Street estimates, markets reacting positively because it wasn't as bad as feared. You got to think of Tesla as building this AI network for mobility and robotics. And they're trying to scale at something so disruptive, like the TAM of physical AI is severely underappreciated. It's the greatest TAM of mankind's history. So if there is a disruptor in that space, it's Tesla, and if they can conquer it, which again, Elon has been shooting 100% on all his conquests, buying it at an under $2 trillion market cap is
They'll be right back.
Opportunity. The timing of that inevitability is the question, but I do believe
did you say
it's happening. I do believe autonomy is here. It's happening. Opportunity cost might be at risk, but inevitability in 5 years, I think, would be much higher.
You also mentioned Palantir here already, CrowdStrike already, Cloudflare. So I wrote those down. Axon, what's this about?
So Axon is probably the most under-discussed name that I believe
under-discussed?
is going to be a massive disruptor in the future because everyone thinks, I call them the command center for public safety. Everyone thinks that they just have a camera on their the cops uniforms and that's all they do. No, they do real world evidence. They store all that data into their cloud ecosystem. And what that does is locks in all these industries that don't ever leave their ecosystem and cause a recurring revenue nature that is unmatched. It's a true monopoly. And the reason I'm so bullish in the AI future for them is a third of the police time is
450.
They create a product where you don't have to just manually do it. AI does it for you. Now that frees up a third of every cop's time. That's huge. And also drones is a huge component for them.
And MongoDB?
MongoDB is a dark horse of this because my thesis on Mongo was that databases will be exploding in this AI-driven era. You're seeing Oracle capitalize on that. Their OCI is off the charts. I thought Mongo would have a place in that because of the pure demand right now in business spending for AI. They're really catching up yet, but last quarter was the first time Atlas had a re-acceleration on growth in 3 years. That can't be discounted. So although the stock price looks like it's pulling back a bit, I do think that their consumption model, which is prone to business spending paralysis, which is what they experienced the past couple months due to the tariffs, I think this is a rebound story that if it follows suit of what OCI is and Oracle, this could be one of the biggest movers in the next 6 months.
I like this sort of bullseye shaped thing that you have here and how you guys came up
Bullseye
with these 15 names. You have the control layer, the operating layer, the expansion layer. Very interesting.
That's funny.
How many people were involved in putting this together, and what were some of the parameters of making the Futurum 15?
So there was a whole lot of FTA to come up with that list because it was a ton of great research that we got from Futurum. And the primary driver of who we allocated those lanes is this aerometer score. At Futurum, we want to provide air to retail, air, access, insights, research. And part of that algorithm score is what their mode is. Palantir is one of the best monopoly in modes, same with Cloudflare and Axon. What their valuation is as well, and how we believe they fit in the future AI stack, because there is an AI tsunami coming. Don't confuse that. And that AI tsunami is going to destroy a lot of software names. Middle IT spend is bloated.
Is there names that you wouldn't buy right now?
I'm very bearish on the CRM space, DevOps, observability. Like Datadog was a name that I really loved 2 years ago. I really do not like them anymore because the way that Datadog works is they prevent their customers from overspending on the cloud. For example, what can AI agents do essentially to disrupt that? Create an AI agent that does 70% of the job that Datadog can do, but cutting the cost to just a one-time fee on creating AI agents. That's disruptive. That's an AI tsunami. So Datadog's ability to kind of continue upselling, continue innovating.
And CRM, you said. And what about Adobe? We were talking about that today, being somewhat under pressure with AI maybe being a disruptor to Adobe.
So I believe Adobe is going to be just fine for the higher end customers, but for the mass audiences, I think it's highly disruptive. There's too many competing products out there, but if you're a pro Photoshop user, you're going to maintain on Adobe. But I think the market is going to get a haircut on the TAM on Adobe now. And Figma was their last Hail Mary, essentially to belong in this like maybe narrative, and now they got shut down and Figma's about to go public.
Would you load up on the 15 here for the next 15 years or something?
Absolutely. I think the second layer of AI is going to be disruptive. We're hearing that multi-trillion dollars of spend is going to happen in AI space. Jensen just referenced a couple weeks ago, $100 trillion is going to be spent on AI infrastructure over the course of this disruption, revolution. So I think that's right now the valuations are quite extended, but there is going to be a re-acceleration once we hit that second wave of AI, which has not happened yet. Because the AI agents I'm referencing, the ChatGPT moment has not happened for that phase yet. Once it does, I think it's going to re-accelerate the specific data infrastructure names that are going to show that they're not going to survive but thrive. Software might be struggling a bit, but the future AI 15 names we think are surviving the AI tsunami that's coming.
All right, Shai. Shai Balor, Chief Market Strategist, Futurum Equities. Thank you so much. A lot of fun talking about all those names, and he had a slew that he really liked and recommended. Still ahead, we'll break down all the details on the recent strength we've seen, commodities, solar stocks. Mish Schneider is standing by of Market Gauge, and she's going to go through some of the names she likes and maybe ones she doesn't like. We'll be right back.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
A fresh take on the hottest trends in the market, from every click to every tick.
There's no fear of missing out on Next Gen Investing. 1 p.m. Eastern, only on the Schwab Network.
Welcome back to the Watch List. I'm Nicole Petalides. We welcome in Mish Schneider, Chief Strategist, MarketGauge.com. Mish, good afternoon to you. I just had a great conversation with Futurum Equities, and they have these names, these 15 names, not NVIDIA. It was a little bit of everything else, Qualcomm, Micron, Broadcom, Oracle, Palantir. These were interesting names that they liked. Do you think that we go beyond AI here and see new highs for many names?
Well, I do believe that. I listen to Shai's segment, by the way, and I follow him, so I'm well aware of how intelligent he is on this subject. And I think he was heading in the right direction. Definitely, we haven't seen the second-tier wave of AI. And also, I'm interested in it from a little bit of a different perspective, because I think you need all perspectives on the table, right? And so, number one is we still need energy to run all these AI data centers. Where is that coming from? So that's where I'm looking a lot. Uranium had this huge move because of nuclear energy being a part of it, but that's still a little bit premature. So I'm still looking at some of these other areas, solar, wind, even oil and gas, natural gas being our biggest commodity that we have here for energy and still really cheap, and wondering at what point do they start catching a bid. And then, of course, I'm looking at the companies that you really need to keep these AI data centers going beyond the software. Shai mentioned hardware, but I'm taking even one step level below that, which is like Chemours, which I put on the list for you, which is a company that's a chemical company, but one of the things they make is Teflon, and these semiconductor chips need a coating to operate, and they have a huge number of companies already that they're aligned with for orders for these Teflon coatings. So, there's so many different places to look, and that's just the technology. It's also going into retail and biotechnology and everywhere else.
So, also the big picture here, as you said, you really like to have a portfolio filled with not just AI, but a multitude of things. You also had on your mind oil, silver, gold. Are those good investments now?
Well, it's silver for sure, because silver has been on a tear and then it consolidated. I look at the ratio between gold and silver. It came down, but it still hasn't really broken what I consider to be critical levels where silver becomes a narrative more than gold. Gold is still doing very, very well. I don't know where the bears are coming from. And that's all related to a couple of other things. Number one is the direction of the dollar, the direction of interest rate. We still have a tremendous amount of government spending. We still have a huge debt. That's where those concerns are coming in. Silver is interesting because it's more of an inflationary indicator when it starts to outperform, and it's industrial use. In terms of oil, oil's a completely different animal. So everybody was so negative coming into this year. We started buying it at 62. Then the Middle East crisis hit. We got that big spike. We got out. But what we noticed was that it hasn't really gone down that much. Still a lot of talk about short supply, even with talk of overproduction. Certainly the producers do not want to drill at these low levels, also concerns about tariffs. So if we see this WTI go over $68 a barrel, I think that's a very bullish sign for oil. And then you have to ask, what does that mean in terms of the domino impact?
I want to get to all your other sectors here, but just to follow up on the silver call, because you do think silver is going higher, and I've been hearing that a lot today and lately. If someone wants to have exposure to silver to really maximize gains, because we've seen silver outperform gold in years past, in decades past, how would they get exposure to silver? What's the best way to really load up on silver?
Well, SLV is a very reliable ETF. It has a tremendous amount of volume and liquidity. It is probably the most popular way to trade silver outside of doing the futures. The only thing that I actually caution people who are going to trade any commodity ETF, whether it's USO for oil or UNG for natural gas or SLV for silver, is to look at the underlying commodity. And that's pretty easy to find. You can just Google silver futures prices and it'll tell you what the spot is, because you really want to watch that first. That's what's driving the ETF.
All right, and then also those solar and EV stocks. Do you have any favorite there? And I want to get to Bitcoin too, so a quick thought.
Well, let's see. I guess the best thing I can say about that is TAN, which is the ETF. Again, let's look at ETFs, right? Because you get this big basket of exposure. This week has crossed the 50-week moving average, which it has not been above since early 2023. And this is in the face of a lot of talk anti-solar
and anti-tax incentives and all the rest with BBB, and yet here it is making a massive breakout with great follow-through today. So what does that tell you? Solar is still cheap in terms of an investment, and it is also much cheaper in terms of commercial and domestic use. So that's where I would look for that.
And then last but not least, crypto. How do you go about crypto? Have you been involved? Do you want to get more involved?
I love crypto right now. Not everything, but Bitcoin's getting to 110. That's a big breakout area. Ethereum just crossed over 2550. That is something that I'm really excited about. I haven't even looked at it in a while, but now I would like to see, it's a little bit above that. It's trading at like 2570. I think that can go much higher. And Chainlink, which, things that have actual usage, Chainlink being a bridge between the blockchain and things that you can't typically get on blockchain, that would be another good thing. It's trading at about 1370. Looks like it has a double bottom, good upside. So yeah, I'm invested in all of them.
Wow. A final quick thought here. I mean, you mentioned so many names and investment opportunities. I always love chatting with you. And you're generally mostly optimistic. I mean, you always seem to find the opportunities. Do you think the market's heading higher? I mean, what's your final thought here?
I like two things. Number one is you got to watch the retail sector, right? Because since 2021, the retail sector peaked then, and it's still down almost 30% from those highs while we're making new highs elsewhere. Consumer is super important, not to be underestimated. Certainly going to be impacted by everything, whether it's taxes, tariffs, inflation, and so on. So you have to watch that. And number two is, I still love, Nicole, we've talked about this, the thin economy. I think that consumer is going to come into the market even more in 2026. And then look at the shopping habits of people who are thin and staying thin for the first time in their life.
Yeah, oh yeah. Well, it's a whole new world with that. You're not wrong. Mish Schneider, Chief Strategist, MarketGauge.com. Nice to see you, Mish. Have a good, happy 4th weekend. Appreciate it. Still ahead, we bring in our panel to preview the big jobs report. It's due out tomorrow because Friday we're not here. And we got in the ADP private payrolls, and that showed some weakness. In fact, it had its first decline since March of 2023. What's going on? Our panel is ready.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl.
Schwab, a modern approach to wealth management.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Hey Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
Welcome back to the watch list. We bring in our panel to preview the jobs report for tomorrow. It's very nice to see John Lonsky, who I've not seen in a very long time, president of the Lonsky Group, former chief economist at Moody's Investor Service. Nice to see you, John Lonsky. And Daniel Zoe, lead economist at Glassdoor. Daniel, it's also nice to see you as well. Thank you both for being here. So, John, your thoughts in the big picture, because we got this ADP print today and people were rubbing their eyes. Does it really mean anything? What does it mean to you?
Well, it's not the most reliable indicator of what happens with tomorrow's release on the June's payrolls, but I think it's consistent with the sense that we are seeing a notable slowdown by jobs growth. I can't help but mention, I just came across a consensus forecast that was compiled from 82 economists, their outlook on jobs growth over the next couple of years. Well, they believe that payrolls will grow by only 78,000 jobs per month from July of 2025, this month, through March of 2026. So, get ready for slower jobs growth. Part of this is because of a reluctance to add workers in professional services owing to the ultimate impact of artificial intelligence.
And look, we need a minimum of 100,000 to have stability, right? So the 78,000 is not going to cut it. Is that correct, John?
That's correct. And I think with that type of jobs growth, you're going to see a slowdown by consumer spending. You will find that tariffs in the end may do more to slow the economy than to add to inflation long term. And with payrolls growing by less than 100,000 jobs per month over a 9-month span, you have to figure that you are going to be looking at lower than expected interest rates. I would think by the end of the year, Fed now at 4.38%, maybe no higher than 3.63%. And that 10-year treasury, if we're going to go ahead and stabilize housing, stabilize real estate in general, that 10-year yield has to be under 4% by the end of the year.
Daniel, your thoughts? I know the Glassdoor Employee Confidence Index hit a record low in May. That doesn't sound particularly good. And wage growth, you said, likely to stay flat. How are you feeling about tomorrow's report on the heels of this ADP print today? Is there a correlation in your mind?
Sorry, I was muted. We do expect that the job market is going to slow, but not fall off a cliff. So the ADP report is a sign that the job market is slowing, but we're not necessarily fixated on the specific number that we got. Instead, we think it's overall a sign that, again, the job market is slowing, and that's what we're seeing in worker sentiment too with the Glassdoor Employee Confidence Index. That's at a record low, and it really shows that economic anxiety is very high for workers right now.
And you talked about government, manufacturing, transportation, and warehousing may weigh on jobs growth in June due to policy changes, coupled with, I'll go out and say AI may weigh on jobs growth too, Daniel.
I think it's still probably a little bit too early for AI to be having a significant impact on jobs growth. Certainly there are different sectors where that might be more true or less true, but I think overall the story is still about the slower economy, the slower prospects for jobs growth going forward, because you have to imagine if the economy was doing better, you would see these AI companies hiring software engineers and data engineers hand over fist. Instead, we're seeing a little bit of softness, especially in the tech sector, and I think that just goes to the broader macro story around slower economic growth.
Let's have some quick responses on Fed rate cuts and your expectations or what you think they should have done. John Lonsky.
Well, Fed will probably cut rates in September. There appears to be room for a rate cut at the meeting that comes up at the end of this month, the month of July. But they're holding off because they are still concerned that tariffs may have a lasting inflationary impulse. As I said earlier, I don't think that's going to be the case, simply because you're increasing tariffs, you're increasing cost in what appears to be a slowing economy, especially as far as employment is concerned. And I'll add to this that even profitability has been slowing, especially outside of your high-tech industries, information technology, communication services, where you have the Googles and the Metas and the like. So there's no strong reason at this point in time to believe that the U.S. economy is going to pick up momentum without help eventually from lower interest rates, but they are perhaps not going to be felt. They're not going to come into full force until later this year.
All right, I have 10 seconds. I'm sorry, Daniel. Cut or no cut?
Well, I think that we're not getting a cut in July for sure, and there's definitely going to be some. The Fed is waiting to see what's going to happen. They want to be data-driven, and that means they need to wait for data to see how tariffs are playing out.
All right, great to see you both. John Lonsky, Daniel Zoe, thank you. Good to see you both.
Thank you, Nicole.
That's going to do it for us here on the watch list. I'm Nicole Petalivi. So glad you're with us. A record-setting day on Wall Street. We've had so much to take in, and there'll be more after the bell tomorrow. Headlines pertaining to Washington. Keep it right here on Schwab Network. You can get our Schwab Network app in the Apple App Store, 24/7, schwabnetwork.com. I'm Nicole Petalivi. Market on Close is next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
It's time to look forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on next-gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Good afternoon. It's 2 p.m. in Chicago, 3 p.m. on Wall Street, and this is Market on Close. I'm Alex Coffey. We got just over an hour left in the final full trading day of the week. Will be market action tomorrow, but it will be a holiday shortened trading day, and then Friday a full closure for the 4th of July holiday. Where we sit now with this hour left in trading is essentially all-time highs for equity markets. S&P 500 up a healthy 23 points, 62.21. The NASDAQ 100, after leading the weakness yesterday, a nice bounce back day. Not making up all of the ground of yesterday, but doing a lion's share here. 138 points, about 0.6%, and the Russell's still strong as well. Up about 1%. The Dow essentially unchanged with the Dow. A nice performance yesterday. Factor by factor, growth certainly outperforming value today. If you were to look at a heat map, what you'll see is a relatively mixed session. But if you recall yesterday's session, all of the big squares were the red squares, despite stronger market breadth. Today a little bit more mixed. You got green, you got red, in all shapes and sizes, all sectors. You see Meta and Microsoft both lower, Amazon as well, but amongst Mag 7 you got Nvidia higher, Alphabet higher, you got Apple higher, and the mighty Tesla bouncing as well. Taking a look at a chart I brought to a panel earlier on this week, sometimes I think we just spend a lot of time maybe overthinking. So that reddish, orangish, pinkish line, depending on how you want to define it, is a 20-year seasonality chart. Essentially, if you were to just average out how does the S&P 500 perform on a year around different times, that's how it's done over the last 20 years. The teal line is the performance thus far year to date. So a couple big takeaways for me. One, the period of time that we're about to embark upon, this first half of July, one of the historically most bullish 2-week stretches of any year for the S&P 500. So sometimes maybe it's just important not to overthink it. I'm not a huge believer necessarily in seasonality, but some things are powerful, and you just got to look at where we are in that kind of lighter summer trade around the holiday, typically a pretty strong time for the market. But also, despite all the volatility so far in 2025, the S&P 500 is ahead of pace. The teal line is ahead of the average year over the last 20 years. So incredible bounce back and nice performance thus far year to date, with that first half around 5% or so to the upside. Real quick too, I want to touch on a stock story that just broke in the last 15 minutes or so. So details relatively limited, but a story that OpenAI and Oracle reach a deal for more Stargate projects in the U.S. You can see Oracle taking a leg higher in the last 15, 20 minutes or so. The OpenAI is seeking 4.5 gigawatts of power from Oracle data centers. So Oracle, very, very strong rally, continues to be one of the leaders of this market in working its way back towards its session highs, which of course would be essentially all-time highs, certainly on a closing basis, if it's able to finish out today's session there. Let's zoom back out, and for more on today's trading session, I'm now joined by Matt Maley, Managing Director and Chief Market Strategist for Miller Tabak & Co., as well as the founder of the Maley Report. Matt, thanks so much for joining me. I know everyone's busy with the holiday just around the corner, but let's start kind of big picture. How did you shape up this first half of the year? I just kind of talked about, it was a roller coaster, but so far looks kind of nice. That with the this kind of kickoff for the second half here, what are you looking at?
Well, we have a kind of a weird potential here as we move into the second half of the year. I mean, as much as the market has bounced in a big way off those April lows, it's still up only 4 or 5% so far this year. Now, only 4 or 5% is fine, because to annualize that turns out to be about 10%. And even though it's not as strong as the last 2 years, that would still be good. But my real point on that is that if the market does continue to rally as we go through July and August, a lot of these people only up 4%. That's one thing that these institutional players can kind of play with, and they can kind of figure out what they want to do. If it really takes off, however, they've got to jump onto the ones that are running. No matter what they think of stocks getting too expensive. Some of these tech stocks are getting expensive. Once again, they'll still have to follow them. So we could, there's an outside chance of a meltdown. On the flip side, if the earnings don't come through the way they need to for things to really turn around, that could create some headwinds. And we have to remember that, when you get these big scares in the spring, not always, but frequently, those things come back to kick us in the fall, in the September, October timeframe. So we've got a real dichotomy going on here, and my feeling is I'm really worried about what's going to happen with the earnings season. So I'm a little bit less bullish than I think some people are.
Matt, along those lines, at least right now, it seems like the market's got rose-colored glasses on, and regardless of the information, good news, no news, bad news, there's a reason to get to the buy. And as you mentioned, maybe it's just underweight, trying to get back to, being in line, and people who really bought into the sell-off being a little bit late back to the party. That can change at any moment, though. And ADP, I think, was a little bit shocking this morning. What did you make of those numbers, and how do you think it shapes up for tomorrow's jobs report from the Department of Labor Statistics?
Yeah, Alex, the ADP number, for many years it was a very good indicator for what we would see in the bigger employment report from the Bureau of Labor Statistics, the BLS. It hasn't been as good in the last couple of years, but it is still a concern. I mean, it was a much weaker number than expected. And when you combine that with the news from Microsoft laying off 9,000 people, I mean, that's more of an anecdotal thing. But also, about a week ago, we got the conference board, the consumer confidence number. But one of the components of that is the number where you put jobs which are plentiful versus jobs that are hard to get. That's moved back into an area that you usually see, usually equates with a slowdown in the employment picture. So if the economy starts to show that, the one thing that's held up the economy, of course, has been the employment picture. If that starts to slow, how are you going to get better earnings, in an expensive market? And I guess my point is we're almost at 23 times forward earnings in the next 12 months. And so therefore we need the economy to grow, not slow. We need earnings estimates to rise, which they've been falling on the last 10 months. Those things need to turn around. That's going to be very, very difficult if we get a poor employment number tomorrow.
Matt, this is a super interesting point, because the pushback that most will get on the high valuations, even for the longer term investor, has been, but margins remain sky high, and so they have the earnings power to warrant the higher valuations, or the AI sector is driving growth, and that's continuing. But with trade policy likely to weigh on margins, with earnings expectations coming down, I'm with you. I think it's becoming more and more difficult to continue to make that argument. So at what point is it just simply we got to get through these summer months, we got to get a little bit more certainty on policy? Do we start to watch those two things converge? Either earnings estimates start to turn around, or we start to see valuations maybe go sideways to lower.
Yeah, and I think that will come as we move through the earnings season. I mean, that kicks off late next week, but we really got to wait for a couple of weeks because as we really get into the meat of the season in later July and early August. But you make a very good point. I mean, for me, it just seems like, what is the upside versus the downside? What's the risk reward here? If you add a little bit of cash, if you're 100% in the market and you add a little bit of cash here, you raise a little bit of cash, 10% cash or even 15%. A lot of people might think that's crazy after this big run we've had. Well, what happens if we get through this time frame and everything does look good? Well, then you take that 15% cash and you put it back into the market. At 23 times earnings, this market's not going to run 20% in the next 2 months, right? So you're not going to miss that much. But what happens if things do turn down? Every time the market has gotten above 20 times earnings in the last 50 years, or even actually the last 7 years, it has gone back down to a correction, which has taken it down to at least 16 times earnings. I don't know, that doesn't happen immediately or overnight. But my point is, if you add a little cash here right now, with the market as expensive as it is, you're going to risk missing, 10% move at the most, and you're still going to get paid 5% in that cash. So you're going to lose, miss 5 or 6% opportunity on 15% of your portfolio, or risk 20% decline on 100% of your portfolio. So I just think the risk-reward equation right now is more to the risk side. And I'm not saying go to 100% cash. I'm not saying bury your head in the sand, but just raise a little bit of cash, because the most important thing is if it does turn down, those with cash on the sidelines aren't the ones who sell when the market's at the bottom. It's the ones who are fully invested.
Talk to me a little bit about positioning within the kind of stock positioning, in the sense that, obviously this has been a big mega cap hyperscaler driven market for several years now, but ironically yesterday with the NASDAQ lower, S&P slightly lower, looked kind of healthy under the hood. You had kind of more broad participation. You had financials out in front. Do you see that actually getting some legs? Or is that still just a random day here and there where Russell outperforms NASDAQ, financials outperform tech? Does it have staying power, or again, a one-off?
I think it's more of a one-off. However, having said that, and this is the reasoning behind it. Number one is that if you can't have the tech stocks roll over in a major way, or even in a meaningful way of any kind, they can trade sideways or even rally a little bit and have some rotation. In other words, if new money is coming in, you can have rotation and people say, well, I'm going to buy a little bit less in these expensive tech stocks, and I'm going to buy some other areas, like the bank stock, which are breaking out very nicely. Now, deregulation and such are some good reasons to be buying the banks. But if the tech stocks start to roll over, the indexes are going to go down. It's just mathematically impossible for them not to. It's over 30% of the S&P. I'm talking about the tech sector. Over 30% of the S&P, and over 60% of the NDX. 40% of the Mag 7, but 60% in tech overall. So if the tech groups goes down, the whole market's going to start going down. And when people see an expensive market going down, they start to pull money out. So they're not going to rotate into other groups. They're going to rotate into cash, especially since cash is paying something right now. So my point is that you need to have a tech. We did have a time in late last year where the market kept rallying and the tech group moved sideways. But as soon as the tech group started heading down, the rest of the market followed with it. So be very careful about assuming that we can see a big rotation move in the second half of the year.
Great points, and I appreciate you taking the time here, Matt. Matt Maley of the Maley Report. You have a good long weekend. We'll catch up soon. As we shift gears here, now we want to discuss the outlook for M&A in the second half of 2025 and beyond. Joined here in studio by Ephraim Kaplan, Senior Managing Director of BGL. So glad to have you in the studio here. Thanks for joining me. I know it's a busy week in personal lives for everybody, so we appreciate you taking the time. Let's start big picture. M&A, we're starting to see signs of it coming back, big mega deals and stuff. Is that still on the horizon? We still going to see that out in the future?
Yeah, good to see you, Alex. In the backdrop of a couple rough years in 22 and 23, the market was hoping for some green shoots in 24, and quite frankly, we didn't really see them come about. But I would say if you look at the data, if you look at year-to-date volumes for 25 relative to 24, while they are down, you've seen over April and May some positive signs of resurgence in volumes, which we did not see in 24. Valuations continue to stay quite strong. But there is some of the green shoots that we're also seeing is that there's a significant amount of strategic market activity. So absent a dearth, which we saw in 22 and 23, you're really starting to see the strategic market keep those valuations strong. And we're also starting to see some of the run-of-the-mill buyout activity happen. So given that we're an M&A and capital markets firm, we're hoping that that trend continues.
Yeah, and this is where it's interesting, right? Because from an acquisition standpoint, obviously there's really hot sectors. Things like AI and the startups, whether it's VC, PE, big hyperscalers like Apple and NVIDIA and all them looking for deals. That stuff's happening, looking for the startups, looking for the next hot thing. But then it's also, even in things like oil, we saw these big mega mergers, and we see it's almost like a joined together out of necessity in some ways, maybe. How are you seeing it sector by sector? Is it still like hyper specific depending on what sector you're talking about, how strong or not strong this M&A world is?
Yeah, there's probably two things to comment on there. One is just the segmentation or the interest in certain aspects or sectors to invest into. Secondly is the structure of the private market relative to the public market. So
Right.
let's talk about the former real quick. Yeah, there's the cliche AI opportunities that are super hyper growth, and the public markets are glomming onto those and chasing those. We've been around for 30 years, and a lot of our DNA and a lot of our history really is founded in old school industries, industrial markets, healthcare, infrastructure, and services. And quite frankly, while AI might be the name of the day, we're seeing massive support and massive strength globally to deploy capital into the services market, into the infrastructure market. And a lot of that is driven from, frankly, what is probably the biggest unknown that is keeping from this market from the dam breaking, if you will, from capital, is just this massive amount of uncertainty around policy, as you've spoken with some of your past guests, and tariff issues. So if those things can get ironed out, you'll see broad-based recovery, but right now, services, infrastructure are really bright spots within the firm, and I think the economy as a whole.
Well, I think that makes a ton of sense, right? Like, you got to know the game you're playing before you can make major decisions. But one trend, and this is just anecdotal, I've noticed, and I'm sure there's data that you'll have to support it or not, but it's becoming increasingly difficult in several of the industries, particularly industrial ones, to be the small business in this day and age where technology is important to have, whether it's automation, whether it's logistical networks, whatever. I grew up in a family that owned a small trucking company, and it just became increasingly difficult in the last several decades to compete with the very large companies. And it seems like it's not limited to that specific industry. It's a general trend of bigger businesses are swallowing up market share across the board. Now, that's great for the M&A world, but is that out of necessity or because these bigger companies see opportunity to expand that way?
Yeah, I'm glad you brought it up. I would actually say because of the proliferation of product in the private markets, because of the different ways to access liquidity in the private markets, I actually believe it is more efficient. There's a better risk-reward pendulum when it comes to deploying capital into the small businesses such as what your parents had when you were growing up. So the amount of return that you actually can access in the private markets relative to the risks you take, I think is a better calculus than really deploying capital into the public markets. So I actually think there's the liquidity premium that used to be placed on capital to be in the private markets is coming down, which is pushing more money and more interest into the private markets. So I'm frankly excited about the small business. I'm excited about dealing with opportunities or building opportunities in the old school industries, whether it be trucking, transportation, digital infrastructure, environmental, or the like. So I think there's huge opportunity for small business.
And potentially easy synergies for the bigger businesses that are looking to be the buyers, as well as they've already got the investment into this technology to maybe bring some of those older, smaller businesses to the modern day as things are changing so quickly. As you look ahead, obviously policy uncertainty, but a lot of these trends that have been underway maybe had some hiccups in recent years, but seem like they're trying to come back. Seems like some of the bigger tech stuff they'll wait longer, but in these industries that they're maybe longer lasting, do you see tailwinds on the other side of policy uncertainty, assuming we get some of that certainty, let's say sooner than later? Big, beautiful bills working through Congress. We got these tariff deadlines coming up. Let's say we got a little bit of an idea of what the game looks like. Do you think things can pick up in the second half of the year?
Yeah, we have not, as a firm, we're a very sector specific firm. So we're less product focused, we're more sector focused. Right. I'm comfortable saying that we have not seen or had this much confidence in what's to come over the second half of this year than we have over the past few years. When you think about why...
And this is both sides, buyer and potentially acquirer?
Yeah, I really don't think about buyer-seller gaps. I think as a banker, my job is to bridge those. I do think, generally speaking, at a more macro level, the uncertainty that we've experienced from a policy perspective and a tariff perspective are really, in our view, the main headwinds that have been there to really allow this market to break out. We don't expect the dam to break. Do we expect cracks in the dam to slowly unfold or break a little bit more so that more M&A will happen? We believe that. So that's going to happen over the course of the next couple of years, but we think it will be much more systemic than periodic and up and down, super volatile. We think the VIX will come down. So we're excited about the prospects over the next few years compared to where we were the past couple of years.
Okay, so final question then, for those who are focused on public markets and you got a specific front row seat and lens into something a little bit different, would you say to our viewers, who maybe self-directed investors and trying to decide if they're looking to buy, that this is a positive reflection of the economic outlook?
Absolutely, 100%.
Good stuff. From Kaplan, appreciate it so much. From BGL, joining me here in studio for a really good conversation and exciting. We'll look to have you back soon, continue that. Coming up next, we're going to look at its delivery prints for Tesla. Disappointing, but the stock rallied. We'll find out more why right after this.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Hey, Dad. I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The two grandchildren ready for their college educations.
Quit sleeping with me.
Someday it'll be their turn.
Dad? Dad?
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Hope I get over this tonight.
Welcome back to Market on Close. I'm Alex Coffey, now joined by Steve Wesley, founder and managing partner of the Wesley Group, to discuss Tesla, a stock that will drive investors mad and traders insane. Is Steve, objectively, I think a pretty tough print from the company, but of course Tesla will go where no one expects and it jumps on the news. Talk to me big picture though. What did you make of the numbers we got?
Look, they delivered 384,000 units. That's a small uptick from Q1, but still down 14% year over year. Tesla sales are down in the US, down in Europe, flat-ish in China. And the big issue is at precisely the same time, BYD grew 38% Q1, VW doubled EV sales, GM grew a whopping 97% in EV sales. Tesla needs a game plan to catch up.
So, Steve, are we, in a way, really going to need to see more on whether it's sustainability through batteries, automation, and robo-taxi from Tesla, going forward to rationalize the excitement around this name? Because, and I don't want to put words in my mouth, maybe you can expand on this too, it seems, at least in North America, there's a bit of a saturation of this market relative to maybe where expectations were several years back. It doesn't look like the adoption's quite as widespread. So maybe we start with that point, we can work our way to, what Tesla's going to have to do.
Well, what Tesla has to do is the easy part, but let's talk about what's going on globally. EV sales are booming. There's no saturation going on. Global EV sales are up 29% in Q1 year over year. Volkswagen, BYD come into market with great product. North American sales up 16% year over year. Europe up 22%. China whopping 36%. The simple fact is battery costs are going down. EV sales are going up. Now the question is, how does Tesla win in that marketplace? I think there's a simple three-pronged attack to get back on plan. They need a new $25,000 model to compete with China, Volkswagen, Hyundai. They need regulatory approval for robo-taxi in multiple cities, not just in Austin.
Wow.
And a little bit of rebranding, less politics, more models, more full self-driving, lower prices. That's the plan to win.
What do you think a reasonable timeline is for, a real rollout of whether it's robotaxi, Waymos, you take your pick? I've heard 10, 15 years. I've heard sooner than that. What do you think is reasonable? Several cities have technologies like this rolling beyond maybe what we're seeing right now, which is limited in scope.
Look, the world's moving way faster than that. I think Tesla's got about a year to bring a new, lower cost model to market. That is what the world wants. You can see prices coming down throughout the world, sales taking off. BYD, fastest growing major auto company in the world. Tesla needs a low cost product, but they also need to get going with full self-driving. Again, they have launched in Austin, but it's in a teeny geofenced area with a human being sitting in the front seat. They need full self-driving. They need it in multiple cities. By comparison, Waymo is already in 4 major cities: LA, San Francisco, Phoenix, Austin, but they're expanding into Miami, Washington, Atlanta, New York City, Toyota. They're going global. Tesla's got to find a higher gear to catch up. And don't forget the Chinese. The Chinese have at least 6 major full self-driving companies. There's massive competition there that's spurring better.
No, China had 300 of them.
BYD, Pony AY, and WeRide are the ones to watch. And just by comparison's sake, WeRide is already authorized to provide service in 30 cities in China. So this competition is global. But right now, Tesla's probably a second behind Waymo. They've got to get regulatory approval in more cities.
Going back to kind of the core business, which is of course selling cars and growing that within this EV world, you mentioned obviously the swift adoption we're seeing globally. Is Tesla's divergence from those trends, in your mind, the branding perception, or is it a preference, maybe in Europe, maybe in China, to buy domestic, to buy European products, to buy Chinese products, and Tesla may be seen as an American company?
Well, there's clearly a little bit of that, and Tesla's just not the most popular brand in Europe these days. But I would argue consumers want the same thing. They want a low-cost, spiffy EV that gets as close to 300 miles or more as you can. BYD has hit the cover off that particular ball, and they're offering $8,000 to $9,000 EVs, Seagull in China. They're offering a similar car, Dolphin, throughout Europe. BYD is now selling more cars in Europe than Tesla is. A dramatic reversal from just 24 months ago. So I think a lot of people, US might be a little bit different, but a lot of people throughout the world, whether it's China, India, South America, or Europe, they're willing to buy Chinese cars. The name of the game is getting prices down and getting good new product to market. Right now, BYD is winning that game with Volkswagen and Hyundai right behind.
How do you feel trade policy, if at all, impacts this competition? Are we heading towards a world where the U.S. is kind of isolating itself in some ways, and what kind of impact would that have on a company like Tesla?
Well, look, I think the tariffs are a mistake. We are isolating ourselves, and when you take away the tax rebates, you're just putting U.S. companies at a disadvantage. Companies, whether it's Ford, General Motors, they're going to lose market share, and I think that's a shame. But there's one thing I want to be clear on. A lot of people say, oh my God, the sky is falling, $7,500 tax rebate is going away. What everybody should realize is there's a revolution in battery technology. Battery prices went down literally 20% in 2024, probably going down another 15% in 2025. By next year, even without the $7,500 federal subsidy or tax credit, EVs are going to be costing less than a comparable internal combustion engine vehicle. What we've seen for the last 10 years is if you wanted an EV, you paid a green premium. For the rest of your life, you're going to be getting a green discount. That's why EVs are taking off, not just in the US, but globally.
One thing's for sure is it's rapidly evolving, and the adoption, as you put it, is certainly not lackluster worldwide. So exciting times ahead, and we look forward to them. Steve Wesley of the Wesley Group, thank you so much for joining me on this holiday week. Have a great weekend. We'll catch up soon. Coming up, we're going to look at another Magnificent Seven name that made some news today. That, of course, being Microsoft, with job cuts announced, the second in as many months, really. May also job cuts. We'll find out why right after this.
I'm back. Doo-doot. They keep pumping Apple.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time learning. Trade brilliantly with Schwab.
Market on close. I'm out of coffee. Microsoft announced another round of layoffs. Joining me for more on the developing story is Christopher Davis, partner at Hudson Value Partners. Christopher, thanks for joining me here on this holiday week. Let's start big picture. Obviously, this is this second in as many months of Microsoft's trying to shrink down their staffing here a little bit. What do you make of it? Is it alarming or just everyday run-of-the-mill efficiency cuts here?
I think while Doge may have retreated from the headlines for Washington, within corporate America, efficiency as a theme is still alive and well. We've been long-term Microsoft shareholders at Hudson Value Partners, and I think after a while you get used to the fact that Satya Nadella is going to continue to make some bold moves. They want to focus and invest in innovation, and he's going to continue to do that. So I applaud today's moves.
So when we look at what we know about these moves, it does seem like they're targeted to particular areas of the company, and I'm guessing they're not AI-related cuts.
No. From everything we know, they appear to be targeted in some elements of the sales force, primarily within Xbox and gaming. And it's about 4% of the company, so not a rounding error. It's definitely significant cuts here. And I think it shows that this is a capital allocation decision. In all businesses, capital allocation is key, and this frees up some human capital, some monetary capital for them to be able to allocate back into AI, because that's where growth is. Gaming has been a flat market for them in the past few quarters. It's a solid business. Xbox is a great franchise, but it doesn't have the growth profile of the cloud or AI at this point.
Yeah, and it seems like it's all about the cloud, right? I mean, we were just talking to Oracle earlier, the OpenAI announcing needing some gigawatts from them.
25 more minutes.
Stargate project, but it seems like Microsoft's out in front when it comes to AI cloud infrastructure. And I had somebody on the other day was kind of calling all these companies almost like they're competing, but they're almost friendly competitors as they work together in many of these projects. When you look at where Microsoft fares versus the other big public cloud AI companies, where do you slate it?
I slate Microsoft as the leader. Certainly in share price performance, they
Oh, you
passed
would.
Amazon and Alphabet this year. Meta is in sort of a different business, but if you're in that true enterprise, that Fortune 500 business, that's something that Microsoft really leads far and away. I think the stat is something like 90% of the Fortune 500 is using Microsoft tools in some way. So I think Microsoft has a truly dominant position there.
Well.
Oracle is certainly nipping at their heels, definitely competing on price more, and it's something that they have to watch out for.
Christopher, question for you, because as we watch AI kind of disrupt technology and continue to drive efficiencies and new possibilities, you're seeing companies, and I know it's very different, like Adobe, really see their a threat to what seemed like a market share that was impenetrable just 5 years ago. Microsoft seems like it's in that position right now with these long-standing relationships sprawling across so many different types of B2B businesses, consumer uses, and of course the infrastructure uses that we're talking about. When you look at Microsoft, what can really disrupt it? If you're trying to be an honest assessor of whether or not I should be long or short or not involved in these shares, like what's the bear case for Microsoft opposed to, hey, the stock's done really well?
Yeah, the bear case for Microsoft right now is valuation. It's an expensive stock. It is probably one of the more expensive stocks we own. You're looking at something like 36 times forward earnings at the current level. So we need to continue to see earnings growth for them. And I think we will. You compare it to Adobe. Adobe faces challenges from the likes of Figma and Canva that have truly disrupted it. If you think about Microsoft, they have 430 million Office 365 paid users, highly sticky within that ecosystem, everything from Teams to Outlook and in between. And you look at all over Microsoft's now 50-year history, the competitors they've been able to fight off, whether it was Lotus Notes, Corel WordPerfect. Apple has tried to come out there for years, and even on the free side, the Google Sheets and Google word processor, they really have never been able to take market share. So if we saw a true competitor or one of those come up, that would certainly call into question the moat for Microsoft. But at now, I think it's quite secure.
You mentioned Oracle competing on price, obviously with cloud driving the lion's share of the growth for Microsoft, a higher margin business typically in this kind of macro world where margins are expected to contract for many businesses with trade policy, maybe even just economic slowdown as well. How intact do you see the margin story at Microsoft with companies like Oracle trying to compete on price?
Well, at 67% margins on the cloud and the server business and the AI business, I think they're in good shape. They definitely have some room to come down. And as always in new businesses, when you have strong margins, they contract over time. That's just the nature of competition. But I think Microsoft's in a good position. And you've seen the U.S. government defending them through fighting off digital services tax. And also, Microsoft is a truly global business. They have, local for local data centers around the world, which helps to insulate them within some of these trade tensions as well.
Christopher Davis, thank you so much. You have a great long weekend. We'll catch up soon. Christopher, of course, Hudson Value partner there. So always great to get his insights. Coming up, we're going to look at commodities. We're going to talk some gold. We haven't talked any gold yet. We might talk some Bitcoin as well. Dan Deming's going to join us.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
It is the best way.
At Schwab, how I choose to invest is up.
Hey, lady.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
You
Let's move on, shall we?
excited you're sitting in the same car with Carl.
Where are you going?
Schwab.
Oh, fire her.
Schwab, a modern approach to wealth management.
Binge watch the market with the Schwab Network.
Jimmy mentioned triple modem today on Mr.
7 days a week on schwabnetwork.com and on all of your favorite streaming services.
Schwab.
Schwab. Blub. Well, well. These people don't know what to think. We're at the 200 right now. We're going to find out something here real shortly. Could I ask for silence, please, Nancy? She's rude. Yeah, Jimmy's sick. Lulu. Oh, there she goes. 6220s from 275 to 380. Very nice. Ooh, 360. More minutes to go. We're at 4:50. More minutes to go.
Use your Target Circle 360 membership to get
God, 750. SPX or boom boom. Yabba dabba doo. Less than 4 minutes. Less than 4 minutes. One minute left. Alrighty. Ding, ding, ding. There it is. Closed with a high. So the dips have been buying and the breakouts have been selling. It's alright with me. Now, I really sneezed a lot today. I just couldn't believe how many. Record breaking. I bet you. Oh, I couldn't. I've sneezed more in one day than I have probably in a total of 5 years. And then just to have a stream of it. Follow you everywhere you go. Okay, well, I'm going to get on out of here. So, a couple weeks ago, I woke up and I couldn't, seemed like I couldn't walk. Didn't have balance. So I took a shower and I got my balance in, but that's what I've been worried about for the last 3 weeks. who have never been hopeless. So we'll see. We'll catch y'all later.
I just think that having an outside, educated, specialized perspective is extremely helpful in anyone's situation that's trying to better themselves. I personally have learned a lot of coping mechanisms to sign up and get matched with into kind of something, a feeling of home.
If you've been watching Winston's YouTube videos, then you know that the markets are like the Wild West.
Or somewhere to feel closer to. I have felt creation of myself, my vapor departure. You heal. Wanted to. I still have a ton of this, and I hope you're all doing. Thanks for watching.
or if I need to continue it for more weeks. And if I have to continue it for more weeks, I obviously will miss my group cruise coming up in just 4 short days. I even fly out in 2 days. And so I have been on edge this whole week. Now what's gonna happen, I'm gonna go in for my final IV, and then I'm supposed to be scheduled for an x-ray right afterwards. And if the x-ray is clear, then they say they should be able to put me on pills, which means I'm gonna make the group cruise. So it all depends on today. It's all up in the air today of all days. So I'm getting ready to go to the hospital right now. It's 8 o'clock in the morning, and yeah, fingers crossed if I can get back home before. Oh, by the way, happy Canada Day, everybody. It's our Canada Day. It's your 4th of July coming up in just 3 more days. It's our Canada Day today. So all my Canadian friends and everybody living here in Canada, happy Canada Day. I hope you have an absolutely amazing celebration, an amazing day today. It's party time here in Canada, just like it's gonna be party time in Seattle on the 4th of July, and I'm hoping I'm there. So yeah, fingers crossed, wish me luck. I'm heading out to the hospital right now. Well, as somebody who makes a living on the internet, I have a business that I run, a travel agency, and I have multiple emails. Well, one of the biggest problems is all the spam emails that I used to get. Every time I go on the internet, I search for something, the next thing you know, I get 20 or 30 emails trying to sell me something, or trying to scam me something, trying to promote something, and it drives me nuts. And that's why I signed up for Incogni. Now what Incogni does is it gets you off those mailing lists. If you contact one of these data brokers, now a data broker is somebody out there, every time you're searching the internet, they're looking at what you're doing. Oh, what's he searching? Oh, look, he's entering this information in. Oh, that's his address. Let's get that address. And then they sell it to people out there, not necessarily all legitimate businesses. They could be from the dark web. They could be hackers. They could be people looking to steal your information. And so you don't want to be on these lists. You say, hey, data broker, take me off your mailing list. By law, they have to do it. However, I don't know how to contact them. Do you know how to contact them? I doubt it. But you know who does? Incogni. Incogni does that work for you. You sign up with them, and they get that information out there. They get you off those mailing lists. You'll see a dramatic drop in your spam email, your hack, and it basically keeps your information a lot more safe. Your private information, your address. You don't want all that information to get out there, and you want off those mailing lists. So if you'd like to give Incogni a try, why not follow my link down below or use the QR code right here, and don't forget the code FAMILY to get up to 60% off your subscription. Thank you Incogni for sponsoring this video, and I really do appreciate your service. Okay. This was frustrating, but it's don't panic yet. Don't panic yet. Trouble is, I got good news, but I got bad news. So I went to the hospital, I had my intravenous, and then I went to the x-ray department, and I'm not scheduled today. Why am I not scheduled today? It's Canada Day. So they're working with one machine today because it's a holiday. So they're doing the emergency rooms, they're doing all the patients that are in the hospital that need this stuff done while they're in hospital. I'm not in hospital. I can wait a day apparently. So now I have to go back to the hospital tomorrow and have my x-ray. And if the x-ray is clear, they will write me a prescription for my pills. If the x-ray shows any sign whatsoever of infection, I'll be hooked up to the intravenous one more time, and they'll schedule how many more weeks they want me to be on. So yeah, I didn't find out anything today. Oh my goodness. Of all days to be scheduled, Canada Day for an appointment. So yeah, I got nothing. I got nothing from that today. So now the good news is I'm feeling much better. I do have a little tickle in my throat, like a little cough, but I think it's the air conditioning. It's been scorching hot here in Canada, in Ottawa, and then all of a sudden it gets cold and it gets really hot again. And in my house, my downstairs is nice and cool, and upstairs is really warm. I cannot seem to get the air conditioning right upstairs. So I'm going in and out, and I think I got a little bit of a tickle in the throat from the air conditioning. But I'm feeling really good. I had a goal to try and work my steps up. Doctor's orders, don't panic. Doctor's orders were to walk. Walking is the best thing for a collapsed lung to get it going again and get your stamina up, etc. And I'm not trying to do a hero thing. I'm not trying to do anything special like that. I'm going and I'm doing it a little bit at a time. Like I might walk 1,000 steps and then rest. And then later on in the day, try and walk another 500 steps. And that's been going really well. And I've actually been doing much better than I thought. When I first came out of the surgery, before I went back in for the complications, I never even got close to 1,000 steps a day. Not even close, just couldn't do it. And for 3 days in a row, I hit 5,000 steps. And yesterday, I hit 10,000 steps. Again, not all at once like I normally do. Throughout the day, I work for an hour, get up, walk for 20 minutes, 30 minutes, come back, do some more work, rest, whatever I was doing, laundry, doing the dishes, walk some more. Got 10,000 steps in. Wasn't trying to hit 10,000, it just happened. So I'm getting better. That's a good sign. And I got my fingers crossed that tomorrow I'll find out for sure that my lungs are clear. And if that's the case, I'll be on that cruise. So, sorry, I thought I would have an answer today, and it's gonna wait one more day until tomorrow. But again, thank you everybody for all your support. I really do appreciate it, and really fingers crossed that I'm gonna get there. Well, I hope you appreciate this little update. If you did, please give it a thumbs up. Want to see more tips, more tricks, more travel vlogs, and see if I can actually travel more? Hit that. Have yourself a safe and a great vacation.
$200 million. What would I do with $200 million? Yeah. Buy me a car. Buy me a nice car. Okay. Buy me a nice car. I gotta buy a nice car. Yeah. Nice car. I mean, nice. What kind of gasoline do you get per month? We're going to put 150 gallons in this thing. You get about 20. Good deal.
If you're uninsured, you could have rough waves ahead. Progressive Boat Insurance can protect your...
Alright you guys, welcome back to a brand new video. I found something on Facebook Marketplace. It's a good circle.
Got a little mullet.
Perfect size. Oh, oh gosh, every time.
She drops them every time.
Every time.
And a little pinfish.
Oh, big mullet. No. Look at that, that's a chunk. Woohoo! Need a few more of these, but I don't know why we're only catching one at a time.
Hey, if we can just keep throwing and catch them this size.
Yeah.
Better than Menhaden.
Yeah. Don't fall in. Woo!
Got him.
Oh baby! Is that Menhaden?
Yeah.
Oh my gosh! Check it out, you guys! Yes! We've got bait! Woo! Ah! Woo-hoo-hoo! Good job! Nice! Teamwork, baby! I would say that's definitely enough between that and the 2 mullet for at least one bait trap and maybe a little bit in the other one. So we're just gonna make a couple more throws and I think we should have this done within, how long have we been out here? 20 minutes?
Yeah.
Ooh! Alright, you guys, I'm seeing some mullet jumping right by the boat, so I'm gonna give it one more try here.
There it is.
I got it. Ew. There's nothing there. Okay, you guys, so Andy had it quite easy. All the bait was just there, ready for him to catch, and I have tried and tried and tried. Can't seem to get any. And we've moved to a couple different spots. The wind has picked up, so it's harder to see them. But we have to get a few mullet jumping here at this new spot. Yep. Nothing. We got two or three Menhaden. 3 more little guys. Dang. Alright you guys, we just got back from on the water trying to catch some bait. Andy of course had wonderful luck. Me not so much. I caught a few here and there. These crab pots are perfectly intact. The only thing that they're missing, the trap door that Andy's working on right now where the bait goes. You gotta have that closed obviously or all the bait will fall out the bottom. So we're putting makeshift little trap doors on there and using some wire to tie it together. And once we do that, we will be a-okay to go put these things in the water. I am so ready for some blue crabs, you guys. So all 4 of these pots need the bait cage door mechanism. Right here is where the bait goes into this little spot right in here, and you gotta have this closed. So that's what we're working on right now.
If you figure out a better way to do it, I'm all ears.
Don't we have miniature bungees? I think I brought all that. They're in my truck. We could at least use that on the side that you open the thing. Like wire the one backside.
Nice tight puppy.
Ah, I love it when I save the day, you guys. My brain just works in mysterious ways sometimes. I remembered I had these 4 little miniature, all these bungee cords underneath my seat in my truck. And these will work perfect, so there were actually exactly 4. You don't have to undo any wire wrapping. We can just have this little hook dangle. There you go, you guys. There's one. There's one done. We are headed now to the grocery store to get some chickens. And then we're gonna put our bait and chicken in these pots and finally get them in the water. So stay tuned. Good old Piggly Wiggly. Juicy, big old juicy leg quarters. Only $1.59 for this whole package. Alright you guys, we're finally down here at the dock, about ready to soak these pots. It has been, it seems like just a never-ending thing to get to this point, but we're here. Piece of chicken. All right, you guys, I've got this one pot with our chicken in it. This one's going in first. No rhyme or reason why I'm picking this spot over here. I just think it looks good. Hopefully it's deep enough. Just barely deep enough. Just barely. Yum. Yeah, we definitely, ew. We definitely got enough. I was worried we weren't gonna have enough, but.
We got plenty.
Yum. I really hope this is not one of those situations where you are what you eat. You know what I mean? Like, we're eating the crabs and the stuff that they eat is just questionable. Alright, well, I do feel like we could have gotten some more chicken at the grocery store. This may be a little bit of an unfair advantage, but it's a good amount of chicken in there. 2 big, huge thighs.
All right, y'all. So the second pot is going out in deeper water right behind the boat here, and we do have the minnows in this one.
Sunk. Good job. All right, you guys, I'm gonna take this other bait, Menhaden one, and try not to fall through the dock here, but take it on this other side. So Andy just said that I can't see him, but he's like right behind me. The crabber is checking his pots that are out there, the commercial crabber. He's got a pot like right here. Hey! You catching Minnie? Good. What do you guys use for bait?
Shrimp heads or menhaden.
Oh, okay, that's what we've got, Menhaden. Okay, cool. It's better than that chicken, huh?
Actually, too. You can find the bait all over with chicken.
Yeah, that's true. You too. Hopefully we can do that good.
Do you know QuickBooks Online can streamline your business finances? With your financial accounts and apps in one place, you can see where your business stands. And 86% of customers say QuickBooks helps them simplify their business tasks. Learn more about QuickBooks Online.
Ooh. Leslie's products work harder, so it's easier to enjoy your pool.
Hey, John Janice, hi.
Even when you shouldn't.
Are you at a pool? What? No. Maybe.
Trust Leslie's to keep your pool at its best.
All right, now I'm set. Bam. Did you like that spin move? Yeah. I tried to get it out there. Guys, the time is finally here. We are about to go check the crab pots.
I cannot wait. I'm pumped. We got our we got our laundry basket here to put the crabs in. Just makes it a lot easier to dump them in here, and you don't have to worry about losing them on the dock.
Yeah.
I'll show you guys how this works here in a second if we have some crabs. So.
Oh, we're gonna have some crabs. Let's go see what's in our pots.
All right, this is pot 1 of 40, guys.
Honestly, I feel like the bait traps smell worse than the chicken.
They definitely do.
Oh, I see one. Woo! Oh my gosh.
Let me get up in here.
Guys, we might only have one keeper. That one right there. They've got to be 5 inches, so. Oh yeah, this stinks. Yeah, this is the part where you definitely don't want to get pinched. But we are going to put all the crabs in here for now, and then we'll weed them out. Go. Oh gosh, you guys. It stinks. It smells so bad. Yuck. Alright, you're up. Alright, you guys, 1 pot checked, and we've got maybe 2 keepers, but definitely 1. Nice. Made it look easy.
All right, how many we got? At least 2 keepers, maybe 3.
That's a good one there.
And this one over here is big.
Feisty. Woohoo! first one that has bait in it, so, or the menhaden rather. Wow, it feels heavy. All the bait is gone in this one. They absolutely annihilated all of the menhaden. I was wrong. The chicken definitely smelled way worse than the menhaden.
Yeah, my puppy.
Are you looking to buy a great car but have not so great credit? You need a fresh start from Jim Butler. Look, I know I'm just another talking head, but Jim Butler's 6, 12, 18 credit repair plan is really something to talk about. It's like a roadmap to help you build your credit with a reliable, affordable car, and eventually get you back on the road to bigger and better things. But don't take it from a talking head like me. Go to midmofreshstart.com and see for yourself.
Uncover culture and centuries of history.
Only a few minutes away from the airport.
If you came here illegally, you should be deported. I tried to overturn an election. I tried to overturn an election. How did I do that?
We are at the Dade Collier Airport here in Florida at Alligator Alcatraz. Today is their opening day. Today we're also expecting lots of protesters and Trump supporters. There are so many news reporters here. Let's get into it. Make sure you are subscribed.
This is where I raise my kids. This is where I'm raising my grandkids. We live like 5 miles down. This is our home. We bring our kids here to do cardio. We bring our kids here to learn how to drive on this strip of road. This is so unjust. This is so inhumane to the people that they're calling illegal immigrants. They're not.
Trump is a traitor. DeSantis is a coward.
We live in Everglades City. We're from here. These people don't belong here.
Yeah, I mean, they're saying that it's going to be really bad for the environment. As the resident here, how do you think it'll affect things?
I don't think it'll affect me at all. I mean, actually, it'll help America because it'll be keeping the criminals out. So for me, it's a cheap price to pay.
They basically filed the federal lawsuit arguing the project requires a full environmental impact review.
How come you think people protest these deportations from the Trump administration and not when Biden deported like over 3 million people?
And I think you look at the way in which this is being, this project is being advertised, this Alligator Alcatraz, this idea of this horrible concentration prison camp for scaring people into self-deporting. But I also don't like that question. It seems like you are from an outlet that is going to try to create some kind of narrative that...
Well, I'm just with myself, so...
Okay.
I did see on the videos they had like places for food, places to get legal help. Would that sound like a horrible like concentration camp?
I think the idea of putting 5,000 people in the heart of the Everglades in a way that they are consciously trying to conjure the image of a terrifying prison camp shows that this is BS window dressing. You know better. You're not stupid. I would hope that you would think about these questions yourself.
The only terrifying prison camp did in fact come from the Biden administration. This is how they treated undocumented people. Why weren't liberals protesting then? We have seen inside this facility and the living conditions are appropriate.
Hey, Biden wanted me in here.
I get the premise and the emotion behind it, but we need to make America great again. And the way that we do that, we voted for mass deportations and to close our borders.
Trump is a traitor. DeSantis is a coward. Trump is a traitor. DeSantis is a coward.
Do you agree with the criminals who have raped and killed being deported?
At least arrested. I don't see what difference it is whether we imprison them here or whether we deport them.
Of course you can deport criminals, but these people mostly aren't criminals.
Water is going to be contaminated. Where are they going to put the sewage?
What do you think about Alligator Alcatraz?
I think it's needed. It's a good spot for it.
And so you're from Florida?
Naples.
What do you have to say to the protesters?
I think it's not going to work this time. We have to figure out who these people are, see if they can stay, see if they can.
I would say the alligator could certainly eat as many criminals as they can.
We have spotted a gator here
at Alligator Alcatraz.
We are here at the Everglades Alligator Farm in Miami, Florida to find out what these migrants will be up against should they escape Alligator Alcatraz.
You know, the fact that we're not going to have funding available for shelters, the fact that people don't have a safe place to go when the storms come, and it's Florida, it's hurricane season. We're getting hit. You know, these are problematic. We're watching them in D.C. right now argue over how to spend $4 trillion.
We took the FEMA money that Joe Biden allocated to pay for the free luxury hotel rooms, where he's paying hundreds of millions of dollars in New York City, and we used it to build this project, and Narana was just a little fraction of that money.
I don't know anything about any immigrant being put in a luxury hotel. I think that might be...
Well, I've been there. I've been to the Roosevelt, and I spoke to the people outside there, and I mean, they were there. They get free housing. They get sports.
I don't know anything about that. I'm sorry.
Well, I think that that's important to know as you are protesting against ICE.
I don't think it's too important to know it all.
So this is Bob. You're a longtime supporter of Trump?
Yes, actually for the last 8 years, and I'm actually a registered Democrat.
It's sage. We burn it for our ancestors. We burn it for peace. We burn it for protection. We burn it to protect ourselves.
I'm surprised that like by 9 months they wouldn't be bigger.
Right.
We love you, and for anyone who doesn't love this country, guess what? We still love you, but if you don't like it here, you're free to go to another country.
This is what decency looks like.
So as a former Democrat who became Republican, I remind people that we are a constitutional republic, and every country has immigration laws, and every country enforces them.
This is what democracy looks like.
Guys, so it feels like holding a snake. Kind of, you can feel it breathing. Because at this stage they can bite.
Yeah.
Which probably weighs like, what, 30 pounds?
That's what I think.
Okay.
25, 30 lamb.
She's strong.
Oh, yeah.
People have not gotten due process. You do not love them. If you cannot read the Constitution, then maybe you should not be telling your side of the story.
Anybody who comes to this country, even if they come in illegally, once they have made contact with U.S. officials, they are given a court date. In that time frame, if they commit a crime before that court date, they can have an order for their removal.
Now we are going on an airboat. I've seen videos.
Oakland is a baseball town. As a symbol, it's super powerful. Yeah, I love baseball. I love the ritual involved in it. I love the uniforms. I love the field. I'm Tim Queta, and I'm part of the founding team of the Oakland Ballers. In 2023, we lost our third major sports franchise. So when we started the Ballers, it was very important for us not just to keep professional baseball in the city of Oakland, but to keep something in Oakland to give the people of Oakland pride. Running a baseball team is like running multiple businesses in one. We've got contractors, we've got baseball players, we've got full-time staff. Gusto, taking care of the payroll and HR aspects of that, has allowed us to focus on baseball. I'm not an HR person, I'm not a payroll person. It's helped me build HR and payroll organizations, which is fantastic. The Ballers are our way of giving back to the city of Oakland, and quite frankly, we couldn't have done it without Gusto.
So one of the questions we get asked almost every time we're working with a new client is, does this health insurance cover prescription drugs? The majority of the health insurance plans out there, especially major medical plans, they do have prescription drug coverage. But I will tell you, in today's environment, prescription, especially generic prescriptions, can be sourced mail order from numerous places for next to nothing. And so even if a health insurance plan doesn't have the best prescription drug coverage, that doesn't deter me from recommending it to a client. There's just so many options for consumers, whether it be Amazon Pharmacy, whether it be Cost Plus Drugs. Mark Cuban's taken on the world, and he has a generic prescription drug mail order plan that is just a good option for consumers. You've got different things like GlickRx and GoodRx, all of these discount options for prescriptions. It gets really tricky when you start talking about specialty drugs and brand name drugs. Those type of prescriptions can be a huge cost for consumers, and the options sometimes can be very limited. So it takes a very special broker, someone that has a lot of knowledge and understanding of the industry, to be able to help guide you to the right type of plan. things like compounding pharmacies and sourcing prescriptions from international manufacturers. There's just a lot of different options in the prescription drug market to help consumers minimize their prescription drug costs. Thanks for watching. Please subscribe to our YouTube channel. If you have questions, please leave them in the comments. I will say though that health insurance discussion is a very intimate discussion, and the best way for us to help you is to reach out to us directly. You can find us online at bbsinsurance.com. Please reach out to us and we will tailor make a health insurance solution for you and your family.
Of this, it's so cool. It looks like they are driving through the land, but it's water.
You guys are sitting up here. You guys do know you guys are sitting in the wet zone. Tsunami.
To support the president. I like what he's up to. I think we need to get the illegals out of here, especially the criminals. And the ones that we can work out a relationship with, like in farming or construction or the hotel industry, what have you. And he's already on that. We can work something out in that direction. But I want to say something to the Democratic Party, and I'm a registered Democrat. How dare you bring in 20 million illegals and 500,000 of them are criminal? How dare you put our country through this insanity of murderers and rapists and every other piece of crap? Unfair, unwarranted, un-American, undemocratic. How dare you?
We are on the airboat and we are about to pass the gator.
If you guys want, you guys can stand up and get a better look. Right? That is a wild alligator.
What's going on out there with the terrorists and the criminals and this and that? There's 500 million of them. Why are they plaguing everybody in America, and why is that fair?
Are you originally from Miami?
Where do you get this group, the 10,000 prisoners?
They have already.
Who is they? Who is they? Tell us who they is.
Who is they?
Yeah, who does these people?
This is what we call 6 legacy media reporters versus 1 Trump supporter. So Holden, it sounds like you're very, very against this place and like Trump and all like Trump supporters and
100%.
So, like, you said that this is a white nationalist thing and that the reason why they're deporting people is because of their skin color and they don't like their culture. Like, that's what I heard, right?
I mean, to a certain extent, you know, I think that's why the population is so willing to go along with this. They said it was because that they don't pay taxes, even though studies have showed that immigrants pay on average more taxes than the top households in America.
But I mean, like, how are they paying taxes if they're getting paid under the table?
Who says they're getting paid under the table?
Well, how would they be getting paid and like they're not filing their taxes through their employers? They're hired illegally, so, how do they pay taxes?
So every time somebody.
We've got store-wide savings this 4th of July at Metro Appliances of War. Take advantage of 20, 30, even 40% off on laundry, refrigerators, dishwashers, ranges, even outdoor grills. We have top-load laundry sets as low as $4.79 each and front-load laundry pairs starting at $7.99 each. We've got
Pay somebody, they have to take out taxes. Who spends money?
I mean, not if it's cash. You take out cash and give them cash, and they don't pay taxes on that.
Yeah. So is Home Depot doing that? Is Home Depot paying people under the table?
I don't know. Are they?
I would assume not for a $1 billion corporation. So why is ICE going and raiding?
Well, because the people that are getting deported at Home Depot, they're like the day laborers.
Is it funny to you? Is it funny to you that immigrants are getting illegally detained without due process? Do you understand what due process is?
I'm sorry, it seems like there's confusion. It's not like the Home Depot workers are being deported.
Have you not seen the videos of them chasing the Home Depots?
Yeah, it's the day laborers who wait for work outside.
That's not true. They've raided. Have you not seen the videos of?
Yeah, and I went there, and it was the day laborers who wait outside for work.
So let me ask you a question. How many times are you going to interrupt me? Can you answer that? No? Okay, sounds good.
Trying to prevent a concentration camp from being built in our backyard.
What is a concentration camp?
What is? mean, I can't give you a definition or a dictionary definition right now, but I would say anywhere they're gathering a lot of people that aren't being given due process.
I guess, how come there has been so much protesting against the deportations?
Because they're fascists.
We say no! We say no! We say
yes!
I can't even understand what they're saying.
Yeah. Yeah, it seems like they think that the more angrier they are, the more correct that they are.
I don't know. How many of them are illegal?
Yeah.
I don't know.
Yeah, it's ridiculous that they cover their faces. I mean, they pretend to be a part of this cause, and I think it's annoying that they pretend that they're speaking on behalf of other people, always. Like, other people can speak for themselves.
But they're not speaking for me. And I live in the Everglades.
You live in the Everglades.
We live in Everglades City.
Yeah. And you're also an immigrant.
Who?
Are you
Yes, I am.
Legal. She's a legal immigrant. She's a citizen.
Yeah. And I guess, like, as a Hispanic immigrant from the Everglades, what do you think is important for people to understand about our immigration policies? And
you have to follow them and you have to assimilate, you know? I love this country. Be nice.
Yeah. Yeah.
From what I understand, the people that are already have passed their court appointment time, a lot of those guys, they're out there, millions of them. I mean, these people want them to stay.
Yeah.
And as far as they're worried about going into churches, well, wherever the immigrants are, the illegals are, that's where they should go to get them.
Yeah.
If there's so many immigrants that don't like where they live, why don't they change the rules where they live? Kick their government out and make a new government the way they want it.
Yeah.
They want to come here and change our way of life to their old way of life that they're running away from. It's
the same thing. It's the same thing that's happening in Europe with, like, Muslims taking over, or North African countries. They want other people to adhere to their way of life.
U.S. citizens. Whoever's worried about my name's Enrique Tario. You believe the
Yeah, if you don't know what you're up to, like they would, just because of the invasive animals. See these spores in the bottom? Those little things are.